All right, welcome back everybody to day 4 now of the TraderLion conference. Another great group of presenters yesterday, and we've got an amazing lineup planned for today as well. Let us know what was your favorite presentation from yesterday down below in the chat right now, and also let us know where you're tuning in from. Always cool to see who's the furthest away, so we'll have a friendly competition there. As always, again, this is the 2025 annual training conference featuring market wizards, top traders, top educators. This is the best event for traders out there. You can learn new strategies, new setups, risk management principles. And today is going to be another fantastic group of presenters. As I mentioned, we're kicking things off with Peter Brandt, Market Wizard, discussing risk management and just general key principles for success over the long term, over decades. Then we've got Pax Trader going even more into the lessons that have allowed him to trade again for decades, and also getting into his opening range breakout methodology and how he goes about preparing for that. And we go through a bunch of examples of that as well. Next up, we'll have Jason Shapiro discussing 3 characteristics of a strong risk-reward trade. Again, another market wizards. So it's fantastic to get to learn from their experience. And then at 1:30 p.m., we've got Deepak Uppal, top performer in the U.S. Vesting Championship, both in the regular division as well as the money manager division as well, discussing positioning for outperformance, sharing a lot of trade case studies and key tactics and, again, principles to be able to perform over the long term. Lastly, at 3 p.m., we're wrapping things up with our very own Ross Haber discussing CANSLIM in modern markets, discussing alternative entry tactics, how he manages risk, sell rules, all of that, going really into detail on a lot of examples. So that should be really fantastic as well. So hopefully you guys are looking forward to today. Should be a great batch of presentations. Let us know in the chat right now, who are you most looking forward to? And there's a lot of experience here on the table that I look forward to, hearing all the lessons that they have to share for us about how to trade sustainably for decades to, allow us to compound, because that's the ultimate goal. So looking forward to all this. And again, let us know in the chat which of these speakers you're most looking forward to hearing from. All right. Again, we're keeping this conference completely free. This is the 5th time we're doing it. It's amazing every single year. It's my favorite time of the year. But in exchange, what we do ask is that you help us spread the word about this resource that we're building. You can go ahead and scan this QR code and it will basically prompt an X post here that you can share. But also feel free to share the URL link of the stream itself in Discord, on Twitter, wherever you communicate with other trader friends. And again, just help us spread the word. We put a lot of work and time into this, and we want to reach as many traders as possible. So help us go ahead and, again, spread this resource. And a big thank you in advance for doing so. All right. A huge thank you to NinjaTrader Live for sponsoring the conference. They were instrumental in helping us put this together. You can tune into NinjaTrader Live for daily futures trading, real-time market coverage, and actionable strategies. This is a great resource that you can go to, especially for futures traders out there, to learn risk management, entry setups, risk management, and actionable strategies, as I mentioned. So you can scan this QR code right here to go ahead and check them out. I highly recommend it. They've got great resources on their YouTube channel. And again, they're live 6 days a week with top traders and educators. So you don't want to miss this. Check out ninjatraderlive.com. NinjaTrader, and then the URL is in the description as well as popping up in the chat right now. So definitely go ahead and check them out. It's a great way to support the conference as well. So as a thank you, definitely go ahead and check out their page and resources. All right. Again, we put a lot of work into this. Everything is recorded. I'm sure I'll get that question asked a few times today. And a great way to get the most out of this event is to make sure that you sign up for the free VIP pass that's on TraderLion.com. You can scan this QR code right here, or click the link that's in the chat or in the description. And this gives you access to all the slides, all the recordings all in one place, as well as bonus notes, key takeaways, and resources that we're creating along with all the recordings. So if you don't want to miss out on that, definitely go ahead and unlock your free VIP pass. Again, the link is down below in the description. It's in the chat as well. And this also gives you access to free giveaways of TraderLion Masterclasses and subscriptions to Deepvue. So you don't want to miss out on that. So make sure to sign up. Again, it's 100% free, and you can either scan the QR code or check out the link in the description. All right, I do want to mention a key resource that we just recently published a month ago, pretty much now. This is the Trader's Handbook. This is our debut book. It basically walks through step by step. Each chapter covers one aspect of a trading system. So everything from post analysis to sell rules. I know a lot of people are working on improving those, to entry setups, entry tactics, risk management, building a model book, how to do a trading study. All of that is covered in this fantastic resource. We worked very, very hard to put this together, and I think it's an amazing, comprehensive resource that can benefit a lot of traders out there. So let us know in the chat right now if you've already picked up your copy. If so, what have you thought so far? We're rated 4.9 stars on Amazon, which is fantastic. There's not many books that can claim that. And we've got over 400 reviews and already over 13,000 traders that have picked up a copy. So definitely go ahead and check it out if you haven't already. Here's a quick testimonial from Mark Minervini. Great to hear his thoughts on it. The Trader's Handbook is a comprehensive encyclopedia for investors interested in learning the ins and outs about technical analysis and stock trading in general, packed with explanations, practical insights, and real-world examples. It also features a model book section showcasing historical stock market winners, highlighting their breakout points, key patterns, and notable price behavior. A great addition to any trader's library. So go ahead and listen to Mark if you haven't yet, and pick up a copy. And we worked really hard on this. It doesn't only incorporate our experience of all the authors, but it also incorporates a lot of the key concepts and principles that I've learned interviewing well over 100 market wizards and top traders. So it's a great kind of overview and incorporation of all those ideas into creating a sustainable trading system. So definitely pick this up as well. And I do want to mention that this is basically also your ticket to unlock the free educational course that goes along with this book that has additional bonus webinars. We've got 13 of those that go along with each of the chapters. And we've also got bonus webinars on trading breakouts, specifically going really in depth into that process, pullbacks as well. So there's a lot of bonus resources. And in addition to the model book that's included in the book itself, we also have 5 additional model books covering key setups and key patterns to look out for. So you don't want to miss out on that. So definitely go ahead and check this out. And once you go ahead and purchase it, send us your receipt at TraderLion.com/handbook. And you can go ahead and get access to that free educational course that comes with it. So this is more than just a book. This is a tremendous resource in and of itself. But in addition to that, it unlocks a whole suite of resources that can really help you accelerate your learning curve. So again, if you haven't yet picked up the Trader's Handbook, go ahead and scan here or click the link that's in the chat and pick up your copy. And again, if you're, if you've already picked one up, thank you, first of all, and let us know in the chat, let other traders know in the chat, what you thought and if it's valuable to pick up, and be great to hear your guys' thoughts. So with that, let's keep on moving here. I also want to mention that over on TraderLion.com, you can unlock a lot of free resources, free educational courses. The Ultimate Trading Guide is a fantastic resource in and of itself. We've also got the archived TraderLion podcast, educational articles, blogs, and much, much more. So visit TraderLion.com to unlock that. And also, if you want to go even deeper, I highly recommend checking out the TraderLion Masterclasses. We basically partnered with top traders and educators across many different disciplines to create the best deep dive resources available on their specific topics. So you can learn stage analysis, for instance, from Stan Weinstein himself. You can learn swing trading from Oliver Kell, the US investing champion and record holder for swing trading. This is a fantastic resource that I learned an immense amount from, and it really shortened my learning curve. Oliver's a fantastic educator, and he really put his heart and soul into this. Each of the webinars is basically 4 or more hours long, going really in depth into his process, and you can learn exactly how he interprets price action, scans the market, his entry setups, his position management rules, his risk management rules. All of that is in there. So I recommend the Swing Trade Masterclass if you're just starting out and don't know which one to choose. This is really, really good. We've also got market analysis from John Boyk, which basically teaches you the blueprint for trading success, both by analyzing top traders in history from William O'Neill to Darvis, going back to Wyckoff, how they traded, what stocks they traded, how they evolved as traders. And we also go in depth into different markets and different leading stocks going back, to the early 1900s, and you'll really see the parallels that build over time, and really learn, again, that blueprint for trading success. So this is really recommended. There's also a lot of bonus guest speakers in there that are fantastic, that add their perspectives onto things. We've also got the Trading Psychology Masterclass. You guys heard from Jared yesterday. This is a fantastic resource that allows you to build a system for your mental game, for trading psychology. A lot of people, work on their fundamental system, their technical analysis system, and that becomes edges for them. But then they kind of neglect the trading psychology mental game aspect. And this is really, really important. And Jared is a very systematic and fantastic educator. And I highly recommend this resource if you haven't already. So if you're looking to improve your discipline, your confidence, all of that, this resource is fantastic. I highly recommend it. So with that, again, check out the TraderLion Masterclasses at TraderLion.com/university. All of these are 30% off during the duration of the conference. So don't wait. Go ahead and pick one up today if you're interested in them. All right. Also, I do want to mention that every year we're also, as a part of this event, trying to do something good. In addition to creating this educational resource, we also want to raise money for charity. And again, we're working with St. Jude here to donate. We're over 1/2 of our goal, so we're over 10,000 raised, which is amazing. Thank you so much to everybody who's donated. And if you haven't yet, and you've been watching the conference, found value in it, and have gotten at least one takeaway, which I'm sure you've gotten by now, go ahead and donate at least $1. Again, if you found any value in the conference, please go ahead and do so to help us, raise money for a great cause. We take no cut out of this money. YouTube takes no cut out of the money, and I think they even pay for any fees associated with it. So help us pay it forward, and support the conference, and do it in a way that supports a great cause as well. And donate now if you haven't already. I'll be doing so as well, so definitely go ahead and donate. The link should be to the bottom or right side of the stream itself, and I think in the chat as well you can click that icon that's like a giving with the heart icon, and that allows you to donate as well. But again, a huge thank you to everybody who's done so already, and a thank you in the chat to everybody who's donating right now. So help us pay it forward, and pay it forward by donating to St. Jude's. Also, I do want to mention that in addition to, of course, this conference that we put on every year, we work extremely hard with this YouTube channel. This is kind of my personal project to create the best foundational resources and in-depth resources for trading education out there. We work incredibly hard. We do webinars with market wizards. We have, of course, the TraderLion podcast, educational tutorials. We've got the Trader's Handbook webinars that go along with each chapter of the book, going even more in depth. And we just work extremely hard to create the best educational content out there that can help shorten your learning curves. We're creating the videos that we wish we had when we were first starting. So go ahead and subscribe if you haven't already. We're shooting for 200,000 subscribers this year. So go ahead and click that button. It's 100% free and helps us move towards that goal, and helps you unlock all the resources that we'll be posting, which will be fantastic. And also definitely check out our huge library of interviews with market wizards, top traders that we've already posted to the channel. So again, go ahead and subscribe, and go ahead and leave a like on the stream. Again, that helps push it to a wider audience and helps us reach more traders. So, if you're not able to donate, definitely go ahead and hit that like button. It's completely free. And again, lets other traders know that this is a valuable resource that we're creating. So a huge thank you in advance for doing that. All right, so with that, let's go ahead and kick things off for day 4, the end of the second weekend of the 2025 TraderLion Conference. A huge thank you again to all the presenters. They're going to be fantastic. And thank you guys in the audience. I hope you guys have your notebooks ready. And this should be a fantastic day of education. So looking forward to seeing the presenters. Let us know again in the chat who you are most looking forward to. And we'll be right back with Peter Brandt in just a minute. Stay tuned. Thank you. All right, welcome everybody. It's my honor to introduce the next presenter of the TraderLion conference, Peter Brandt. Peter is a veteran trader with over 4 decades of trading experience. He is known for his mastery of classical chart patterns, process, and risk management, and he was featured in Unknown Market Wizards and is the founder of Factor Trading. Peter, so great to have you back. Really looking forward to this, and great to have you.
Hey, thanks, Richard. By the way, I loved your book. I loved it. One of the best. I recommended it, and I don't recommend very many books, but well done. Very well done.
Yeah, thank you very much. And I see that you're enjoying the Tour de France right now. I wonder if there's any parallels between cycling and trading that you might cover, but it's been exciting for sure.
Yeah, I've been a Tour de France fan forever. I've been over to France. I've gone over, followed stages around. I watched it from TV, TV back when it really even wasn't on TV. You had to kind of scramble to find where it was. But yeah, it's great. Yeah, thanks for having me on.
Looking forward to this. Let's go ahead and dive right into the slides.
You bet, Richard. Let's do that. I've about 10 minutes of prepared remarks. Then we'll jump right into the questions your people would have. I want to talk about trading as an endurance race. To me, trading is kind of the ultimate career endurance race, at least it has been for me. Tour de France is the ultimate sporting endurance race, 3,000 kilometers of biking over mountaintops on gravel for 21 days, really an endurance race. And, it shares, I think, that characteristic with trading. Trading is really something that requires endurance. I want to refer to something that I talk about quite a bit to those people who are in my community of speculators. And that's something that I call the Pareto principle. And I'm just going to make the statement going in that as a trader, how you understand and apply your trading relative to the Pareto principle really will decide your future as a market speculator. For those of you who are familiar, it's the concept of the 80-20. It's that 20% of what you do will produce 80% of the output that you have. That 20% of volunteers among 100 will produce 80% of the work that's done. And it applies to trading too. And this is something, and I'm going to talk about metrics here in a little bit, and hopefully there are questions on metrics. But one of the key metrics to me is that when I look back over my trading, and it's year in and year out, 20% of my trades produce at least 80% of my profits. And I actually kind of go 15-85, that 15% of my trades seems year after year after year produce 85% of my profits. And that just doesn't apply to me. Over the course of 50 years of being in the markets, I've got to know an awful lot of people who you know by name, and I've got to know them as friends and as peers. And I've had this conversation with just about any trader that I consider to be a trader in whom I'm going to have great respect. Does the Pareto rule apply to them? Does it apply to Paul Tudor Jones? Does it apply to George Soros? Does it apply to Stan Druckenmiller? And in fact, it does. I've not found any trader that cannot relate to the Pareto rule in how they are trading. So I'm just going to assume it's going to apply to you. Whether you like it or not, it's going to apply to you. And what it really deals with is that the outcome of your next trade or even series of trades just does not matter. What matters really are the metrics over a large number of trades where you've traded for a couple of years, 2-3 years, 200 trades, 300 trades. And then it's trying to figure out what metrics besides the concept of Pareto really matter. I just find it interesting when I look at social media that the metrics that seem to be the most acclaimed metrics among at least retail traders are win rate, Sharpe ratio, rate of return. And those are metrics that, in my opinion, just don't matter at all. Those are metrics that, while I'm aware of one or two of them casually, they're not metrics that I really care about in terms of how I measure my own trading. The metrics that matter to me, and I think the metrics that you want to have if you want to survive to thrive, have to be Kelmar ratio, profit factor, and expected value. I'm just going to assume that you know them. I'm going to assume if you don't know them, I'm not going to explain them. You can Google it, you can look at it. But if you really want to trade as a career over a long period of time and be consistently profitable, you are going to have to figure out these three metrics, because you excel in these three metrics. You will excel in your Pareto principle calculations as well. Now, I'm not going to go through here. I do keep track of metrics. I'm obsessed with metrics. I keep more metrics than I probably should keep. But I really like to understand the metrics I like to understand the math of my trading, the math behind my trading. If you want to look at my metrics and even print them out just to study them, you're welcome to do that by just going to my Twitter space at Peter L. Brandt. I post this chart there. I do not post rate of return because I just don't think rate of return is a metric that I really want to judge my own trading on. What does the Pareto principle look like to me? I just got briefly go through this, then we're going to get to question and answers. But over the course of the year, I trade about 100 times, about 100 trades. I get dealt in about 100 trades, two plus trades per week as new initial positions for me. And in each trade, I do 2 tranches. And so just think of it this way, that over the course of the year, I'll trade 100 trades or 200 tranches, each trade having 2 components to it. And at the end of the year, I look back and calculate this year, every year, and I find I know what my net profit for the year is. Then I want to find out how much of that net profit was produced by 15% of my trades. And what I find pretty much year after year, and these are averages, that 30 tranches out of the 200 really give me the profit. And the key thing is I don't know in advance which 30 they're going to be. If I knew in advance, I'd only take the 30 and I'd forget the other 170. That I end up with about 70 tranches of relatively small winners, 100 basis points, 120 basis points or less. Then I end up with about 100 losing trades. So about a 50% win rate. The importance to this is, in order for my Pareto trades to be net profit to me bottom line, I need to make sure that the small winners offset all of the losers, so that at the end of the year, I have 30 tranches pulling the weight and 70 small winning tranches offsetting 100 smaller losers. If I can do that year after year after year, I pretty much know that I'm going to come in on target in trading, in attempting to achieve certain metrics. Rate of return, win rate are not metrics. So, Richard, I'll turn it over to you. I'm sure you'll have questions.
Perfect, Peter. That was excellent. And it kind of leads me into exactly what I want to talk to first. And what I wanted to start with is looking at the Pareto principle and applying it to your trading. Maybe talk through about your process for doing an annual review, or if you do it on a more frequent basis, how you actually go ahead and look at all your metrics, or do you kind of track them continuously throughout the year?
Yeah, no, we do. I mean, I really follow my trading really, really carefully. It's kind of like a doctor wanting to know your blood pressure and your heart rate and your oxygen rate and your vitals and all your blood tests, where doctors are taking a look at all these numbers and trying to appraise whether you're healthy or not. And that's really what I want to do. Is I want to be taking the pulse of my trading. I want to dig into my trading. I want to understand it from a math point of view. What I do annually is really look at the metrics themselves. I don't really go back and look at something on a trade by trade basis and try to appraise it that way. I really want to look at composite numbers. And so I actually trade at 3 different futures commission merchants, FCMs, and that includes crypto, and occasionally I'll put on an ETF position occasionally. But I have all of these 3 FCMs, and the data flows in, and I keep a unified trade sheet then, and I keep track of all my trades, all of the details of trades that go in on an Excel program. Data in the trade, what the symbol is, the market, what I see, where I'm getting in, where I get out for an initial stop, what my target is, what the pattern is. And so I'm measuring all these things, and I keep track of that on an annual basis. Then really what I want to do is look at the trades, starting with the largest single profitable tranche, because again, remember, one trade equals two tranches. So I'll take on a trade, and it might be 10 soybean contracts, might be 6 on a shorter term basis, 4 on a longer term basis. So I have my 2 tranches. And so I'll measure which tranches were the highest profits all the way down to the biggest losses. And then it's just really a question of trying to find if for instance, there's 200 tranches, where am I at the end of the 30th most profitable trade? And then that usually comes in. It's great with AI now. I used to, crunch a lot of this data myself. With AI, it's super interesting. Is I'll just take trade by trade. I'll take every trade, the rate of return of each trade against total nominal capital. I don't do rate of return against margin. I think that's nonsense. Rate of return against the value of an underlying stock, that's nonsense. You always measure performance against total nominal capital, and that's what I looked at for these trades. So it's a basis point number, not a dollar number. And so I'll look at that, and then I'll let AI really dig into my trades and, what's my profit factor, because that for me is a really big one. Manual, I will keep track of my 3 and 5 year Kelmar ratios, and some people keep Kelmar on a monthly basis. I don't, but I'll look at it annually. But then I'm looking at skewness, I'm looking at kurtosis, I'm looking at gain to pain, I'm looking at quartiles, and, I am really trying to really dig into the numbers and get a sense. And then being able to compare those numbers to benchmark numbers, because for me, I have traded pretty much the same way with some modifications. I mean, there's been evolution to some of the areas I traded, but for the most part, the deal, I'm a breakout trader who wants to let winners run and take losers real quick. So that's what I do, and I just then compare it against benchmarks. And when I'm way off from my benchmarks, then I'll dig in and try to figure out maybe why that is.
And when did you kind of develop this process that you do to dive into the numbers, and did it correlate with turning profitable and really seeing an improvement in your performance overall?
I was a wild man, 1970s, 1980s, I started in 74 was my first trade, joined the board of trade in 75, blew 3, maybe 4 accounts up that really started. It's really when I discovered charting in 78, where I kind of had a feel for what I wanted to be as a trader. And I think that's one of the key things. You got to figure out, who are you as a trader? What's a trade for you? What's not a trade for you? And for me, I developed the ways of looking at charts, trying to see things in charts, figuring out what a trade is for me. And so I kind of was a wild man and just took shots without thinking mathematically in a lot of years. It really wasn't until I had my worst losing year of all my years. I've had 4 losing years, Richard. And 2013 was the worst at minus 13%. My average losing year has been like maybe minus 600 basis points. But that was minus 13. But to make it worse, it was the longest peak to valley to new peak NAV drawdown that I had in my career. It ended up being 20 months. The bottom, the trough came, probably at 10th or 11th month. But it was after that I came to the point and said, I don't need the money. I think I'll just quit trading. So it was a decision. I'm either going to quit trading, or I'm going to try to figure out really what trading is all about. Even though I've been profitable all these years, I've supported myself, my family, and generated wealth trading. Finally, it's like I'm going to dig in and become obsessed with the metrics. And so 2014 is when all of that happened, and it was a pretty big transformation for me, even though I've been highly successful as a trader for decades.
What did you dig into that really changed things? Was it looking at how much you're risking per trade and kind of standardizing that? What big changes did you make after 2013?
I wanted to see if I could eliminate drawdown. And so that became a process. In the way I even measured drawdowns changed. Of course, it used to be you'd look at monthly rate of returns, and that's the way the CFTC would really ask a trader to look at drawdowns, peak to valley on a month-end basis, or you could look at it on a weekend basis, I suppose. I think the most dangerous thing traders can do is be obsessed over their account value day to day and interday, where they're looking every minute at, am I down, am I up, where am I? I don't want to trade my equity. I want to trade the markets. And so it's really then became a function for me to be looking through the lenses of these things. And I just found that the profit factor really had to be what I really keyed into. I think prior to that, rate of return. I was big on rate of return. I knew my drawdowns. I knew my rate of return. That's how I measured. I kind of knew my win rate, although I didn't used to really keep that up. I was conscious of it kind of, but I didn't keep it up. I think I ended up being kind of naturally good, but not naturally obsessed with data. And so that I found was, if I could really cut my losses, really take my losses seriously, where maybe my focus prior to that was on my winners, trying to find winners, all of a sudden, I really wanted to become the best loser in the business, or lose better than I'd ever lost before in a better way by exiting trades quickly. And then I just found that if I can get a profit factor of 3.0, if I can get a Kalmar of better than 2.5, I'd like a Kalmar of 3.0, and I can get a profit factor of 3.0 plus, then I can scale my trading as far as I want to scale it. And I can scale it without risk of big drawdowns. And so I measure my drawdowns peak to valley based on sequential closed trades. I trade a total nominal capital. Every trade I do has a basis points, has a rate of return. And so I keep a cum graph of that sequential closed trades. And my goal is to have my worst drawdown each year be 2%. I want to keep my drawdowns on the basis of how I look at drawdowns under 2%. This year, I think my worst drawdown so far is 110 basis points, something like that. And so my goal is to crank my Kalmar by cutting losses quickly, by allowing any trade that's a winner to have another day. So I do not believe in day trading. I think day trading is foolish. I think people who day trade are begging to be losers, although there are some that'll succeed. And so I hold positions overnight, over weekends, over 3-day weekends, sometimes for months, because if it's a winning trade and it keeps going my way, I want to keep going my way. So if I can find a way to take bigger profits, cut losers short, to have close to a 50% win rate, crank my Kalmar up to the 4 area, I'm going to have good numbers at the end of the year. Pretty much whether I like it or not, the other numbers are going to come in and give me really a right-handed outlier. I am looking for a bell curve distribution on. It could be basis points of each trade. It could be weekly profits or losses, monthly profits or losses. However I want to build that bell curve, I want to have a big right-handed outlier, and I want to have pretty much nothing on the left side of zero. So that's kind of how I think about my own trading anyway, Richard.
Yeah, that's excellent. And I want to dive a little deeper into how to become the best loser we can be, and maybe some guidelines for newer traders out there who are just starting to focus on risk management and focus on that aspect. Did you just lower the over amount of your portfolio that you're risking on each trade, or were you actually tightening up your stops to take those losses as quickly as possible? What was kind of your process there?
Well, going in, for years, I would not risk much more than 100 basis points, 1% of cap, total nominal cap.
1%. Right.
although in the early years, I'd crank that up to 3 or 4 or 5. It scares me sometimes when I think about some trades that I did
Yeah.
early on, the early 80s. But for the most part, during the 90s, 2000s, early 2010s, I was at 100 basis points. And then starting in 2014, really coming out of all of the math stuff, it was 170 to 80 basis points is my max risk. Of course, 0.7% or $7,000 on each $1 million of nominal capital. But I want to try to move my stop as quickly as possible so that I can bleed some of that risk out, even sometimes within hours of putting the trade on. But definitely by the end of day one, I want to start squeezing the risk out by tightening stops on at least half of the position or one tranche, and try to get to a break even on one tranche by the end of 1 week. And hopefully by the end of 2 weeks, try to be break even on the entire trade if I'm not already stopped out. In a lot of cases, I'm already out. I may be out 2-3 days after I put the trade on. As a matter of fact, that's not unusual. And so I have that maximum risk. And also, I will not take a loser home on a weekend. I just have a policy to look at my book on a Friday around noon, depending on what time zone I'm in, and say, if I've got to trade this a loser, I'm not going to take it home. I'm going to get out. And that's partially risk management. Trades that are losers on Fridays tend to be bigger losers the next week. But partially just a headspace deal. It's nice going home on a weekend, being able to go boating, being able to do whatever.
Yeah.
Knowing you're not worrying about where a market's going to open on Monday because you had a loser on a Friday.
And was it the research into kind of sequence of returns and doing those calculations that got you to lower kind of how much you're risking per trade from 1% to 0.7, 0.8%?
Yeah, Richard, I was lucky enough to have some friends who were really a lot smarter than me in terms of building models. Some people that really were some of the smartest people in the futures industry back in the 90s. I won't name the names, but they helped me on a cooperative basis build this Excel spreadsheet that's got like 500,000 cells with formulas. And so we can do a lot of playing what if this, what if that. And in the process of doing all of that what if, I just find that if I risk 70 basis points, I'll keep my sequential close trade draw down to 200 basis points a year. I could double my risk if I wanted to. And so, but over any shorter period of time, you never know how those numbers, again, probability only deals when you're dealing with the law, large numbers, the rule of law, large numbers. So, it's just, we know from modeling and also from actual results. I mean, I have results going back to 1981. I have statements going back to 1981. And so, I have a copy of every trade I've done now for the last 11 years, trade by trade by trade, day by day. So, we can model hypotheticals, but we can also then match that up against actuals and try to find out and play these what-if games to see. So I just personally, my personal tolerance is, as an older guy who's at the tail end of his career, it's not my goal to build my account. My goal is to try to be excellent at what I do, is trying to really feel like I'm on top of my game, like I am really, really good in all 12 aspects of my trading. And if I can do that, I'm not really worried about the numbers. I'm not worried about I don't trade for profit anymore. I trade for the challenge. I've not worried. I know if I meet the challenge, I'm going to have the profits. So.
Yeah, and if I remember correctly from that table you showed, your batting average is about a little bit over 50%, depending on the year. What's been kind of the largest sequence of losers in a row you've had, and how did that feel to go through that? Where I should be right every other trade, but I'm just wrong 10, maybe even 15 or more trades in a row.
Yeah, I mean, there are people, once in the first place, a trader's got to really pretty much trade the same way over and over again for a couple of years to get the data that will provide dependable probability.
Right.
But yeah, I mean, here's the deal. You would think if you're 50, how can you be wrong 8 trades in a row, let's say? If you're 50, if you have a 50% win rate, how is that even possible? Well, it's possible because I'm moving stops. And so it's almost as if I'm taking a trade by day 3 or 4, my risk reward on the trade all of a sudden is up to 7, 8, 9, 10 to 1. And so the probabilities are then that you're going to get stopped out of stuff, for me, small losers. And so 2023, I think it was, that I put on 21 trades, started in July 26th, I think, of 2023, that over a course of 21 trades, I was wrong in 19. Then I think I had winners, then I think I had 4 or 5 losers in a row. But I know you can, and I can look and say, hey, at a 50% win rate over 1,000 trades, now let's take a subsample of 100 trades and say, what's the probability you can have a 30% win rate over that 100 trades within a 2,000 trade sample? And then you can say, what's the probability at a 30% rate that you will have 9 out of 10 trades being a loser? How many times over the course of 5 years? With AI today, once a person has their metrics, you can do all kinds of things would then reassure you as a trader of process. You become assured of the way you're trading. I have no trust in my next trade, Richard. I have no clue whether the trade I put on yesterday and today is going to be a winner or loser. I don't really care. I have no problem betting against my biases. I may have a bias on corn as someone who traded corn fundamentally. I may be bearish, but I have no problem trading against my bias. And so I just trust process. I trust that if I keep doing what I'm going to do time in, time over, that the numbers will take care of themselves. So hopefully that answers your question.
I love that. I have no trust in my next trade. I have trust in my process. I think that sums it up really, really nicely. Kind of the key point that we want to emphasize here. I wanted to go back to discussing the metrics that I think a lot of people focus on. The Instagram ads where somebody's in front of a Lamborghini and they're promising a 95% win rate. Why does win rate not matter at all, Peter? What should traders really, especially newer at the game, understand about win rate to recognize that it's not really something you should be optimizing for?
Well, not optimizing for it. In the first place, I don't believe in optimization. I don't believe I think optimization is a myth. I think it's lunacy to even think in terms of optimization. But win rate is somewhat important because you start getting win rates down in the 20s and 30s, and some of the other numbers then that have to combine the whole kettle full of metrics become even more important. And so, but right. I think it's fair to say that most of the people that probably have been included in Jack Schwager's Market Wizard's books, 70-some traders, 50% is probably a pretty good shot. Guys that talk 90, 95, I don't trust that. I don't trust how they got there. They optimized up the wazoo and looked at a small n versus number and then said, look at this, I'm right 95% of the time. So somebody says that to me, I'm going to, if I have zippers on my pockets, I'm going to zip up my pockets. So, or wait for a pitch for swampland in Florida, because that would be coming next.
Yeah. I think a lot.
Yeah, go ahead. Sharp ratio. I don't like Sharp ratio. I think Sharp ratio is ridiculous. I have a terrible Sharp ratio because the Sharp ratio penalizes somebody with a right-handed outlier. When you get a bell curve with a big tail to the right side, you get penalized. Well, as a futures trader, that's exactly what I want to have. I want to be humped in the middle with a right-handed outlier, and that gives me performance that's consistent and also sufficient. But to Sharp, it's terrible. So I prefer Sterling ratio, which is somewhat similar to Sharp, but at least adjusts for risk-adjusted performance.
Yeah, I think thinking back, going back to batting average, going back to a lot of the traders I've talked to who are more growth stock trend followers, that's kind of their basic thing. Batting average of 40% overall, 45%, and then the best periods they get over 50%, 55%. That's kind of what's normal for them. But a lot of them just really focus on getting that average loss as small as they can and getting that average gain as high as they can to optimize for that. So that goes right along with what you're kind of focusing on as well.
Well, it is. And I just want to have, when I came in the business, if you weren't in the pit, you didn't day trade for the most part. There are a few exceptions, few and far between. I mean, if somebody talked about buying and selling the same commodity in the same day, you had a pretty good guess that they were standing somewhere in the pit. They were on the floor, and they were making their money from the bid-offer spread. They were not day trading as such for price. They were instantly buying at the bid, selling at the offer, making the market. And it's no one day traded, and I think that's symptomatic of kind of the craziness today of turning $200 into 10,000 in a month. Is this thing that you got to be day trading, you got to be looking at price all the time. I look at price for the most part. I enter orders. I limit pretty much the time I enter orders till after the markets close each day. So that's 5 p.m. New York time, as I'll scroll through the trades I'm in, through the markets at which I have orders to enter, see if anything's have changed. I will look at markets from time to time when I'm in the office and I'm looking at emails or writing a letter. I'll see what markets are doing from time to time, only because I'm interested in maybe looking at a different way to look at a chart for a different idea on how to tighten my risk. But I don't look at charts during the day to select trades. That to me would be ridiculous. I think day traders have the odds stacked against them from the very beginning. Is a trader who wants to learn how to trade is much better off learning how to trade as a swing trader or a position trader than as a day trader. So that's my word on that, I guess.
Yeah, watching the ticks during the day doesn't help your stock move any higher when you wanted to, and you get to watch the Tour de France, which is a lot more fun and more productive. It prevents you from doing something you shouldn't be doing and going against your rules. And Peter, I actually wanted to talk a little bit about how you place trades outside of market hours. How do you feel like that helps you be a little bit more objective and be a little bit more rules-based, disciplined? Because when you're placing it during the market hours, again, everything's moving. There's a lot of noise, a lot of stuff that can take away your focus. When did you start placing trades outside of market hours, and how did that impact your trading?
Well, I think from the very beginning. I'd never really been a day trader. I'd never sought out to say, I'm going to find a day trade today. I mean, from the very beginning, I was willing to hold positions for days, weeks. And so for me, I don't want to be caught up in what I call the blinks. I don't want to be looking at markets, seeing all of the blinks going on, prices change, and be drawn into the drama. That's a great way to FOMO out a trade. You start looking at prices trade, all of a sudden you start looking for a trade. And I don't want to look for trades. I want trades to find me. And so for me, it's just a matter of following during the week a select number of markets, because I only look at 60 markets. And I do that on Fridays. I start on Friday at about noon, and I scroll through a list of all of the futures markets that I trade, because I'm a futures trader. And so I start with weekly charts, and I'll scroll through those weekly charts to see what catches my eye. And obviously those that catch my eye immediately will be those that I have trades in, I have open positions on. But then what else? And so by the end of Friday, I end up with a list of 8 markets, maybe 7 markets, 6 markets. And those are the markets in which I have trades, and as well as maybe some trades that I'm interested in. I came in this week with orders to buy Bitcoin. I came in with orders to buy Euro stocks, banked futures, and those were the trades that I was looking to put on. I had 3 or 4 trades I was carrying with me. And so then come Sunday, I do my open orders. I trade with GTC open orders. So when I change an order during the week, it's oftentimes just to bleed risk out on trades I'm holding, or maybe to tweak the way I'm going to get into a trade. Is to maybe get into a trade with a little bit better edge coming in so that I can even bleed the risk out of the trade from the time I take it. So that's kind of how I survey the market. So for me, it's just I want to see where markets are at the end of the day when I can completely draw the bar for the day. And so I draw my bar, and then it's just a question of, is there anything on this chart with today's bar drawn in that makes me want to change an order that I have sitting in the markets? Or based on the rules and guidelines that I have, that needs to then dictate the process. So I don't like having to make decisions on markets during the day. I like to be an order placer. And I like to think of myself as that's what I do for a living. I place orders that make sense based on classical charts. And if I can place enough orders during the course of the year that when I look at a chart a year after the fact, and I can look at a chart, blow it up, stick it on a wall, and look at a chart from 10 feet away and say, where were the 3 or 4 places on that chart where I hope that I took action? I want to then be able to go into my book and say, I was at least at a 70% there, 80% there. I'm never going to be 100% there, because I'll see some trades that maybe really after the fact weren't that good at trades. Maybe I'm jumping the gun a little bit, or I'll miss some trades. That'll happen too. So, but I want to get close. And so those are all the things that during the course of the day, when I'm thinking about trades, the things we're talking about right now are the things that go through my mind. These are the things the very things we're talking about, Richard, are the things I obsess over. Is thinking through all of the processes. Am I true to the process? Am I being unbiased? Where are my emotions? How am I doing on different aspects of analysis and so forth? Rather than, well, should I buy soybeans today? Well, what about S&P? Is there a trade for me today? Those are not decisions that I want to be dealing with on a day-to-day, and especially on an hour-by-hour or minute-by-minute basis. I think that's a waste of brain energy.
And is that part of your annual review process, is to look back on the markets that you trade over the past year and say, all right, this is a buy point that I hope I would trade. How did I actually execute in real time? What were my thoughts in real time there? If I didn't place a trade, why didn't I? Is that stuff that you look at as well? That seems pretty helpful.
No, I mean, I'm aware of it. I'm always kind of, that's lurking in my mind. It's not, those are not data points I'm looking at. Partially because it's awful easy to second guess a trade after the fact. I probably could count on 2 hands the number of trades over 50 years that I could say those were perfect. That just nailed everything. And so I think one of the characteristics that a good trader needs to have is self-forgiveness. Because you're going to screw up. There's seldom a trade where I'll say I did that one just the way I should have. Or put another way, there's not a trade I do that looking back after the fact I would have said I could have optimized it in a little different way, because that's always true. And so I don't really look at that per se. What I might look at is what's my holding period on winning trades? How does that compare? Am I pulling the gun too early? Is, all of a sudden, if my holding period on winning trades 1 year is 18 days and the next year it's 8 days, I need to have a general awareness of what kind of markets gave me that. And so I'm always kind of aware of I'm doing it the way I want to be doing it. That I'm comfortable, that I'm in my groove, right? That I found my niche and I fully explored my niche and I'm in my niche. And so I'm always aware of that. But those are not specific things at the end of the year that I look at. Nor do I journal. I don't really journal either.
Gotcha. And going back to what you said about your routine, going through the weekly charts to identify the chart patterns, what are you looking for on those weeklies that would really get you interested? And is it almost is a big part of that where you think you can manage risks tightly and logically, where you would get out if you were wrong if you do place a trade.
Yeah, well, I'm very aware of that. Yeah, absolutely. I mean, there may be a trade I really like, but if I don't have a good place to put a stop that makes sense, I may bypass the trade. I may skip it, or at least downsize it so much that it hardly even matters. But, I'm a classical chartist. I'm Edwards and McGee. Go back to Schaubacher, 1933, Edwards and McGee, 1948, some pieces of William O'Neill. And so I'm looking, I prefer continuation patterns as opposed to reversal patterns. I like charts that, for me, a sweet spot would be an ascending triangle, descending triangle, rectangle, tight head and shoulders, pennants, in straight line moves, patterns that are between 6 weeks and 16 weeks, that are parallel. That I don't like diagonal patterns. I like horizontal patterns, not diagonal patterns. I don't like trend lines. I don't like wedges. I think they fail too often, and I think they're suckers bats. I mean, hey, there's some guys that trade trend lines that are wonderful traders. I'm not taking anything away from them. That's their groove, and they've figured out their groove. But for me, I just like, Darvas boxes is another way. And sometimes I'll explain or describe a pennant. So, I'm looking for breakouts. I don't trade patterns within patterns. I wait for breakouts. I trade ATR breakouts that are adjusted for the length of the pattern. And when I put an order in on a Sunday, for instance, I put orders in on a Sunday to go long Euro stocks, bank futures in Europe. And so I've got a buy stop above the market, but then I'll attach to that the sell stop that will automatically go in place. You might call it a one if. I think like IBKR calls it one if for an attached order. So I've got a buy stop going in. I attach a sell stop to that, and I put in alerts. And so on 2 different platforms, so that every order that might fill for me or price I might not want to know about, I'm going to get a text message, I'm going to get an email, and I'm going to have a computer that makes noise, so I shut it off. And I'm getting it by different iOS devices and PCs with contingencies, backups for entering orders. I never want to be in a position where I'm restricted to one way to enter an order. I always want to have ways to change orders. So that pretty much describes the kind of pattern I'm looking to get into. And those don't happen a lot. People might be surprised to know that, if I trade a given market 3-4 times a year, that's a lot for me. If I traded gold probably 4 or 5 times last year. That's a lot of times for me to trade the same market, because really there's not that many really good patterns for me.
Could you explain a little bit more the ATR breakout, just to clarify kind of that terminology?
Yeah, average to range. And so, if I'm looking at a pattern, I was looking at a pattern I'm looking at a pattern in gold right now, for instance. I'll look over to the other screen. Sorry if I look away, but it goes back to April of this year. So we got a pattern in gold that's April. And so we're April, May, June, July. So we're 3 months, 10 weeks, 13 weeks. So I know from day to day what I use a 30-day ATR. So I know the average true range over the last 30 days. And so I want to see an important point, let's say in the case of a rectangle for an upside breakout. I know the point at which I will consider to be, it's the breakout point, but I want to go past that breakout point. And I want to go past that breakout point by an adjusted ATR, meaning if I'm dealing with a 6-week flag, I don't need that to break out by a full ATR. If I'm, a breakout of a 6-week flag is going to be different than a 6-month head and shoulders. So the leeway upon which I need to see a breakout is going to change. I've got a graph. I can generate that number. That's a number I can generate very, very quickly. I just put in number of weeks in the pattern. I put in what my ATR is, where my important high point is, and it'll say here's and generally speaking, where your order is going to go in. And so that's how I adjust ATR. I don't use ATRs for trailing stops. I know that's popular among some people. I see people all the time talk about they protect stops with ATR. I don't do that. That's really not something I've ever really dug into that much. I prefer to find stops in other ways. But so that I use ATR when I get into a trade.
Do you trail your stop at the higher low that's, a little bit before? What's kind of your process for moving up your stop incrementally as a trade goes in your favor?
Well, I mean, I know when a trade has not completed, because at the end of the day, we still haven't broken out. So
Yep.
I know at the end of a day that I can make the statement that if I've identified a possible pattern and I know what today's bar is, and today's bar is within the range, and I'm looking for an upside breakout, I know then if I use today's low as my stop, I'm using the low of the last full day in the pattern. And so what I'm looking for is what bar is the last full bar within a pattern prior to a breakout. And I will use that low in the case of a long position, that high in the case of a short position, to set my initial stop. That's kind of my what if, my contingency stop. I'm filled on the trade. Where does that initial stop go? And so that's my starting point. And I know some great traders that don't play it that tightly, that, they may be looking at head and shoulders, a bottom pattern, and they're going to use the low of the right shoulder. And there's some great traders. Bruce Kovner is one guy that was with a trader also with me, Commodities Corp, back in the 80s, 90s. Bruce Kovner, one of the best traders, I think, that has been alive in my generation. He would give the market to say, I want to see this pattern absolutely fail. But in the process of doing that, you got to cut your size down. If I'm going to give head and shoulders bottom to the right shoulder low, as opposed to the last full day in the pattern, I may cut my sizing in doing so by 70%. And so
Right.
what happens is I dramatically change my risk-reward relationship. And so, you're always playing off of that. So, I kind of want to make the market prove I'm wrong, but I don't want to make it prove I'm that wrong. So I try to use kind of that last day within a pattern before we break out.
And say you're using that low, and maybe the breakout, that close of that day is at 100 and that low is at 95. And could you maybe walk us through a hypothetical process of how much you would size that, given your risk profile?
Yeah, I mean, you're saying I'm buying a market at 100, risking a 95.
Yeah.
Okay, so I'm risking 5. I'm risking 5 points. Let's say that's, I don't know, whatever, 5, how many zeros you want to add. But I'm risking 5 points there. Well, I don't do risk-reward ratios. Some people I will say I don't ever want to take a trade that's under a 3-to-1 risk-reward relationship. I don't really care about that. I care more about, do I have an opportunity to move my stop quickly, and I'll let the market go where it's going to go. And so I will say, okay, that's 5. And let's say I'm willing to risk $7,000 per million. And so I've got $7,000 per million as my risk. I divide it by 5, and it'll give me a figure of, what is that, 1,500 shares, or whatever the math works out to be. So I know my sizing. And so that's how I always determine my size. It's where I get in versus where I get out, relative to 70 or 80 basis points, and it gives me the number of contracts that I'll trade in the futures markets. Now, sometimes because futures are not as flexible as stocks, if you're dealing with 100 ounce contract of gold, sometimes you end up in between. And so you have to make adjustments, and sometimes I'll do that with micro contracts where I'll balance out a position with full contracts and then use micros to zero in on that 70, 80 basis point risk trade. So But and so that's how I figure out nice sizing. I size all trades pretty much the same. I don't say, well, I like this trade more, so I'm going to risk 110 basis points, and I like this trade less, so I'm going to risk 30 basis points. I just go in and say I'm going to figure out what a 70 basis point trade is based on where I'm going to likely get in, where I'd likely get out if I'm wrong right away, and then figure out my sizing and go from there.
What do you think are some common sizing mistakes that you see traders nowadays making that can lead to risk of ruin later down the road if there is a sequence of returns that really gets skewed outside an outlier sequence of returns of negative losers?
Yeah, I mean, pyramiding is a big one. Well, I mean, I'll back up. It's just putting too much on at once.
Yep.
It's they just go in way too heavy. They think 70 basis points, really? You're risking 70, $7,000 for $1 million account. That's pretty skinny, isn't it? Well, so they'll double that up. And I know the numbers. I know probability numbers enough to know that, I could get up to 200 basis points, maybe squeeze 220, and I'd be okay. But if you're a trader that does not have a Kelmar of, I'm going to make up some numbers here, and I'd have to actually crunch them to see if what I'm going to say is right. So this is just as an example. If I've got a 2-year profit factor of 1.5 and I have a Kelmar of 1, and all of a sudden I start risking through 400 basis points on the trade, I'm setting myself up for a huge owie. And, the risk of ruin starts adding up pretty quickly. So it's putting too much on. And then it's pyramiding. I'm not a believer in pyramiding. Now, I know some people who are wonderful pyramiders. Some of the best traders I know are skillful at pyramiding. But I think putting on a pyramid position is more challenging than putting on an initial position. It takes a different skill, not necessarily more skill. It just takes more refinement in one area of trading. But what happens is when you pyramid a position, in effect, you've had adversely given yourself an average entry point. And so it's going to take less of a correction to all of a sudden take you to break even on a trade. So I am not a biggie. For the most part, my biggest position is when I put it on, and from there on out, I get smaller. There may be occasions in which I add, but it's going to be adding because I see something entirely different on a chart with its own risk-reward profile that's separate from an initial risk-reward profile.
Right.
I did that in gold sometimes. I've done that in treasuries in the last few years. So I think those are the big dangers. And I think another big danger is, that they jump. They're looking at trades. They're bullish a market. They buy it. They're bullish a market, don't do anything. And then they see it rallying strong, and then they buy it. And then they blow out in the first setback. And then they buy the new highs. Then they blow out again. And they end up being right on the trade, but they lose money. So,
right.
But I think sizing, getting too big. I see what people are talking about in terms of sizing, and it's unbelievable to me. I mean, if I put on a NASDAQ position in Q, it might be 1, maybe 2 per million. And I see guys trading 5 NASDAQ for $50,000. Well, good luck with that one. Which, by the way, I don't mind at all as long as they're trading real markets, because we always need new money on the table.
Yeah, and one thing I wanted to ask you, Peter, is obviously you've supported yourself for quite some time trading by itself. How did you handle the pressure of needing to perform, or needing to make money, to put food on the table, help your kids, all that stuff?
I didn't start trading until I had what I felt was close to 2 years of family expenses in the bank, separate from my trading. Yeah. I didn't count it as my trading. That's why I tell people today, you want to quit your job as an engineer, you've been hooked on trading, here are my rules for you. All the money in your account has to equal profits. We're not talking about, a trust fund, wife that's a neurosurgeon and can support you. Yeah, you're taking a loan against your house. We're targeting real profits. Your account has to be real profits. You've made them. Unless you've made them, you haven't proven yourself enough, in my opinion, to take the risk of quitting your day job. And so you have to have 2 years with the family expenses in the bank. It's not part of your trading capital. You have to expect to be a loser the first year, and then you have to figure out what's a reasonable rate of return. Reasonable, not crazy, reasonable. Keeping in mind that people that have a 40% annual rate of return long term are among the best in the world. I mean, we're talking about the Stan Druckenmillers here, the George Soroses, the Bruce Kolbners as an independent trader, the Paul Tudor Jones. None of this 10x stuff exists in the real world among long-term career traders. So put that out of your mind. And so let's say you think you can do 25%, 30% a year trading equities. And then you just figure out how much money do you want to either take out of the market, or a combination of take out of the market and grow your account by per year. And you'll kind of know how much you have to have in your account. You don't go in with $100,000 account and expect to make $100,000 a year perpetually. You got to be realistic about that. And and I would add to that you have to have traded the same way you plan to trade for at least 2 years, and be able to generate some AI statistics that give you comfort that you can trust your process.
And you, during your career, you took money, on a consistent basis out of your account. Is that correct?
Yeah, I mean, the early years, no. I mean, the early years, I started with 88,000 in 1981. I mean, I don't know what that equals today, but it wasn't enough. I mean, it wasn't in 1981. It wasn't where guys who considered themselves to be prop houses or prop traders, independent traders. I'm talking independent, not newfangled prop, which means nothing. I mean, independent traders. I figured back then you really need $500,000 to $1 million to say, okay, I'm in the game now. And so you translate that to wherever it is today in today's buying power. And so my goal in the early years was to grow my account. I wanted to grow my account in the early years, and that included finding some income elsewhere and even adding to my account. So I added. The first few years I did nothing but make deposits. And then it was pretty much, hey, this is my job. I went into trading with the idea of, you want to maybe get rich, whatever that means to you. But I wanted to be a career trader. I wanted to make trading my career. I thought it would be really, really a cool job to have. Yep. And it has been for me. Here I'm still doing it, and I'm doing it because I love it. But and so then you obviously got to start wiring money to yourself every month, because that is your source of income, and that's been the case for me. So I've been a net withdrawer ever since probably 1987 maybe, up until 87, pretty much the minimum amount of withdrawals. But then after 87, I started withdrawing money and to fund other things, real estate and so forth.
Yeah, so do you have a long-term account too, or how do you kind of diversify your capital?
No, I mean, we got the company as a pension account. I have real estate holdings, 4 different real estate holdings. And, my account was much bigger. I mean, my account's not the biggest it's ever been. I have kind of a maintenance account it's my retirement, keep me busy. Let me have fun. And so I have money in equities that's I'm passive. I'm the passive guy in. I've got money managers. I'm into some funds. I'm into some private deals. And, I probably should have kept it all in futures and parlayed it, because that's where my performance has been the best. But I was one of those guys that felt like, golly, I'm making it in this risky business. I better take some out because it's a risky business. Well, as it ended up for me, it's the calmest money that I have within my net worth is the amount of money that I have in a futures account. Even though it's the largest chunk, it's the calmest because of the way I manage risk. I have more volatility in Bitcoin holdings than, and of course, real estate. It's horrendous to get out of real estate positions. But Yeah. So for me, trading is really, it's not anymore about me, quote unquote, adding to a bottom line. Although I definitely want to each year be as profitable as I can, but I'm in it for the challenge now of, how much risk can I really bleed out of a trade, and how can I find the best 15 trades in the next year? What are they going to look like? So that's kind of my focus.
And it is a challenge. There's always something slightly new to learn and improve on. And I'd be curious to hear from your perspective, what was the most recent rule change that you implemented, and what was the reason why you tweaked it,
Um,
if one
there's
comes to
always,
mind?
yeah, there's always tweaking. I think the most recent rule change was that if I had a pennant pattern that was less than 12 weeks, although that's arbitrary. I mean, it's a judgment call, and it comes after a really straight line move. That instead of doing a 1x target, I'll do a 2x target. In other words, width of the pattern projected from the breakout is I'd go
Mhm.
2x instead of 1x. And I did that last year. And also, I added a tranche in January 2024. I took my daily rules and applied them to a weekly chart, and am now trading a tranche on very selected trades based on the application of daily rules to a weekly chart. And
Mhm.
that's now in some cases an additional tranche in a trade that for those trades might take me up then to 120, 130 basis points in those instances, because I've added an additional tranche that to trade a weekly chart pattern that I think might have tremendous carry through. And on those trades, I manage them based on kind of more traditional trend following, moving
Yeah.
averages type thing is how I manage those trades. And those trades have outperformed my average of basis point profit of all profitable trades, which is interesting. But, hey, I'm less than, I'm 1 year into that experiment. So I'll have more information at the end of another 6 months.
Awesome. And you mentioned, using AI to help with the Pareto principle analysis and analyzing your trades. Are there specific prompts that you like to use, or is it more just uploading a spreadsheet of your data and say, hey, calculate X, here's the formula, here's what to do. Is there any? Yeah,
It knows all the formula. It knows the formula
yeah.
better than I do. No, I literally will take one column on a spreadsheet that I ended up with, which is
Hmm.
the master spreadsheet. That then, I have three or four other spreadsheets that are created in the same file, for which, I'll stack and deck and rearrange. But it's once I get the one that I want, that's the sequential closed trade NAV. That's the RORs that go into that number. I will just copy paste that column on a spreadsheet. I could even copy paste that column on a spreadsheet onto a Word document, and then do a copy all and plug that into it. And usually I try to look at Grok, and I also try to look at Chat GPT, and I just put them in and say, these are the trading results trade by trade of a commodity futures account. You know, let me see all the numbers you can get. And sometimes it'll
Yeah.
come out and it won't give me something. I might want a kurtosis number, or I may want something on skewness. All right, once I get skewness and I say, okay, at that skewness of 6, tell me about that. AI is pretty good at that. It'll go through and
Yeah.
say, at this kurtosis and skewness, here are the implications of that. Here are some things you need to be aware of. And so AI has been remarkable. I use AI all the time to take these numbers and have my own numbers be interpreted to myself. And sometimes it gives me a little bit better understanding of ways that I should have understood numbers for a long time but didn't. So AI has been a teacher to me. So I've appreciated the capability that AI has been given to me to be able to quickly take a look at performance numbers and try to extract some practical information from that.
It's really cool to be able to talk to your data, and like you said, it can give you a new perspective on things, and see things from a different light, almost having like a research buddy who can give a fresh take on things. Is there a difference you found between Grok or ChatGPT, or do they usually give similar results?
I think yeah, it's sometimes one will give a shorter response than the other, and then it gets reversed with another question. I think I trust ChatGPT more, and I have the ability to more categorize and group requests in ChatGPT than in Grok. I mean, they're both good. It's just if I'm on Twitter, I've got Grok right there, and I can do it real quickly. So, but I mean, I think they're both. What's interesting to me, Richard, is I can ask my own what Peter Brandt thinks, and I'll do that every once in a while, and I'll say, here's the deal. What would Peter Brandt say about something like that? And I'm amazed. I'm just simply amazed at the answers I get. I don't always agree with what the answers it gives me. I would say, well, yeah, I'm not sure that's really what I think. I mean, it's often conditional acceptance, but I'm amazed at the level of detail that it'll go through on just what I talked to you about, the last day rule, right? That last full day bar is, and somebody every once in a while will send me an email saying, here, I asked Grok a question about you, and, here's a 2-page response. And I go, whoa, it's crazy. It's crazy what AI does.
Yeah, it'd be cool to, you've given quite a few podcast appearances. You could take those transcripts, download them, create like a Peter Brandt model, upload that, and then that might be even more refined than just the native thing. There's all sorts of cool things you can do with AI. That I think there's a lot of potential there to help you improve your trading and be a coach that can work with you. I think it's cool.
Well, and we're planning to. That is something that I'm trying to hang on until I kind of fully go out to pasture, which is kind of what my staff is encouraging me to do. I think only because they have their own ideas on how to do a company, which are good ideas, but is going to take everything. I mean, I've pretty much written up every trade I've ever done. I mean, I write them up for myself. And so I've got this stuff going back to I think I started writing up trades in 1978, 1979. I have thousands and thousands of pages and hundreds of hours of interviews and stuff. And our plan is to have that on an AI that gets gate-walled. It's intellectual property. As I retire, this is intellectual property that I can hand to people who will want to continue to help traders as we've done that. And so that is the plan, to have a Peter Brandt AI that has most of the material that, what AI has on right now is probably 10% of stuff that I have is the fully loaded. So I think that'll be beneficial to even my staff, is, let's say the day in which I'm not involved in markets at all, is at least some of the ideas I have, while some of them are not so great, at least they're there and available.
Yeah, no, perfect. Peter, this has been a lot of fun. Just a few wrap-up questions here. You've touched on this a little bit, but what advice do you wish that newer traders starting out would take more seriously when it comes to risk management, position sizing, bet sizing, that aspect of risk management as a whole?
I got to have realistic expectations. I think that's one of the big problems that these young traders have, is they see these guys on Twitter that, all of a sudden they're making thousands of dollars a day. That's not helpful. That's not helpful at all. People have to have realistic expectations about what they do. They have to know that it's going to take 3 to 5 years to really even have a scent, pick up the scent, the smell of how you probably will end up being the things you want to start employing as the way you trade. And, I remember the old guys. When I joined the Board of Trade, we had guys that were, they were on Omaha Beach in World War II, and they were still in their 50s. And, all these old guys would say, cut your losses short, let your winners run. And I think young guys kind of go, yeah, that's great. Yeah, I hear you. Wonderful idea. Let your winner, cut your losses short. We'll let your winners run. We give lip service to it without really wanting to really completely understand it. And now that I know the math, I wish I'd have dug into those guys back then. They were willing to share wisdom out. I would have said, unpack that for me. really, really unpack that for me, really explore that for me. And I think that would have given me, that would have cut 5 years maybe out of the process if I would have really had an understanding of the math behind trading early on. I don't think it would have had, I don't know, end of day, bottom line, over time, what difference it would have made. But I think it would have made it more enjoyable for sure. And I think I would have had less volatility than I had. I mean, 50%, 60% drawdowns inter-month, those are not fun, and I've had, on month to month, I've had 3 drawdowns close to 40%, and that's month end. That's not inter-day or day to day. And so those aren't fun. I mean, drawdowns are fun. And if there was a way that I could have managed drawdowns better, which means managed losers better early on, I think it would have made the last 50 years more enjoyable. It might have made it more profitable. It probably would have, but it would have definitely made it more enjoyable.
A smoother ride, yeah. Yeah. Just curious, before we call it, who are the biggest mentors for you in your trading? Who really helped you out and set you on the right path?
There were a couple of guys at the board of trade, and they passed. I don't have approval from their families to use their names. I'd love to, but there was a trader from Cargill, and there was a trader from a Merck firm, R.G. O'Brien, and these guys. They mentored me on risk. They mentored me not on trades. I don't really think they ever said, well, back then we didn't have stochastics and all that stuff. So it wasn't like, well, you need to optimize your moving averages, because we didn't have all of those metrics back in the 70s. But it was common sense. It was wisdom, trading wisdom, understanding yourself. I think it was really a preparation to know that you are your own worst enemy, and you who you are, Peter Brandt, will attempt to sabotage yourself at every turn. You need to be aware of the fact that you are your worst sabotager, and you need to figure out ways to prevent the sabotage. And it's he who manages self manages best. You got to manage yourself first. And so I think these were guys that really helped me understand the human aspects of trading, the philosophical aspects of trading, not some, use this moving average or this pattern works better than that pattern or whatever. They never talked to me about that stuff. I'd get together meetings with market wizards from time to time. That kind of stuff's never talked about. What do you think of RSI, or what length moving average you use? I've really never heard guys that I consider to be my peers ever talk about that stuff, because I think they've gone deeper in their trading and they talk about things that matter more, and that is trading as a deep dive into the human soul. And that's really what I would encourage people who are just starting down the road to, is look at it as a marathon. This is an endurance sport. This is a Tour de France of trading, and here we are.
Peter, always a pleasure talking with you. Thank you so much for your time. Are there any other resources or websites that you'd encourage people to point people to if they want to learn more from you or learn more about your style?
I think your book, you always promote your book. I endorsed your book. I think it's a textbook. It's a textbook. Stay away from how-to books. I don't think how-to books are really very beneficial. Not that a trader may not pick up this tip or that tip that they might build into their own process. But I think seeking out how somebody else's trade is unimportant. Don't try to copy somebody's trading. It never works. It'll never work. I don't know two people that I consider peers that trade the same way. There's no two Richard Dennis turtles that ended up trading the same way. They all went their own way. And so you got to say, how do I trade that's me? What does that look like for me to be a trader? And then what does it look like for me to solve all of the problems and challenges to get there?
Excellent. Well, Peter, thanks again so much for your time. Appreciate it. To everybody watching, hope you enjoyed as well. Make sure to leave a like down below if you enjoyed. Subscribe if you're new to the channel, and we'll be right back. Stay tuned. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Matt Kenah, also known as Pax Trader. He's a seasoned futures trader who first got started on the CME in the 90s. He's also the founder of the Pax Group, where he shares his experience and teaches his signature opening range breakout methodology. Pax, thank you so much for your time. Really looking forward to talking with you, and great to have you. Welcome.
Richard, thank you for having me. I know we talked about doing it last year, but I ended up in the hospital with some heart issues, but this year's all good. Thank you.
Yeah, well, it's great to have you. Thanks for taking the time. To start with, for people who aren't familiar with you and your background, do you mind telling us the story of how you first got interested in the markets and how you got started on the CME? That would be great.
Oh, I think my story is a little bit more of a typical kind of a Chicago, South Side Chicago kind of a neighborhood story. I was driving a truck for my uncle after high school, and my dad thought I was going to school, and when he found out that I wasn't, he told me that I needed to figure something out. And so, become a cop or a fireman or, otherwise work for the city of Chicago in some way. And I didn't want to do that, or become a tradesman. I didn't want to do that. There was a guy in my neighborhood named Pat Finley, Pat Geronda. His name was Pat Finley. It's now Pat Geronda, who was a neighborhood knockaround guy like I was, but had gone to the SIBO, the Chicago Board of Options, and the Board of Trade. Started at the Board of Trade, ended up at the SIBO. And in his early 20s was a multimillionaire and a huge donor to the inner city high school that I went to. And so, when my father told me I needed to figure something out, I figured, well, you know what, I'll go do what he did. So I got a job as a runner on the floor of the Chicago Mercantile Exchange, 1988, in January of 88, right after the crash of 87. The markets were a little quiet because the crash had happened just a few months before that. And it was the beginning of the year. But even still, when I walked onto the trading floor, the energy there was unbelievable. And, I decided pretty quickly. I was nervous, I was scared, and I didn't know anybody. I didn't know one soul on that floor, not one person in that business. I didn't have any rich uncles. I didn't have any rich cousins, and I didn't know anybody in that business whatsoever. But I knew that whatever was going down on that floor, that I found my home, that whatever it is, I'm going to figure this out and I'm going to be better at it than everybody else. So, because I didn't have any money behind me, I had to earn my way. So, it's like the minor leagues in baseball. Start off in rookie ball and, you work your way up to class A and, all the way up, and that's what I did. I learned how to hold a deck, which means that, the paper orders that a runner would bring, sell 5, June lumber at, the price, and they give it to me and I'd run the order. So, eventually I learned, I learned how to do that because the lumber, where I ran orders to, best kept secret in this business though, was the lumber pit. They needed a deck holder. So the guy offered me a job. I went from minimum wage as a runner, $89 a week after taxes, to $150 a week in cash, holding a deck and lumber. Man, that was big money. And I was still driving a truck at night. So I was able to make ends meet that way. And I worked hard. I worked 7 days a week driving a truck and 5 days a week from 9 until 1, holding a deck in the lumber pit. And then I learned hand signals. We called it arbitrage. And that's the same thing. You start off with a decent job and you work your way up. Reputation. So you show up every day, you work hard every day, you don't come in hungover, you don't party, you show people that you can take in a lot of information and act decisively on it and retain it quickly, and you'll move up quickly through the ranks. And I did. I think I started working for the Ojo Manini Chicago Futures Group in late 88, going into 89. And I did exceedingly well there. It's $750 a week, and now I am off to the races. I'm rich. I lived at home, at $750 a week in 1989. It was big money. And then I got hired. Everybody wanted to work. I was in the Eurodollar pit at the time, which is now SOFR. Everybody wanted to work for two main groups. One was SRG Financial, and the other one was on the other side of the pit, named his badge was Derby. Those guys paid a lot of money, and not only did they pay a lot of money, but they would put new traders into the pit. So again, I had no rich uncle and nobody with money, so I needed to earn my way in. There were 3,000 clerks on the floor, and I wanted to stand out. I wanted to be better and different than them. So again, not partying, not coming in hungover. My mother had breast cancer surgery, and I was at work, and the guy that I worked for, Steve Mendez, I got a job with Steve, and Steve asked me, "Why are you here?" And I said, "Well, I'm not a doctor. This is what I do. I can help my mother best by being at work and doing the best that I can." So I was hired on an interim basis with SRG Financial. They went through 3 or 4 clerks, but I bet on myself. It's the first time that I really gambled on myself. I quit a steady $750 a week job for a $1,000 a week job that, they could have, on a probation period, they could have fired me at any time.
Right.
And it was stressful. It was hard. I thought I was going to get fired, but I worked my way in, and they liked me, and they hired me. And eventually, or they hired me for good. And eventually, with a 3.5-year break, I took 3.5 years off in my early 20s to study to be a Catholic priest. Celibacy was not. I'm married with 20 years and 5 kids, and I was previously. I've got 2 kids from my first marriage. I was married in 1997 and 2 kids, and then married again in 2004 with 3 kids there. So total of 5. Celibacy wasn't my thing. But I went to the seminary, and it was a great time. I had a great education. I learned a lot about myself and the world spiritually, and learned how to take care of myself in a spiritual sense and in an intellectual sense for the first time in my life. And I brought that back to the Merc. My work ethic, the way that my brain worked, and, I really kind of did, like, everything on the floor just made sense. And then my newfound intellectual curiosity and my spiritual health. And I was able to really succeed at that point, So I went back to work for SRG Financial, and he ended up backing me in 1998, late 97, early 98, to trade for myself. So I got my seat, what we called a seat, my membership on the exchange. And I didn't want to trade the S&P futures because it was already an established pit, and I'd be in the middle of it. Everybody had their relationships and things, or Eurodollars were changing a little bit, and I didn't want to do that. So the NASDAQ futures was a new pit. Started in 96. The day I got my seat, I walked into the NASDAQ futures, and it was, maybe 5,000 contracts a day. On a busy day, we did 5,000 contracts. Open interest was just a couple of thousand contracts. There were maybe 20 people, 30 people in there, including the order fillers. And I went in there and started to trade one lots. And, and I worked my way up from there.
And what were the pits like? I've never experienced them. I've heard stories, all of that. But what was the kind of atmosphere and feeling around everything that was going on?
It was great. It was. I don't even know how to explain it in a short way. We human beings controlled everything. We
Right.
made. This is before, like 2003 is when a lot of the volume had,
computers.
right. When AI, we talked about this the other day, when AI began to change everything. But But before that, when I started, I only caught like three and a half really, really good years before that happened. But man alive, it was unbelievable to be able to have human beings control order flow and create order flow, paint the tape, and move markets was great. Talk about auction theory, right? And even game theory, but so many things went into it. I had to. So the Nasdaq, I grew as the Nasdaq grew, I grew.
Right.
I went from 1 lots and 2 lots to 4 lots to 5 lots, 5 lots to 10 lots, and 10 lots to 20 lots, and then to 100 lots pretty quickly. Quickly meaning within a year, 2 years. The volume grew, open interest grew, volume grew, volatility grew with the advent of the tech bubble. So the more that went on, and the better I developed my trading process, my trading strategy, I traded bigger. So we move the market. If how do I say this? If it was even offer, and I wanted to be long, the best advice I'd ever been given as a trader was from this guy Edmund Mercatician, emo, who was a bully. He was mean and nasty until you earned his respect. He was a New York crude trader that came to Chicago to trade NAS, and he sat down after I stood up for myself and tried to rip his larynx out of his throat and beat him with it. He sat down on the next to me on the train and apologized, and we talked. And he said, "Listen, if you think the market's going higher, don't worry about what the banks are doing. Don't worry about what the firms are doing. Don't worry about what the funds are doing, and don't worry about what we're doing, big traders. If you think the market's going higher, get long. If you're wrong, get out. If you're right, learn how to add to them. Stay out of the way of the market, learn how to add. Conversely, if you think the market's going lower, don't worry about any of that other stuff. Get short. If you're wrong, get out. Stay out of the way of the market, learn how to add to them." That was the best advice that ever been given. So if it was even offer and I wanted to be long, I bought the evens. You didn't join the bid in the NASDAQ because we moved so quickly. So I bought the evens, and then I would have to hope that other traders came in behind me to buy the rest of the evens, so we would go even bid.
Right.
Until I became a big trader, and I said, buy the evens, even bid, 05 bid. Now what are you going to do? So it was exciting and fun, and it was stressful. It was tense. It was a hard life. The NASDAQ, after the tech bubble burst, we had 200-300 point ranges every single day. We'd break 300 points, rally 200 points. And, so the things that would keep me up would be what we called out trades. So if I bought a 10 lot at the low of the day or close to the low of the day, and we rally 300 points from there, it's $300,000 every 100 points. Now we're 300 points away on a 10 lot, which is, not that big of a deal at that time. Because remember the NASDAQ was $100 a tick in those days, So a tick, we traded in full point ticks. So if I bought a 10 lot at the low of the day and we're 300 higher, that's $300,000. That's 3,600. I'm out. Now what am I going to do? It was a scary situation. $100,000 every 100 points. So when I started to trade bigger size, if I was at a 50 lot, an out trade is, I bought 50 at the low of the day, and you're the order filler. Mm-hmm. I think I bought 50 from you, but you traded with the guy next to me. I checked up the trade, at the same time the guy next to me did. So, I come in the next morning and you don't know the trade, but the guy next to me knows the trade and everything is good. Well, I'm short now 50 from the low of the day, right? And those sorts of things happened every single day. I had an out trade clerk that handled my out trades. The worst would be, when you're buy or sell, so now I'm short 100 instead of 50. It was just, those things kept me up at night, and especially the bigger I traded. It was a great time, Richard. It was fun. I don't know that I could do it I'm 57 years old, and I still trade. I love trading. I don't trade every day, but I don't know that I could do that anymore. Holy smokes. I'd like to think that if the floors were still here, that I'd have my sons working for me, maybe a couple of my daughters, but I don't know that I can still be out there roving it in there every day. whether you're talking about the screens or you're talking about the pits, this is a young person's business. I mean, especially being out there banging away at it every day. This is it's not for the faint of heart. To be a successful trader on the floor, I had to watch 5 people or 10 people with my right eye, another 10 people with my left eye. I had to hear another 10 people with my right ear and 10 people with my left ear. And I had to know who was long, who was short, how the funds were positioned, how the banks were positioned, and who was likely to puke their positions at what was their puke point, who was going to add, how are they going to average. And I had to know those things, and I had to pay attention to the order flow. Otherwise I would not be a very profitable or effective trader. Another thing to point out on the trading floors, though, is we did not have access to technology. If I wanted to see a chart, I had to walk out of the pit and stand in line at what we call the CQG machine, which was just a computer, and print off a chart or print off different time frames and then go back into the pit. And I'm not doing that. I'm trading 10,000 big NASDAQ a day, and I'm trading 10,000, 15,000 minis a day later on. I'm not walking out of the pit when I'm making markets that big. So I had to learn how to do all my technical analysis before the market opened and after the market closed, and I still do it that way.
And I was going to ask you this, but you kind of talked about it with watching the people around you. Was it more about trading the environment in the room itself versus any other method? What was kind of your process like? Yeah.
No, both. It's both. There's one of the main reasons that so many traders did not transition from the floor to the screens is because they traded off of other people. Either they got fed by their friends or their family members who were brokers or order fillers or whatever, or their friends that they partied with. Or the roar. Everybody has heard this before. The roar of the pit. You knew if they were buying or selling. And that's true. Because I was a bigger trader, the roar started oftentimes, not always, but the roar started when I started buying and selling, or the other big traders or the banks or whatever, So anyway, a lot of those guys were not able to transition that onto the screens. I was good at that part for sure, but and another thing too is because I didn't have a rich father, a rich uncle, or anybody down there. I needed I wanted to make myself indispensable to the order fillers. I didn't want to have to need them. I wanted them to need me.
Right.
And so I would trade bigger and bigger and bigger, and so to the point that happened. But now I also had a process. I traded. I had 2 great a lot of great mentors in my life, but 2 main ones. Mickey Hoffman, who taught me how to think and act like a trader. Judd Hirschberg, who taught me, when I met him, Judd told me, I'll teach you a way of trading that works on the floor, off the floor, anywhere in the world, anytime in the world. And that was the opening range breakouts. Traders have been trading the breakouts from the opening range has been clearly defined in futures as the high and the low of the first 30 seconds of the day. And traders have been trading breakouts from there since Dow theory was invented in the 1910s or around that time. So my mentor was a big trader in the yen and lost his ability to trade, and so he started to teach me. I was the first student that he taught, and it was great. It was so I was able to combine my natural, kind of my natural ability or my natural talent with a tried and true trading methodology with great technical awareness skills, not technical analysis, but technical awareness. To me, it's a distinction. Technical analysis is I'm going to look at charts and I'm going to make a trading decision based off of a chart, live, like I'm looking at a 15-minute or a 30-minute or something. Oh, look at that pattern, and then take a trade. I don't do that. It's called technical, awareness in my mind, because I'm aware of the levels I want to trade before the market opens, and I can show you those later. But, we open up today at, what was the S&P opening range was, give me a second.
Yeah, no rush.
Was 63.52 quarter to 63.47 half. So I want to be short at 47 half. We came out of the opening range in the pit. It's the same thing on the screens. The more things change, the more things stay the same. The only difference between now and then is there's no energy, there's no relationships. Nobody needs me anymore. I'm not a market maker anymore. I'm a market taker. So those things all changed. What has not changed was I'm going to be short at 47.5 and I'm going to take profit 15 handles below, and I'm going to add below that and take profit another 15 handles. These algorithmic rotations that are the same sort of basic thing that we did on the floor. It's just a little, the entities that created are different. So I had that process that I was able to adapt to the screens, and then that helped me. That helped me with, I think, what is the most important aspect of trading. Futures traders, especially with the advent of these funding companies that everybody calls prop, they're not prop, but everybody thinks that your win rate means something, and it doesn't mean anything to me. My win rate is probably 30%. What matters, I don't know what my win rate is. Most of my trades are scratches or very small expenses. But what matters to me is how I increase my size, how I decrease my size, and how I decide not to trade using real-time information, real-time market information to tell me when to go big, go small, or stop trading. Not at all.
Yeah, and when you mentioned the roar, I always picture that comic where it goes from buy to Excel, though the words get mished until it goes from buy to sell. It just shows the emotions and cycles in the market. And getting more into your transition to off the screens, when did you kind of make that full-time switch pretty much? And obviously you had a methodology that enabled you to make that transition, but what new things did you have to learn? But also what actually core things did you take from the pit to that process?
That's a good question. So things changed in like 02, 03. Side-by-side trading kind of took off. I took a year off. I got divorced in 02. I was married 6 years and 2 kids, and I got divorced. So I took like a year off. And Mickey Hoffman told me, Christmas of 02, he told me, you're the greatest trader. You're the best trader I've ever, it's 6,000 people he mentored. You're the best trader I've ever coached or I've ever known. And then 6 months later, he's telling me to stop, quit, retire. Don't ever come back here again. You're going to go broke. So you can go in this business, you can go from hero to zero really quickly. And I did. It took me, I made a really large amount of money. So it took me a long time to kind of blow through it after my divorce, and all of that other stuff, half your stuff goes away and actually more. But it doesn't go away. I mean, I made that money for my wife and my children. So, they got what they deserved. But the point is that, the business changed, let me try to answer this a little bit longer. So I say this all the time on X. Everybody, all of the younger traders are flashing cars and supercars and houses and trips and things like that. And, I was young and I did the same thing too. But my point always is to bank that money and save that money, because I can guarantee you that everything is going to change. And when things change and the way that you're making your money changes, you're going to be screwed, because you're left with the supercar that's going to become, like in 08, worth a lot less. Or your watches that you paid $25,000 for that somebody told you was going to be worth 50 is now you're selling for 10. No good. Bank that money, bank it, because things will change. I guarantee you they'll change. People will get sick. Relationships will change. You'll get divorced. Businesses will fail. We'll get into a deep recession again. And that's all coming again. Of course, it's cyclical. And when that happens, you've got to make sure that you have banked that money. And that is the biggest mistake that I made, is that I just kept thinking, well, I'm Pax. I'm going to continue to make big money. I lose 100,000. I'll make 200 tomorrow. It was an egotistical way of looking at things. It was an ego-driven, mentality that I had. And eventually that led to my downfall. So I started a prop group with a partner of mine. We leased space from Linda Raschke's husband, Damon Pavlidis. And then, my mother died in in June of 08. My sister, she died in October of 08. And my mother-in-law died she died in February of 09. I always say March, but it's February 16th she died. So, in 6 months, the 3 most important women besides my wife had passed away. And my business failed, and, the market fell apart, and the Great Recession kicked off, and I lost all kinds of investments, then properties that I had no business being involved in, and over leveraged and things like that. So I took another year off, and then I traded for Pete Stottlemyre for a while. Pete Stottlemyre, the father of market profile, was trying to update the profile into the age of algorithms, and it didn't work. But that brought me into back into trading. For a while I was going to go to, my wife and I were talking about what's the next move. Do I go to law school? Do I go?
So you were going to step away. You were going to
I
step away
was,
completely.
yeah, because it was done, and nobody I knew at the time made money on the screens except for Anthony Crudele. So and none of the traders I backed, and I backed 100 of them. None of them made money on the screens. So Stottlemyre then, got me back into trading, and I went into the hogs. I got my seat back, and I went and traded lean hogs. And, I learned how to spread, and I learned different skills in there, and that was an exciting time, and I reinvented my career. And then MF Global happened, and MF Global took a ton of money. I had a lot of money, way too much money in my trading account at the time, because I had a bunch of hog spreads on, and, you needed it for margin, and I left too much in there. And that was why, that was gone overnight. I eventually got the majority of it back, but that was like the straw that broke the camel's back. I'm going to make back that money. I'm going to make back that couple million, and I'll do it on my own. Before you knew it, I was emptying out SEP accounts and IRAs and all kinds of things, and we were broke. We sold our house, moved from Lake Forest, Illinois, back to the south side of Chicago where my dad lived, and I started to. I took a little bit more time off, but then as we took our house money, and we took some of the money I started to get back from MF Global, and I started to trade 1 lots and 2 lots on the screen. So all that background to tell you, the thing that I had to learn was, what worked on the floor was trading the breakouts from the opening range, even if they're only 15 points. Managing my expenses and not taking a lot of risks. Somebody asked me what my RR was once on Twitter when I started tweeting in 2019, and I had to Google it. I had to look it up. I don't know what that is. I spend a little bit of money. I had to reframe things in my mind. Like, I don't have market losses. I have market expenses. Trading is like any other business, and I have to treat it as such. So I'm willing to spend money to make money, and I have to keep what I spend in line with what I can make. So I started to trade 1 lots and 2 lots, breakouts from the opening range, and instead of trading NASDAQ because the NASDAQ is jumpier, I started to trade S&P. Also, I felt like I helped create the NASDAQ as a trader, so I felt like I knew it too well. And if I'm going to miss my stop, or I'm going to if I'm going to stop trading the breakouts, and get stubborn and start fading things, picking tops and bottoms, I'll do it in the NASDAQ more likely than the S&P. And, I had 5 kids that needed to eat, so I had to figure it out. And that's what I did. I took 1 lots and 2 lot breakouts in the S&P, and I tried to figure out where the algorithms, where the algos, the new market makers, where are the HFTs, right? The high frequency trading models and their algos, where are they taking it before they decide to extend the range, and how big are they going to extend the range? At that, in 2013, it was 10 to 15 points. The ATR was like 20 points, on a 10-day look back. So I would just trade for 4 to 8 points, 4 to 10 points. And then and then the market was kind of, starting that, the truck to all-time highs again. And so I would buy, instead of trading a 2 lot, I would trade a 3 lot. So I'd leave a runner on. And then I would, I started to add to my size a little bit like that. So I was just trading simply the breakouts from the opening range, and I would remove my risk by paying for my trade by selling 1/4 of my unit, and then I would sell another 1/4 of my unit at my first target, and I would keep one for the next one, and then one for to become a runner, and that began to work. And it helped that in like 2014-15 there was some volatility, and the ranges started to expand. And then we had Trump's election in 16 in November, and that was busy. We had some busy times there, and so the money was bigger. The most difficult thing that I had to relearn was how to size, like I said earlier, how to size up, how to size down, and how to decide not to trade. If left to my own devices, I will always trade big, and I will always overtrade, and always chase money. So I had to develop like guidelines and rules that were meant to keep me within myself. It's things like I call my 2x4. So from the opening range, I'll take 2 expenses, And they're only, so if the opening range, if the top of the opening range is even, and we go even bid, I'm going to get long at even, or even quarter or even half. But if we go back in the opening range, I'm out. So it's a tick or two ticks, and that's it.
Right.
If I buy evens and it stays bid above my entry price, well, all I have to do is pay for my trade, take profit on it. Okay, so I had to learn how to let raw price action size me up, and not my opinion and not my guesses, but raw price action, And so gradually I learned how to do that. Not the roar of the crowd, not being able to see Goldman is selling 100 lots. Well, if Goldman is selling 100 lots, then I can go ahead and trade 100 lots because I can get out. Or Richard Dennis, the great Richard Dennis, would come in and sell 10,000 through a day. Well, if I know he's selling 10,000, I can trade bigger and get out, right? You can't replicate that on the screens. So I had to learn how to let the raw price action allow me to, or help me to learn how to size up again. And that took some time. That took a long time. Mm-hmm. But my only goal, Richard, was to be green, man. I mean, if I made $100 or $200, I was happy because I knew that 200 would be 2,000. And, I knew that 2,000 would be 20,000. And I knew that if I can scale that up, it would be more, 50,000, 100,000. It's been those things. Go big, go small, or not at all was the hardest thing to learn how to do. But, I don't know. And then not to overdo it. So 2 expenses in a row, I cut my size. I give myself 2 more expenses, 2x4. Silly, but, it works. And it helps me protect me from me. I got to protect me from me. The market can't hurt me. The market can't help me. The market is neutral by nature. Mm-hmm. Only I can hurt me. That's the best lesson I learned on the trading floor. Was the only thing that can hurt me is me.
Excellent. And I love the framing of a stop loss hit or a small loss as an expense. The trader who first taught me at the University of Maryland, Dr. Eric Wish, he always says, a stop loss hit is a small loss on a good setup that you would take again. That's just getting you one loss closer to your next win that can pay for all those small losses. Mm-hmm. Would you be able to maybe share your screen and walk us through your morning routine process as you get ready for the trading day and chat about how you set your levels and how you utilize them as you're getting set?
Sure. All right. So let me preface this by saying that I trade on domes. I only trade on domes. I don't trade on charts. I look at charts after the market closes when I make my targets for the next day, and then I read and then I adjust them in the morning. So this is all kind of new to me.
Yeah, no worries.
In sharing this, okay? So hold on, let me figure out how to do that. All right, so the markets that I primarily trade are going to be the I trade the S&P primarily, and I've been trading a lot of gold lately. NASDAQ, I bought some NASDAQ yesterday, but I got stopped out of them pretty quickly for a scratch. But, I don't trade NASDAQ very much. And I trade, this year I've traded a considerable amount of 30-year bonds, but the bonds aren't moving very much lately. So everything in my mind, or everything in this market has pivots, right? Is, above here, if this, then that. Right. A plus B plus C plus D. So, my trading process is a swing and trend process at its heart, but using daily breakouts to establish a position. And I started to do that on purpose on the screens when I started the trading on the screens because I needed to make money, and so if I got long in the S&P at 60.10 and my objective is 64.06, well, that's going to take me a few months, but I needed to make money along the way. So I traded I had kids to feed. So I started to trade the daily breakouts, and then the way that I managed my positions is what ultimately gave me the ability to be able to hold something for a lot longer and to be able to add to it. So the opening range is going, as I said, is the first 30 seconds, the high and the low of the first 30 seconds of the day, and that's the breakout point that the algorithms are using. Mm-hmm. I don't have the opening range populated on here, but this is a daily chart. Okay. Mm-hmm. And today's the opening range in the S&P is 63.47 to 63.52. So 47.52 here. Let me put up a 5 minute if I can find one. All right. So 40, here's today's opening range. On a short-term chart, you can see the opening range breakouts. So I want to be long above 63.52, and I want to be short below 63.47 and a half. So you can see that, we opened, I think here, let's see, 8:30 Central Time. So we opened up in here, broke a little bit, and we kind of messed around with it. Tested the top of it, came back down. So this is where my 2x4 would come in handy. I'm going to sell 47 halves. And if they come back in the opening range, I'm out. But I'm going to sell 47 halves, and I'm going to buy the quarter of my unit at 43 half, and that's going to be, how I pay for my trade, or remove my risk, or give me a little bit of house money to trade with. So if I sell, to keep it simple, if I sell a 4 lot at 47 half, I'm going to buy one at 43 half. Well, we made it down to 43 half a couple of times. Right here the first time, no, shy of it, 43.75. Back up to the opening range, so that's a scratch. I don't count scratches as an expense. I sell 47 halves, they go offered 46 half, I put a scratch stop in. I sell 47 halves, they go 47 half bid, I'm out. Maybe 47.75s, maybe 48s. I mean, this is why I trade on domes, because you have to be quick and you have to be nimble. And please do not try this with live money. It takes a long time to be able to get quick enough to be able to execute this. So do it if you're going to try this, do it on the simulator, please, okay? Take your time. This is a marathon. It's not a sprint. If there's one thing in my life that my life exhibits, is that you don't have to get rich today. Take your time. Anyway, so I sell 47 halves, scratch, sell them, scratch. Sell them here. One tick shy, back up to the opening range. I reload. Finally pay for it here. Okay, and then we don't do anything. We come back up to the opening range on the number. This is when I think the Michigan consumer sentiment was released. We rally back up to the top of the opening range, and then we come back down. So short again, because you're trading breakouts, quick. So now when I sell 47 halves for a lot, or 4 contracts. I buy one to remove my risk at 3 half, got that off here. And now I've got 3 on, and I'm going to buy another one at 15. The markets always move, S&P always moves in 15 handle increments, always. And if I can't get 15 handles out of the trade, then I'm going to take the scratch, and I don't want it. Okay, so now we got down, 15 handles is 32 half. Or 32. We got down here. I took profit on another unit, or another quarter of my unit. So we go offered below here, selling more. Okay, now I'm going to sell. I'm short 4. I pay for my trade with the 1 lot. I take profit on a 1 lot. We go 32 half offer. I'm going to sell 4 more. Scratch them out. Then I'm going to try to sell 34s. Pay for those. We broke a little bit, so I paid for them, and then we came back up and scratched. I'm not going to try to add to a position more than twice. And I'm not going to take, I'm going to try not to take an expense on it. Okay, so, then we bounce back up here to, really nowhere. So I'm still short from 47 half. Market's got to come back up to my entry price to scratch me out. I don't use trailing stops. My stops are always at entry. So now when we don't make it back up here. I'm still short. We break down here to, I don't know what the low is, 27 half. And we've been kind of messing with this all day long. So I've got no reason to get out until maybe the close or the margin close at 4 o'clock Central Time to see if I want to, take a position. I'm not going home with anything on unless we break 100 points. I'm not going home short or long and flat. Who knows what kind of headline risk we've got this weekend. But you see, so I'm short from 47 half breakouts. I take profit at 32 half, and I'm still short half my unit. Now, if the market extends to my next target, which is another 15 handles to 17 half, well, I'm going to take some profit on the trade, and it's going to be a nice little day. This is yesterday, and this was also a great breakout. Yesterday's opening range is 63.05, top of it. So right here's the open. You get long above 63.05, you never look back. We make it up to the first target at 20, 15 handles. And look how we churn that 15 handle range for a little bit. got below it, but did not make it back to our entry. So I'm still long. We take out 20 later on in the day. This is, whatever time that was, late in the morning, like at 10 o'clock Central. We take it out again.
So you're adding more there? You're adding more there? Yep.
Yeah. And I'm going to take profit at the next 15 handle rotation right up here. And we got there, take profit on them. So if I'm long 4 from here, I pay for my trade at the pain line yesterday was 09. So I'm going to pay for my trade at 09 in here. I'm going to take profit at 20. We go 20 bid, buy them. They go bid, take the scratch, come back under, nothing. I'm not going to flatten here because I've got no risk on the trade. So the market's got to come down to my entry price and scratch me out, or it's going to do this, extend. So later on, we go 20 bid, I'm going to buy more. So I'm going to buy another 4 lot. Now I'm long 6. I'm long 6 and I have no risk. I've got 1,200 or 1,300 locked in, of realized gains and another 1,400 of unrealized gains. And I'm willing to spend a little bit of what I've locked in to try to double or quadruple what I've got locked in, right? So I've got no risk to my beginning balance. I've got risk, of course, to the unrealized gains, but nothing to the beginning balance of my statement. And that's what I'm here to protect and grow. Right. So, the next target's going to be 35. I take profit at 35. We go 35 bid. I'll try to add. We don't. We mess around, but no reason to get out. And then late in the day, we get above it. Now, there's also a significantly important price, which is 63.42. 63.41.75 was Tuesday's. Let me see if I can find that. See if it goes back that far. Tuesday's opening range. And this is significant. It's important because this was an all-time high. Mm-hmm. So when the high of the day, real-time information to make real-time trading decisions, right? Not found on charts. So if the high of the day is made in the opening range, so if the top of the opening range is also the high of the day, and we come out of the opening range in the first attempt, that's going to be a bearish, often trend day. I thought that I tweeted about this. I thought that this could possibly change the structure of the market because what happened? Trend. Yes, because what happened was the high of the day was made in the opening range, was also the high of the opening range, and it became the all-time high, both in the S&P and the NASDAQ. So we stopped at 41.75. We came out of the opening range at 37.25 on the very first attempt, and everything was an ad. Everything. First 15 handles down to 22, took profit, get below it, add, scratch them out, sell them again, take them down to the next level, 07. We mess around there for a little bit, take it out later, sell them again. 15 handles at a crack. See, it's every day. The market rotates 15 handles, and that becomes support. 15 handles becomes support. We take it out, you're adding more.
What creates that structure, do you think, the 15 handle increments?
I don't know. I don't know. Exponentially, I see it constantly, and I can show you on these short-term charts that it's the way that the algorithms look at the market. There was always the same sort of thing that we did in the pit. It's Nasdaq is going to be 60 handle swings, and they're going to be just as crisp. The Nasdaq, the Nasdaq overruns the targets, but you're going to be able to see it quite often. And then we ended up rotating. So we had we opening range 1, 2, 3, 4. Almost 5 full rotations. We ended up making a low of 41 or 42 later on in the day, but it was a great trade. And then we the next day used the next day's opening range to cover whatever runners, and I got stopped out of some stuff for scratches, but it was a significantly profitable day because of these rotations. This was Wednesday. We didn't do much. We're all over the place, and then just came back up. So, this isn't rocket trading is not rocket science, at least in my opinion. For me, I need to keep it as simple as I possibly can and not corrupt it in my mind with too much. The market's doing one of 3 things at all time. We're going higher, lower, or nowhere. If we're going higher, like emo, I want to be long. If we're going lower, I want to be short. If we're going nowhere, I'm flat. And how am I going to determine that? Well, partly is my 2x4. I take 2 expenses. I cut my size, give myself 2 more. I'm looking for clarity in the market. We're below the opening range. The market is, in fact, trying to break. So I'm going to wait until that maybe opening range is choppy, maybe it's whippy, I'm going to wait for that first 15-handle rotation, and if we take it out, I'll sell them there or I'll buy them there. And then I'll just look for something easy, or a late day trade, or something along those lines. But I am very, very quick at shutting it down and not trading. I didn't really do much June. Late May, once we started the rally, the indices started that dreaded creeping rally, here on a daily. Once we started this, this was actually not bad. When was this? This wasn't so bad, but once we started this kind of slow truck up, I don't need to be involved in the market constantly anymore.
You thrive on expansion, right? Is that right? So you're not looking for
right.
a gradual trend, right?
And I'll take those 15-handle rotations to get those gradual trends,
right?
But I'm also I'm also older. I'm not old, as you can see. I'm in great shape and I'm handsome as hell. But I'm older, and I grew up as a trader. I really came into my own when the tech bubble burst. So I'm a better short side trader than I am a long side trader. I trade the downside volatility a lot better than I do the upside volatility. Last May, I ended up with AFib. AFib in and of itself is not very serious, but my particular kind of AFib caused heart failure. So I went into heart failure. I take very good care of myself. I don't drink much. I eat very well. I work out every day. I'm very strong. I run a lot. So I was able to come out of the heart failure after a couple months. But Anthony Credelli, I don't know if you know who Anthony is. Anthony and I are very, very close friends. Anthony had a heart attack at the age of 36, a stress-induced heart attack. So Anthony called me and said, look, you got to be done trading. You're going to die. Anthony, I don't find trading stressful. Maybe you just got used to it. So, I took that to heart. And I really did from May, June. This is last summer, May, June. I had heart surgery in late June, and July, I didn't do much. And then we had that volatility on the Japanese, the yen carry trade unwinding. Right. And I found it a lot more stressful not being involved in the market, in very easy. I thought easy. I find the downside easy. So I started the trade again, and I did very well. And then we set the low. The S&P stopped at 51.20 in the all sessions, 51.46 in what I call the pit, which is the regular trading hours. We stopped at 51.20, 51.46 respectively, and then we started the trek back up. We broke from 57.21. That was the high of July. I can't remember what the date was, July 21st or something. And that was the all-time high. We broke from 57.21 to 51.20. And then we ended up taking out that high in the fall. And that trade got, it was wonky. It was, like a reluctant rally, Yeah. And by that, I mean, we would, I'd get long from the opening range, or the traders in my group and the Pax group would get long. And, you take profit at the 15-handle rotations. And then the market would come down and stop you out. And then the next day we'd be 30, 40 higher, and you get long again, you take profit on them, they'd stop you out. Next day we're 30, 40 higher. That to me is, what I call the dreaded creeping rally. I can't stand dreaded creeping rallies because I've gotten killed in them in the past. And I don't like them now, even though I'll be long small because I'll get stopped out. Mm-hmm. I like momentum. I don't care if the market goes higher or lower. I just want it to go, even if I'm long. And that market turns around and reverses, I get stopped out for a scratch. I'm okay with that, because to me, that's a whole nother opportunity to put on full size. Or I could be short. In this case, I was short Tuesday and Wednesday, got stopped out Wednesday afternoon, got long yesterday. And that worked. It was good, right? So when I got stopped out of my shorts for a scratch after having taken considerable profit on it, I thought, okay, well, you know what? This is an opportunity to put on a full unit. So I don't know. I look at everything in the market as an opportunity, Richard. I don't look at, everybody complains about algos, futures. Not everybody, but a lot of futures traders complain about the algos. I don't. The algos aren't hurting me. They can't.
They're the market.
Me. They're the market.
Yep.
Yeah, I'm not complaining about them. I'm grateful for them. I don't have to do anything but surf them. And if you can simplify your trading and see it in a very clear sense, you're not going to make money every day, but you're going to make money every month, or you should, and certainly every quarter and every year. And you're going to have, if you can be consistent making $1,000, obviously nobody makes money every day, but if you can be consistent and averaging like 1,000 a day at the end of the month, there will be 2 or 3 days a month where you're going to have $10,000 days. Every quarter, that $1,000 consistency is going to be 20, 30, 40,000. You'll have a few days of those. Every year, you might have a $50, $60,000 few days of those. And every $1,000 consistent trader in every career is going to have 6-figure days, that make your, or more, that make your career. The bottom line is you've got to do the work spiritually, emotionally, physically, to be able to make sure that you survive those small periods of drawdown. Those, like the month of between mid-May and in June, where a lot of expenses here. You shut it down. You go play golf. You go work out. Read a book. Watch a YouTube video. Talk to somebody. Get out of yourself, so you're not sitting there banging your head against the wall, making trades based on your P&L. I'm down. I spent 800. I've got to make that back, and now you're down 5,000. You want to, you want to put a dagger in your neck. You need to be able to deal with those, because we have extended periods of that too, to be able to sift through those really good, easy trades that your process gives you. You need to have, all of us need to have a process that's consistent, repeatable, and scalable. Every single one of us. 3 things. That's it. Consistent, repeatable, and scalable. If you've got that, then learn everything that there is to know about it. Learn its strengths and its weaknesses. Within that process, consistent, repeatable, and scalable, learn how to go big, go small, or not at all. And deal with those days, those weeks where you're going to have small drawdowns, and learn when you have clarity in the market to really put the pedal to the metal, or at least to take a trade and to let it work. And then at the end of the month, you'll be okay. And when the market starts loosening up and we have bigger momentum trades, your P will far outweigh your L. You'll have very big P&Ls, and that will continue to grow, my brothers and sisters. If you are trying to, if you're like I have been so many times in my life, if you are going to be, the pedal to the metal on every day, every trade, oh man, you're going to wind up selling your house and moving in with your dad with 5 kids. No, well, I did. You don't have to. That's in my Twitter bio, Richard. I've made every mistake, so you don't have to.
Perfect. Fantastic. Could you go back to the 5-minute chart here? I do have a few questions about the opening range a little bit. First things first, could you walk us through, again, just maybe before the open, what's kind of your go-to process to make sure you're right in the right headspace to trade, you've got your level set, you're ready to go, and you're ready to perform and execute to the best of your ability?
So when I have the intent to trade, like I did this morning because of the numbers, and I also had my Ninja Trader live show this morning, I wake up every morning at 4:45 or 5. And the first thing I do is I wake up and I make my bed. If my wife is still in it, like she was this morning, sorry, honey. If my wife is still in it, then I make my side of the bed. And that's very, very important. So I make the bed. We usually wake up at the same time. So I make the bed, and that's my first accomplishment for the day. It's important for me to make my bed. I didn't grow up doing that. And I am, how do I say this? I think, I don't think I am not a naturally disciplined person. I think I'm a naturally lazy dude. So, I make a schedule, and I keep the schedule, and then, I appear to be disciplined when I don't know that I really am. So making my bed is the first aspect of that. And then the next thing I do is I hit my knees and I thank God for the day. I ask him to help me make it a better day than I did yesterday. I thank God for my kids. I just go through a little bit of a prayer, and then I do some breath work. I do some breathing exercises to oxygenate my body, to kind of reboot my brain. I do that for 15 minutes. And then I do I hesitate in calling it yoga because it's not real yoga, but I stretch and do some yoga poses to limber up my body. And then at that point, I don't drink coffee anymore because of the AFib. So I come down and make a protein shake with creatine in it, and take my supplements. And then I come down. By that time, it's like, 6 o'clock in the morning. I take my shower after all that. Then I come down, and by that time, it's like 6 in the morning, and I feel good. I'm awake. I'm alert. Or I didn't sleep well, or I'm stressed out. But I know at that point, this is silly. It might sound silly, but I know at that point whether I'm confident, carefree, fearless, and focused, or at least I know whether I'm alert, I feel good, I feel strong, I feel on top of my game, I feel in control. CCFF, confident, carefree, fearless, and focused. Then I come down and I look at the market. What market drivers do we have today? What numbers do we have? What headlines are we looking at? What is going on that are going to move the market? What are my positions? What are they doing overnight? I've been flat for a while, but I was short from 61 quarter to 49.50 earlier on this year. So now it's just a matter of what are the market drivers? What are we doing? My targets. I don't. Besides these 15-minute, not 15 minutes. Besides these 15 handle rotations, my targets, my daily targets, which are outside of these, and my what I call macro levels and flattened zones are based on Fibonacci math, not on trend lines and charts and overlaying 5 minutes with 15 minutes and hourly and things like that. The only reason I'm looking at a 5-minute chart right now is to show you how the opening range works in the 15-minute rotations. Otherwise, I don't ever look at a 5-minute chart, ever, never. It's too myopic. It's too short-sighted. So I look at a daily, and then I'll do some Fibonacci math to adjust my targets. And now I know that, I'll show you. Now I know that above 60, how do I do this? Above my quarterly pivot, above 60.10, I'm long to 62.06, 62.02 right here. Above there, I'm going to be long up to now 63.42. Above that, I'm going to be long up to 64.06. Okay, so I've got the wrong levels up here, but you can see basically how it works. So I'll adjust my daily targets accordingly. And then I'm ready for the day. I eat breakfast. I've been trying to eat a lot of protein. So my wife by that time is up and doing her thing, and she'll make me. We have breakfast together, eggs, and then I come down and by that time it's 7 o'clock Central or 7:15 Central. I've been going to mass in the morning a lot lately. When I don't go to mass, I pray the rosary, and I pray the rosary on Twitter. A great deal. I pray my rosary every day. I'm Catholic, obviously, and kind of a trad Catholic, so it's very important to me. And I pray if I'm not going to morning mass, I pray the rosary on Twitter. But then I come back and it's about 8 o'clock in the morning, and I'm ready to go. Markets open at 8:30, and I know that I'm confident. I know I'm carefree. I know I'm fearless, and I know I'm focused. So, what are the market drivers? Where's the market going? What size will I trade today? And, am I looking to add? Am I not looking to add? And, and then I take my 2x4. Oh boy, I've hit my 4 expenses. All right. Well, that's it. I'm done.
Go golfing, go work out,
Yeah.
something like that. Yep.
Yeah.
Excellent.
Yeah.
And I wanted to ask, is it when you're deciding, are you going to trade today, or are you going to be aggressive today or larger today? Is it based on whether, key data just came out, or, how do you make the decision that there might be big expansion that next day that you can profit from either to the short side or to the long side?
So like market drivers, that's what I mean is, we have numbers coming out, we have data, we have reasons to move.
Right.
If we have reasons to move, then I'm alert. Then I'm aware. I'm aware of if we rally, where are we rallying to? This week has been a great example. I guess I'll use that. Maybe I'll do it on a daily, or should I do it on an hourly? Let's do it on an hourly. So I'm thinking to myself, well, where are we going to go? What are we going to do? Do I even want to trade? Do I want to be involved in this market? So I didn't take a trade Monday. I didn't, I didn't want to be involved in the market. I don't quite remember what we did, but the opening range was 11 to 96. And, all right, so we didn't do anything. So we got above it. We sat. we didn't get any rotations here. No 1500. We got to the upside 96. We made it up to 11 later. You know, it wasn't an easy day. So I didn't take a trade because we had no reason to move. Tuesday, I wasn't planning on trading either until, you know, overnight we rallied up. I don't remember what the news was, but overnight we rallied up to 63.43. But RTH high was 41, as I told you earlier, 41.75, and that was the high of the opening range. It became a new all-time high for regular trading hours. We broke from there. So I jumped into action pretty quickly. 63.37 quarter was the bottom of the opening range, and then the 15-handle rotations all the way down. And even on the hourly, you can see how you know, solid these levels are. We made it down to 92, popped back up to 07, back down. And if I was younger and more aggressive, you know, we can make it back up to 07, and I'm still short here. You know, I take profit at 92 and make it back up to 07. I'm selling them. Yeah, I'm too old for that shit. I'm just too old for that stuff. I'm gonna sell them on a breach, and if they come back up and scratch me out, you know what I mean? So this was a good trade, and because it looked like the structure of the market could have possibly traded or changed on Tuesday, I was going to be involved in the market on Wednesday, and we had CPI Wednesday, so we had reason to move. Here we go. We have market drivers. We got data, and then we had retail sales, and we had PPI, and then today, nothing. So the only reason I wanted to trade today was because of where we were opening, you know, and the market driver at this point was the fact that we were trying to get back above 63.42, 63.41.75, and we failed. You know, I mean, we got up to 40. The opening range was 47. We got out. We got below it. It was an easy peasy day and still short. Unless we're trading back above it, then I'm out.
To use that, I guess, Tuesday example where we made the high and had a great trend day down, in that case, right, you're keeping some overnight and trying to see, but you're using the opening range of the next day to decide whether you're stopped out or not. Is that correct?
So another thing that I do, and I don't have the lines on the chart, is a late day trade, you know, or early MOCs. This is something algos use too. 250 Central Time, 255, so 350, 355. Those prices are, you know, there's always late day settlement, you know, like algorithmic price action off those levels. So Tuesday's late day trade was 62.98 at 250, and then 255 was 62.93. So you sell them at 98, you know, 98 half. We went offered at 98 half. Cover some at 93 at 255. We go offered there, you sell more. Okay. So I sold more and then took those down. We went down to 41, I think, overnight. I left a bunch of money on the table. I took profit at 64, 77, 64. Anyway, I left my stops in at 98. That was, you know, at entry. And I left my stops on my existing shorts from the opening range also at 98. Because I figured, you know, we broke another 40 points from there in the afternoon. My thought process was I'm not gonna wait for everything to come back to the opening range and scratch me out at 41.75. Another pivotal level that I was able to diagnose isn't the right word, but locate was in the late day trade. We broke another 40 points off that, or 30 something points off that 98 level. So that's where my stop is going to be, and I flattened there. So we got up, I scratched out the remainder of my late day trade, and then I took profit. I only had one on from 41.75 at that point, but I scratched out that last one lot. I didn't scratch it out. I took 48 points worth of profit from that level too. Normally my stops are going to be at scratches, unless we opened and traded below the overnight low or the RTH low, and we didn't. We got back in there. We opened the next day. We opened it. See if I can find that quick enough. We opened after we made that high and broke like crazy, right here, and right here, 98 to 96 or 92 to 96. So there was nothing going on. I covered my shorts because we're not going anywhere. It was I'm not going to screw up my trade there. I've screwed up too many trades, Richard, by scratching something out and then thinking, I better hurry up and get back in the market. And that was a level that I was very reticent to do so at, because that was a late day pivot. We broke down to 41. We came back to it. Next day open there. So I scratched them out and I thought, okay, I'm going to let this play out before I take a trade, and then we just kind of messed around with the price all day long.
How does when there's new, really potentially market moving news that comes out during the day, like a Fed announcement or Fed notes, how does that play into your process? Do you not trade those days? Do you really look to, do you draw a range during that time when the announcement comes out? How do you process that? Yeah.
So I have these macro levels, what I call macro levels. I call them macro levels. They're just my word for it, because they don't change. So, like for example, let me get rid of that thing. The S&P quarterly pivot for me is going to be 60-10. So I'm long above. I call that my flat zone. So I'm long above that and I'm short below it. The Fibonacci math that I employ gives me an upside target of 62.06. with the ultimate swing target of 64.02. Okay. Now, December 18th of 2024 was a Fed day. I was flat the whole day. We didn't do anything. And if you, let me pull up a daily. I don't know if I can manipulate this all the way back there, but oh man, alive. I don't know that I could.
Yeah, take your time. You can break out. We can cut right to it, Pax. So no worries if you want to come back to it.
Okay.
So that's
yeah,
12.6.
Here we go.
Yep.
Okay. So Fed day, right? Okay. So now Fed day, we had. I mean, look at this. This is just this is Garbone, or I mean, this is nothing. All right, little drifts, little swings, and I like I said earlier, I'm not trading for the swings. And then if you guys remember this, it was. Without looking at that bar, I'm going to, wait, I got to look at the price. It was like 61.25. So when we started to come down from that level, no, we weren't trading that high. Yeah, it was. Okay. So when we came down through 61.25, I'm looking at my macro zones, 61.25 to 60.62 to 60.10. to 59.80 to 59.51. The low of the day was 59.09. Now you got to, this is going to be different because you need to back adjust it, or not non-back adjusted. This is the back adjusted chart. So I'm talking about S&P. Now the 15 handle swings, right? When Powell was speaking during the press conference, we were steady. We were doing nothing. We didn't do anything. And then we started to take out these set in stone levels that don't change for me. And I started to get short 15 handles at a time, 15 handle rotations. That day we had 45 15 handle rotations.
Wow.
The S&P broke 245 points off the press conference. So it's if you're trading 4 lots, you sell 4, you cover 1 or 2 at the 15 handle rotation, you sell 4 more, you cover 1 or 2 at the next one, and now you're short 6, you're short 12, you're short, you just keep adding all the way, and it was a huge trading day. So I've got my macro zones and the 15 handle rotations. I'm not going to trade the opening range that day because, the market's all over the place because it's a Fed day and you got Powell speaking, right? So, I'm going to far surpass my 2x4 and I'll get killed. But when the market gives me clarity, like I said earlier, then I can jump back in 15 handle rotations at a time. Sell them, buy them, sell them, add, and all the way down. Remove my risk, take profit, add. Remove my risk, take profit, add. That was one of the best days that I had in 2024 because I was ready to trade. Now, I'm like CPI day, the other day, Wednesday, we didn't do anything, but I was ready. I didn't expect us to do anything on CPI day either. But when the number came out, I've had some pretty good days trading CPI days. Now, and that's at 7, the numbers come out at 7:30 Central. The opening range isn't set until 8:30.
Right.
So again, I'm going to, let me find a CPI day. I'm going to, a good CPI day. I'm going to trade the breakouts based on, I can usually tell what it is just by looking at the bar. But, I don't go back far enough on this. So, I'm going to trade my macro zone. So if we're trading at 60.10 and the number comes out and, we're at 59.80, I'm going to try to sell those if I miss them and it keeps breaking. Well, I got 59.49, which is the yearly opening range. That's where we open the year, which is the pivot price for everybody. Earlier in the beginning of the conversation, I said that, I'm looking at trading the breakouts, pivots. So that's the biggest breakout of the year. So we get through 59.49. I'm selling them, and I'll get those because I'm going to sell them before we get there. And I'm not a market maker anymore. As I said earlier, I'm a market taker. So I'm here to surf the algorithmic price action. And through my experience and through my time on the floor and moving markets, I've got a clear insight into how the markets move. And so I'll just jump on board with it and try to take a few points out. And if we get those rotations, 50 nano rotations, I'll add. If we get those rotations through these bigger levels, I'll add significantly. If we don't, I'll flatten up, take my scratch, and go play golf or go lift weights or go lift heavy things or go pray rosary or go have lunch with my wife or take any one of my kids out for lunch or whatever. I'll do something other than, or talk to any of the traders that are in my group. I'll do something other than sitting at the screen, trying to catch 5 points. I don't need to do that. That's a passport to poverty.
And this recent market correction we had some great expansion. Did you play any of those key days?
Yes.
Yeah.
It was like the old days. We broke from, let's see if I can find that. It was December. We broke from 61 quarter. Okay, and this is going to be a back adjusted chart. But we broke from 61 quarter, 61.25 in the S&P. Now the next level 60.62. Next level 60.10. Next level 59.80. Next level 59.49. Then an old a flattened zone. It was the quarterly pivot at that point was 58.40. I'm going to take profit, flatten there. We go 58.40 offer. I'm going to sell more. 55. I said this, did all of this on Ninja Trader Live in March when we kicked off. I just traded it from level to level to level. And when we got through these flattened zones, I would take the money. And if we got through it, I would add to them or I would reinitiate the position. My downside target on that whole swing below 59.49 was 55.09. Mm-hmm. And that, all that is just the all-time high at that point. Here, the all-time high was 61. Here, I'll tell you how I came up with, 55.09 is a macro zone for me based off of 51.01 March of 24 expiration. Mm-hmm. But if you just do this simple little mathematical formula, the all-time high at that point was 61.66 in the S&P. 61.66 when we got below 59.49, right? I'm looking for what the market, here's another important concept. What the market does on the upside, the market will do on the downside, and it will do so in equal measure. What the market does on the downside, it will do on the upside, and it will do so in equal measure. So 61.66 minus 59.49. It's 217 points. So 59.49 minus 217 is 57.32. Another equal distance swing in equal measure takes us down to 55.15. Okay, so my downside target was 55.09. Now we've got like a 6-point swing there. Now I'm looking at the quarterly pivot was 58.40. So it's 61.66 minus 58.40. I did that wrong. 59. How about that? I got the numbers even jumbled on my in my mind on my thing. So 61.66 minus 58.40. That's 326 points. 58.40 minus 326 takes us down to 55.14. So no matter what you're measuring from, 61.66 to the yearly pivot, 61.66 to the quarterly pivot takes us down to between 55.09 to 55.15. So when we got below 55.49, I took the money at 58.40. We got below there, I sold them with both hands and feet, as we used to say on the trading floor, because I knew I had clarity, right? I was willing to spend money in that market. Remember, that's a whole nother thing. I come into the Monday, I'm not willing to spend any money in that market. I'll take a trade or two to see if I can catch something. I was willing to spend money in that. So I'm going to sell 58.40 because I know we close below there. We're going to 55.09 to 55.15 because everything measures there. And that's where we went. When we got there, we stopped there and we rallied back up to 58.37.5. And then we broke again. So we stopped at 59.09 on the nose, rallied back up to 58.40. I mean, three points away to 58.37.5. And I think that was on CPI day. And then we broke like crazy. It was great trading. It was like old day trading. It was like old day money. And, and then it's just a matter of, another thing that everybody on Twitter knows me for is capital preservation, because now it's just a matter of preserving and protecting that capital. Anybody can make money in this market, Richard. Anybody can make money in volatility. Anybody can. It doesn't take a whole lot of, talent to click a mouse. What does take a lot of talent is how you conserve and protect that money, how you conserve and protect that capital, financial capital, how you preserve and protect your physical capital, your emotional capital, and your spiritual capital. If you're not working on preserving all of that capital, you're screwed. Passport to poverty. If you're running out making a bunch of money and blowing it, now, you better be working out. You better be praying. You better be meditating, and you better be breathing. You better be moving your body, and you better be reading, and you better be learning. If you're not, I think you're putting yourself behind the eight ball. It's a long-term game, man. I have made an ungodly amount of money and drove Uber. That's not happening to me again. Another thing too, live below your means. Nobody's going to be impressed with my house. I made more money this year. I could buy two houses I don't know. We can afford a much nicer home. We're not moving anywhere. I reset. Every trade I reset. If I make $1,000, I'm willing to spend 200 of that or 300 of that to make another 1,000, theoretically speaking. And, it's going to be more, the more I trade right, or the more the market's moving. But the point is that I'm willing to spend some of what I've locked in to try to make more. Reset. Every day I reset. Every week I reset. Every month I reset. Every month, my wife manages my account, so I manage trading. She takes the money out and manages our tax accounts and things like that, so that I'm not wholly aware of all of that. I don't want to think of my P&L. I just want to think about the price action. So she does that for me, so I don't have to. And now we live on what I make. If I don't make money this month, well, we'll pay our bills by the money I've made over the year. But I try to make sure that everything that I make, we put away. Who knows what's going to become of this world in another 1 or 2 or 3 years? I've said this a million times on Twitter, and I get trolled all the time. I say it. I've known too many traders that have been worth 5, 10, 15, $20 million that have ended up broke, completely broke. And I can't even count them. And I know everybody always thinks I make 5 million, I'm done, or 10 million, I'm done. Yeah, well, okay. You're the exception to the rule then, because, when is enough enough? This part of my life, not just because I'm older, but since I started to rebuild my career since 2013, there's an old story about Kurt Vonnegut being in Kurt Vonnegut, the great American writer, who was at a society party in New York in Manhattan. And he just had a best-selling book out, and, he had made a bunch of money with it. And he's talking to one of his friends, and his friend pointed out a hedge fund guy. Said, that guy made more money last year than you'll ever make in your life. And Kurt Vonnegut said, yeah, I've got something that man will never have. He said, what's that, Kurt? Enough. I've got enough. I've got enough. I didn't have enough for the first 10 years of my career. I've got enough now. I don't need more. I got the love of my God. I got the love of my wife. I've got the love of my kids, and I've got the ability to make money. That's it, right? I've got my health, relatively speaking, and that's all I need. I've got nice cars, we live in a nice home. It's not going to, nobody's going to drive past my house and go, whoa, look at that, but it's beautiful. I got what I need. I have enough. And because of that, I'll never wind up driving Uber again.
Really well said, Pax, and I'm just going to stop your share here. This has been fantastic. You already just shared a lot of great bits of wisdom just then, but for traders who are just starting out or are at the very start of rebuilding their process, do you have any advice or words that could help motivate them to put things the right way, manage risk, create a process that, like you said, is repeatable, consistent, and scalable as well? Any last really words of wisdom? Yeah.
You need to be willing. If you want to, 90% of us are going to fail, and I know the odds are against me even at this point. And so like I just outlined, I protect myself from that. So if 2 or 3% of us are going to ultimately make enough money to become free or to have enough. That means that those 2 to 3% of people are exceptional. If I want to be exceptional, I need to do exceptional things. I need to think in exceptional ways. I need to believe in myself in an exceptional manner without ego. Self-confidence and a deep-seated self-confidence is very, very different than I'm Pax and I'll make back that money. Look at me, look at me, look at me. I don't want people to look at me. I want people to look at my process. I want people to look at my faith. I want people to look at something that will motivate them. So find what motivates you. Find your why. What's your why? There's a great line in the movie Cinderella Man when sorry. Where James J. Braddock was going to fight Max Baer, who was a killer. And he was asked in, I don't know if you know the movie, go out and see it. James J. Braddock was asked, why are you going to fight this man? You have no chance against him. And he said, milk. I'm fighting him for milk. So when I started trading again, I don't know why this is making me emotional. When I started trading again in 2013, I blew us out of the water. I pissed away every dollar we had. I had no self-confidence. I had no belief in myself. We got back my first check from my first rebate or what I was owed from MF Global, and we rented a house in Key Biscayne, Florida. I needed to put that money away, but we decided that we needed to figure something out. We were struggling so much that we spent the winter down there with our kids. And my wife was a clerk on the floor for 18 years. When my wife walked into the NASDAQ, she saw a man that, was on top of his game. So she told me, go figure it out. What do I do, honey? We're going to get back a significant amount of money. What do I do? Again, law school again, or therapist again, like I thought earlier. She said, no, go figure it out. You can do this. So I had, I wasn't very faithful, but God was faithful to me. I had no self-confidence, but my wife had confidence in me. My kids looked at me, with love and admiration. And so I had to pick myself up out of the dirt and move forward. So be willing to go through the ringer. Be willing to do the work. Be confident in yourself. Know your why. My why at that point was my kids. Necessity is the mother of invention. I had to succeed because I wasn't qualified to do anything else. I spent my life on the trading floor and nobody was going to hire me for anything. So I had to figure it out, and I did. And I'm so grateful to God that I did. So believe in yourself, deep-seated self-confidence, find a process that's consistent, repeatable, and scalable, develop guidelines and rules meant to protect you from you, live below your means, learn everything you can about your process, the strengths and the weaknesses of your process, and then learn everything that there is to know about you, your own strengths, your own weaknesses, and how do you maximize the strengths of your process? How do you maximize your own strengths? How do you protect yourself from your weaknesses? And how do you protect yourself from the weaknesses of your process? Believe me, my brothers and sisters, your strengths and your weaknesses are in the background, getting stronger when you allow your ego to tell you that you're better than them. So don't let those weaknesses pounce on you because they'll crush you. I let mine crush me. I won't do that again. I wake up every morning and I do the same thing. I work out every day. I pray every day. I love my wife every day. I love my God every day. And I love my kids every day, in spite of my weaknesses and in spite of my shortcomings. That doesn't guarantee success, but it does guarantee that I won't blow up.
Pax, thank you so much for sharing your thoughts and your experience. I really appreciate it. I think everybody watching appreciates it as well. Is there anywhere you'd point people to if they want to learn more from you, learn more about your process?
You can find me on Twitter at Pax Trader 777. So it's Pax was my trading badge at the Chicago Mercantile Exchange. Pax also means peace in Latin. Remember, I was going to be a Catholic priest for 3.5 years in my 20s. So I chose something that meant something that stuck. So Pax 777 on Twitter, or you can go to www.thepaxgroup.org and you can join my group for a few days and see how we trade. I trade in there. When I'm trading, I trade in there. If I'm not trading, then one of the guys that I've taught and mentored, will be trading with there. So we trade live in there. We explain what we're doing, what our levels are, how we trade, why we trade, kind of what we did today, only we do it live. So Pax Trader 777, or you can go to my website, www.thepaxgroup.org.
Excellent. Well, Pax, thank you again so much for this. Let us know what you thought, what your favorite takeaway was in the chat, and we'll be right back with the next presenter. Stay tuned. Thank you. All right, welcome back, everybody. It's my pleasure to introduce the next presenter of the TraderLion Conference, Jason Shapiro. Jason is a futures trader and fund manager with over 30 plus years experience in the business. He's known for his contrarian approach and is the founder of the Crowded Market Report, as well as being featured in Jack Schwager's latest Market Wizards book, Unknown Market Wizards. Jason, thank you so much for taking the time and welcome.
Pleasure. Thanks for having me.
Of course. I think today you're going to dive into some hard-won lessons about what it actually takes to succeed in this business, the things that are actually important. So let's go ahead and dive right in.
All right. So what I wanted to focus on today was what I think are what I like to call the three pillars of a good risk-reward trade, which is clearly what we're trying to find, good risk-reward trades, right? We're never going to have trades that make money every single time, but the idea of what we're trying to do is get into a trade that is going to pay us off a lot while we're risking a little, and over time, that will add up. So the way that I approach those things are, I look at it as positioning. These are the three pillars: positioning, sentiment, and market tone. So let's get into what I mean by those things. This is kind of what we talked about. Contrarian trading can really get you into a good risk reward, type of opportunity. You want to be in something that other people don't want to be in, with the idea that the very broad general idea, if most people are losing money doing this, which they are, then if we can be the other way from what they're doing, then maybe we can capture the money that they're losing. That's the general idea of contrarian trading. It's not quite that easy, so let's get into a little bit, ways to take a look at it. So here, positioning. The way that I look at positioning a lot is I look at the Commitment to Traders report, which is something that is produced by the CFTC every week, and it gives the data as to where different people are positioned in the futures markets. There's three groups. There are commercial traders, who are sort of the insiders, so to speak. A gold miner, that is hedging with futures is considered a commercial trader. And everybody else is a speculator, of which are broken into two groups. One are called the reportables, which is because if you take a certain size in the futures market, you have to report that you have that size on, and that was done to try and prevent people from trying to corner the market. So those become reportables, or what I like to call large traders, and everybody else kind of falls into the non-reportables or small traders. So there's three groups in the Commitments to Traders report, and what I am looking to do is watch them go to extremes. So when commercials are extremely long, and when the large and small traders are extremely short, I'm looking to go the other way, with the thought of, if and when the market turns, all those speculators will need to get stopped out and flip, and it can cause a big move the other way. Right? That's the risk return aspect of it. Sentiment is clear. It can be difficult to measure sentiment. There are some data streams that do so. I don't find any single one of them to necessarily be the greatest thing in the world. But I try to monitor as many as I can. And then I also monitor the sentiment by listening to sort of the financial TV and see what people are thinking and talking about, and seeing where the sentiment is. If there is consensus sentiment, it usually shows up there, because you'll have literally 10 guests come on in a row and say the same exact thing about the same type of asset. And you can start to get a feel for the fact that there is some heavy consensus there, right? And when that starts to then coincide with the positioning, you start to get a feel for where consensus is, right? It should be pretty obvious. If it's not obvious, well, then it's probably not consensus, and therefore it's not what I'm looking for. I'm looking for mass consensus. So that's how I work with sentiment. And then market tone, to me, is how the market reacts to news events. People are trying a lot to trade in front of a news event because they think, oh, CPI is going to be higher than expected. Therefore, this is what the market's going to do. I think that's kind of a fool's errand, to try and predict what these numbers, A, are going to be better than what everybody else is trying to predict. And B, even if you get that right, how is the market going to react to that, right? There's two mistakes that can be made there, right? So I don't really try to predict like that. What I do is I try to see what the number actually is. Okay, CPI came out higher than expected. Okay. How did the market react to that? That's what's important to me, right? And that's what helps determine market tone, right? In general, what you want for a bull market is the market to react very well to what is seen as positive news. And you want it to be able to shake off what is seen as negative news, right? That's what a bull market does, right? And a bear market, obviously the opposite, goes down a lot on what is seen as negative news and doesn't go up very much on what is seen as positive news. So that's how I see market tone. That's sort of reading the tape. So what you want here for a good risk reward trade is all three of these things to be in your favor. Let's say you want to get long something. You want the positioning to show that speculators are very short. You want to be able to determine that sentiment is very, very negative, and ask why that is, right? What is it that's driving that sentiment? And then as the news flow comes out to support that type of sentiment, see the market shake it off. So if the market's been going down, 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 people have been getting short, short, short. People have been getting bearish, bearish, bearish. And here's why. And then a piece of news comes out today that supports that why, that bearish view. But the market can't go down on it. That's the market tone changing. And that's what you want on your side. And that's how you sort of get a nice contrarian trade and a nice risk reward trade. So that's really how I approach it. We sort of talked about this. I will say with the COT, people fall victim sometimes when a COT trade that I might talk about or show or we talk about on our Discord or that works, that all of a sudden COT is some magic indicator. Oh, look how great it got this trade. Isn't it wonderful? We found the magic indicator. It's not a magic indicator. There is no magic indicator. I always look at it as if it is a great risk management tool rather than a great predictor. Yes, a lot of times when market turn, the COT shows that there is mass crowding on one side. That's a fact. But there's also a lot of times where there's mass crowding on one side and the market doesn't turn for a while, which is why you want these other things like market tone to agree first, right? You don't just want to take a long position because COT is showing people very short. That's a mistake. You need this other confirmation from the market tone to really help you decide when that is. And of course, if the trade loses money, you want to stop out. You don't want to just say, oh, well, people are so short, I can just stay long. No, people can stay short and get shorter. Just because this is the shortest that they've been over the last 3 years doesn't mean they can't get shorter. Doesn't mean the market can't go down more and they can get shorter. So just like everything and every trade, no matter how you trade, you got to keep your risk management tight and take your losses nice and tight. I tend to have winning trades somewhere between the 35 and 40% level, but they pay off, multiple times to what I'm risking on the trade. The good thing about it is, for me, because I'm picking turns, so here we have a market where people are super short and super bearish and it no longer reacts poorly to bad news. I get long that day. Well, if it goes through the low of that day, well, then, I'm picking a turn. So if it makes a new low, then clearly it's not a turn by definition. So that's where my stop is. And I stop out and I'll wait and I'll see when the next time, if they're still that short and they're still that bearish, and I'll wait for the next sort of event where it can do well on bad news. You also have times where, let's say a market's going down and people are super short. Sometimes they reduce those shorts as the market's going down, and therefore the COT is not crowded anymore. That can help a lot too. I've had examples of that where, like in the big cocoa run up a few years ago, cocoa was showing that people were max long. And I took a short at one point. I got stopped. And then from then on, they were actually reducing their longs all the way up. So it never got me short again. And the market ended up doubling over 4 or 5 months, right? So again, as a risk manager, it kept me out of that, right? And what this does too is it helps you when you're trying to be contrarian we all fall victim. I always say that there is a fine line between just being contrarian and just being stupid, right? And I have fallen victim to being stupid a lot of times. Hey, the market's going up a lot. I'm not long, therefore I'm going to get short. This helps stop us from doing that, which is so important, right? Because I will not get short unless it shows everybody's long, right? Earlier in my career in 1999, and the second half of 1999, I was trading a lot of stock indices, and I knew that the sentiment was out of control, right? Everywhere you went, people were talking about how much AOL stock they owned, or how much Pets.com, or how much, whatever stock. And I knew it was bad. And I started shorting, and I got run over because the market over the second half of the NASDAQ, in particular over the second half of 1999, went up 50%, right? And this is when I found the COT data, because the COT data did not show that people were at max long levels until February of 2000. So this would have kept me from shorting that NASDAQ all the way until February of 2000, which I can tell you would have helped me out a lot, right? And now as we hear stories about that time period, they sort of coincide with that very fact, right? You hear stories from like Druckenmiller, who says he was shorting these tech stocks, late 99, and he got run over, and then he finally covered them all. And then that's when it topped, right? Well, when he finally covered them all, he's no different than most people, right? They probably all panicked and got out of all their shorts. That's exactly when the COT showed that now people were max long here. So again, it can be, yes, it can help figure out where markets are overcrowded and have a good chance of going the other way, but it can also help stop you from trying to be contrarian when really all you're doing is fighting the tape, right? We don't want to fight the tape. We want to be contrarian if we're trying to pick market turns, but we don't want to fight the tape, and fighting price will fight the tape. This at least makes you wait until there's massive amounts of participation involved, and therefore the risk changes. I make the assumption that risk changes based not on price, but on participation. So this is what the COT is trying to measure, where the participation is. And look, markets move by money in and money out. So if all the money is in, and clearly there can be all the money, but relative to history, all the money is in, then when it starts going down, all that money's got to come out, and that's when the market goes down, right? So that's what this really tries to do.
And can I jump in with a quick question?
Sure.
Before in the 90s, before you were using the COT data and developed the edges that you use now to look for, edges in the positioning of COT, what process were you using to determine, all right, now is the time to go long or go short a certain market?
I was doing what most people do, you know what I mean? Looking at charts, looking at breakouts, trying to get a feeling for sentiment, trying to find individual people who I thought were wrong a lot and try and fade them, stuff like that. But I wasn't had a disciplined system yet put together like I have since 2000. I've been doing this process since 2000. So
Gotcha. So still contrarian, just using different techniques.
I tried to be contrarian, but like I say, I was guilty of the stupid side,
right,
and the fighting the tape side, which we fall victim to, and that's what this helped me do a lot. If nothing else, it keeps me away from doing that. Oh, the market's up a lot. I mean, we fall victim to this all the time, right? The market's up a lot. I missed it. Therefore, I'm going to try and catch it on the short side, right? I was guilty of that. I'm sure other people are guilty of that. And this can help us stop doing that. I can remember when Alan Greenspan came out and said the market may be suffering from irrational exuberance. I had been shorting the market then for that very reason. It was going up. I was missing it. I thought it was stupid. You justify it in your brain. Oh, this is stupid, right? Alan Greenspan came out and said that there could be some irrational exuberance. I was ecstatic. I was like, me and Alan Greenspan are the only people in the world that understand what's going on here. And the market closed up that day.
Yep.
That's the market tone talking, right? If the market can close up that day, well then, what are you going to do? It's clearly not time.
Right.
So that's the benefit of sort of the market tone thing as well. And this was way before I even looked at, so knew what COT was. So I wasn't even looking at that then. So that's sort of the positioning thing. Here's some examples. So what we do here is I take the COT data and I index it, over time. It's just like an RSI type of thing, right? So when the commercials index is above 95, indicating the commercials are very long, and therefore the speculator index will be below 5, indicating they're very short, that's when I'm looking to put on a long trade, right? So you can see this is the chart of the COT, whereas this is just the index level of the COT, right? So in this case, I would be looking to either get long, the Russell or the S&P at that time, right? Correct. So it was a bullish setup down here, right, on the S&P, and you could say, oh, well, I don't see that the commercials are super long, but when you index it, because it's coming off of these where they were super short here, right, it shows as a long trade. So now we're waiting for a confirmation, and we know that the sentiment was bad there because of the trade thing and all that. And on this particular day of the low, it was a Monday, there was again negative news over the weekend about trade, and you can see that the market opened down here, went down a lot, rebounded and closed up on the day on what was bad news over the weekend on the trade stuff, which was the center of the bearish argument. So we have the COT set up as a buy, with the sentiment very bad because of this particular news. That news was confirmed, and the market closed up, so I got long there. Okay, and I am stopped if it takes out that low, because then obviously, like I say, if I'm picking a turn, well, it takes out that low, I didn't get the turn. It helps me define where is this trade wrong. It's very difficult to help you define sometimes where is your trade wrong. Well, with me, if I'm picking a turn and the market makes a new low, well, then it's not a turn, so it's wrong.
Right.
I know where I'm getting out, which helps a lot because I know where I'm getting in. I know where I'm getting out. So I know how much I'm risking for that trade. I know how much I want to risk per trade. So I know how to size my trade so that if I'm wrong and if I get stopped, then I will lose that amount on that particular trade. And then that's it. That's all I do. So I buy it there. I'm either going to get stopped on that low, or I'm going to ride it, and I'm going to get out when this positioning goes neutral, right? That's how I do it, because I think that if the edge is everybody is short, then when everybody goes, when it's neutral, there's no more edge, right? My testing has shown that it's more profitable over time once you have one of these running trades to just sit in it all the way until it goes the other way and everybody gets super long. But what I have found is once it goes past neutral, the volatility relative to the extra return you get in that period goes up a lot. So that's not what I want to do, A. And B, as a portfolio manager, what I offer to my clients is, a lot of them have trend following type of systems in there. And I have this counter trend thing. So I'm offering them negative correlation to the rest of their portfolio. So at the point that the position goes neutral, by definition, it means the trend followers are getting long. So they don't need me to put on that trade. They have their trend followers to put on that trade, right? So the trend followers would have been short. They would have lost money. I would have been making money while they were losing money. As they're getting long, I'm getting out. That's basically my contrarian method.
And can you show in the COT plot what that transition back to neutrality would look like, just to make it really clear for someone who's maybe a little bit more new to interpreting?
It goes based on this oscillator that gets calculated, every week, based on what the data is saying. And when that goes to 50, right, then that will be neutral.
Gotcha.
And I'll get out. Pretty simple. I always like to put this one in there because it was arguably the best trade that I ever had in this process. This was the Swiss franc in 2015 that blew a lot of people out at the time. But you can see that this commercials were at record longs at this point, right? These guys were at record shorts. So I'm looking to get long. On this Friday, there was a reversal day in the Swiss franc on what was a day where the dollar was actually up against all currencies. And for some unknown reason, the Swiss franc went up. So I had bought it on that Friday close. Lo and behold, over the weekend, the Swiss announced they were going to decouple from the euro. And the Swiss went up, I don't know, 25 points or something like that. I couldn't even believe it when I turned on my screen Sunday night. I thought I was looking at the wrong contract or something like that. I was like, there's no way that this can be the situation, right? But fortunately it was, and then you see very quickly, this stuff goes back down to neutral and I'm out, right? So I didn't get out of the top, but I was out somewhere around here, right? So that just shows not every trade works like this. Not every trade works, period. But it shows the type of thing that can happen. You can argue that, hey, there's no way I could have known the Swiss were going to do that. And you're 100% right. There was no way I could have known that the Swiss were going to do that. But there's no way I can know what CPI is going to be. There's no way I know what anything is going to be. I don't have, unfortunately, the ability to see the future. Unfortunately, if I did, this would be a hell of a lot easier. But what I would argue is that if you look, at the end of the day, the Swiss went right back to where it started, right? So the news actually meant nothing. And this isn't over a couple of years. This is over like a few months. It went right back to where it came from, right? But this move occurred because so many people were short. They had to cover, right? So they got squeezed. There it was. I'm out. And then it went right back to where it came from anyway. So I would argue the news really meant nothing. Other than it forced people to get out of it. And there were so many people caught short that it had this huge move.
And just to say it another way, the positioning created the setup, and then the divergence between what the dollar did and what the Swiss franc, the expectation the Swiss franc would do, and then it did the other way. That was the trigger to say, okay, this is the tell, this is the time to enter a potentially strong risk reward trade. Is that right?
100%.
Yep.
So that's positioning. So sentiment we kind of talked about, it just kind of helps, like it says, give additional confirmation as to the general feel out there. There's a few things that I put on here, for stocks, the AAII, the CNN Fear Greed, right? Covers of magazines, listening to the financial news and hearing what these people are saying every day, helps us determine what the general consensus sentiment is, if there is consensus, and B, what is driving that sentiment, so that when we're looking for the market to go up on bad news, we can determine what the bad news is, because all these people have been talking about exactly what the bad news is, right? So they're like, oh, the dollar is going to go down because of the trade war or whatever, right? And then when that happens, we now watch how the market reacts to that, right? So that's what's important about sentiment to me, is not just determining what the general sentiment is, but what's driving that sentiment, so that we can then sort of see where the market gives, as you said, it tells, right? Or it acts in a way that wouldn't be expected. What would be expected? Well, figure that out by listening to what the general sentiment is saying about that type of stuff. So I think that's what's really important about the sentiment, to me.
And is it harder to kind of create an objective measure of sentiment, because there's all these different sources. There's what people are talking about on financial news and financial Twitter as well. But there's all these different sources, and it seems hard to sometimes see when it objectively is extreme, because it can get extreme and they get even extremer. So how do you kind of rationalize that?
Yeah. Well, that's where the positioning comes in,
right?
Just because I'm reading the sentiment, you're right, I can be biased, right? If I want to be long, then I'm going to hear all the sentiment is negative. But that's where the positioning comes in. Like I say, as a risk manager, it won't allow me to do it unless the positioning is there.
Gotcha.
Right? The sentiment to me is more about listening to why the sentiment is that way. What is making you bearish? Well, this. Okay, good. So that I I can trade off of, when this does happen, and the market doesn't confirm that, right? That to me is the most important part of sentiment.
It helps you find the narrative that could be the tell that you're looking for. Exactly. Gotcha.
Exactly. And there's a lot of ways to look at sentiment. This was the stock sentiment at the lows, right? The AI survey, was horrible, right? Barron's S&P just said 6,000. Start worrying, these were all off a FinTwit, but every one of these people was bearish down there, right? So this is just a general kind of sentiment stuff. You get it all over. Twitter's a tough place, quite frankly, I have found, for sentiment. I thought maybe when I got on Twitter it would help, but there's so many people and there's so much going on there that to me it's not that great. But it's all just a question of keeping your eyes and your ears open, reading a lot of stuff, listening to a lot of stuff, and starting to get a feel for that. And like I say, a feel for why. Not so much what the sentiment is. Well, I mean, yes, what the sentiment is, but what is driving that sentiment? Why are people so bearish, right? So there is some other sentiment stuff here. So this was the dollar. This is a fun one, because you think about where the dollar is now as we speak in July, right? We just had 6 down months in the dollar, and the sentiment has gotten very, very bearish dollar. We are now told that the whole world is going to liquidate their dollars, and it's, they don't want to be so much in the dollar anymore. But if you go back to January, the sentiment and the positioning on the dollar were at massive extremes, right? This U.S. exceptionalism thing at the beginning of this year was off the charts, right? And everybody loved the dollar, and the positioning was so long dollar and short all these other currencies. And these are some examples where you could see that was all over the place, right? And so I was looking at the time to get short dollar. What ended up happening was we got long the British pound, right? And funny enough, at the time, the idea was that these trade things were going to be bullish dollar and bearish these other countries, because he was going to put up trade barriers with these other countries, and that was going to be bearish for their currencies. So what happened on the particular day was they came up with this trade stuff against England, and the pound was down. The pound was showing, again, in the COT, that people were maximum short the pound. And the pound closed up on that day. And so that was the trade.
So another news failure. Exactly.
Right. It was right there. And you can see here, it was actually right there, but you can see where the commercials were super long here, right? And we kind of caught that trade from about here until it went neutral, which was somewhere around here. So it was a decent trade. In particular, relative to the risk, it was probably like a 6-to-1 trade, right? So that's how that works. And then, we talked a lot about market tone already, how it reacts. This is what they used to call tape reading, right? And this is nothing that I invented. You hear traders talk about this all the time. How does a market react to the news flow? I think that is what is most important for anybody that is trading to help determine, right? You don't want to trade anticipating news, as I was saying before. I think that's a fool's game. You're not going to predict the news better than other people, right? But the market gives you the tell, right? What is the news? It's easy to see what the news is. It's pretty easy to determine whether the news was bullish or bearish. Now let's see how the market reacts to that, right? That to me is the most important thing. And that's what market tone is all about, right? So I use that as my confirmation. I call it news failure confirmation. So people are super short, people are super bearish. Here's why. News comes out, confirms their bearish views. Market goes down, closes up on the day. I bought. The market tone is now good, right? And that's how market turns happen. A lot, not every single time, but most of the time, markets will bottom on bad news and they will top on good news, right? It's just a question of, we're always trying to figure that out. Where is the news already discounted in? That's our big question, right? As a trader, where is it discounted in? Well, positioning helps determine that, but market tone and market reaction helps determine that too. Here, we just had the best news that could possibly come out and the market didn't go up on it. Well, that helps us determine that maybe the good news is already discounted in, And it's like, well, what if there's more good news later? Well, true. We don't know. There might be, and the market might go and take out the highs and you get stopped, But this is a very, very powerful tool, watching how markets react to news over time.
Are there any other great news failure examples that come to mind that people should go back and take a look at and study? Or you've got some examples. There you go. Perfect.
Here is the S&P trade in April. Negative tariff news came out over the weekend. Market gap down and finished green.
Mm-hmm.
We know that April was all about the tariffs. We know that was the defining bearish news event for what was going on in April. And we got it. We got more of it. And the market shrugged it off and went up that day. There it is. If you look at I don't think we have it on here, but if you look at the very bottom in the stock market, well, not the very bottom, but the bottom after the 2022 bear market, the big thing in 2022 was inflation, right? Everyone thought inflation was going out of control. The Fed was raising rates pretty aggressively to try and get that under wraps. And CPI came out in October. It was the largest CPI print that we had seen that entire time. The stock market went down on that, as it should have, and then closed up on the day. And that, to this day, was the beat-ass low of the market. So I think that was a great one that people can go look back and see. I can obviously give hundreds and hundreds of examples because every one of my trades has a news failure like this. But that was a big one. And I know people trade mostly the stock market. So that was definitely one that you can check out.
And for each market that you trade, there's kind of, it's not always the same narrative, but there's some narrative that going on that could potentially cause the news failures, the narrative that's relevant during that time. And to do that, you just kind of need to be paying attention to those markets, judging the sentiment, judging what people are talking about, like you said, and then just paying attention when you've got that news failure, when the positioning is set up where we could have a big shift back one way, basically.
Absolutely.
Yep.
Yeah, unfortunately, you have to pay attention.
Yeah. Well, we got to do the work. That's unfortunate.
It's an unfortunate part of it, but yes,
yep.
You do. And over time you get better at reading the sentiment and hearing the sentiment and starting to understand. Like I say, it's more like you pointed out, it can be dangerous because you can bias your read on the sentiment. The COT and the position will help you with that, but also it's not so much about the sentiment. Like I said, it's more about what's driving the sentiment, and therefore, where can you find these news failures?
Yeah.
It's just another example. The trade we did recently. This was the yen. Back here, and you can see that the commitment of traders got out of control. This is the longest people have ever been yen throughout history in the COT data, right? So at that point, I'm looking to get short. All right. So we had some bullish news on the yen. Yen tried to go up, failed. It closed down, get short against that high. This has not been the greatest trade of all time. As of today, it's a little bit lower. It's probably down here somewhere. Hasn't been the greatest trade, but on a risk reward basis, because the reversal day was such a small day, and because I'm sizing from the difference between my entry, you can see how many times, like even down to here, this was probably 7 times at this point what we had risked. Right now, that came back on us and all that, but we're probably back down there again. This trade has not been the easiest trade. It's not been the greatest trade, but it's worked. So far, I'll take a winning trade over a losing trade any day, obviously. I never know, I'll tell you this, the path of these trades, the COT does not help with. I've had many trades that I put on that have just gone straight in the money very aggressively, very quickly. and that's always wonderful because there's no pain. But I've also, like that Swiss franc trade, it was literally the next day. But I've also had trades that have sat there and have gone nowhere for a while and never stopped me out. And then, a month or 6 weeks or 2 months later, then they've gone in my favor very well, So the path this doesn't really help with the path. So, and those are just the winning trades, of course. I've also had plenty of losing trades, right? But this doesn't really help with the path because I think the path is driven more by, it ends up being the news flow, right? We haven't really particularly had any bearish news on the yen this entire time, right? So it's hard for the market to then, kind of really make a huge move down here. But the fact that we haven't had any negative news and the yen has not made new highs, whereas all of the other currencies have, the euro, the Aussie, the Swiss, whatever, the British pound, whatever you want to look at, they all made new highs. And since this time, and the yen has not, despite the fact that there has not been any negative news on it, it's encouraging. Which again, is a market tone type of thing, right?
Does the trend of the particular market before the news failure impact your decision making at all, or it's really just you're agnostic to that and just watching for that news failure?
Yeah, it's the positioning that drives it. Now, you can argue that trend drives positioning. There's nothing like a market trending up to get people long, and nothing like a market trending down to get people short, right? But not always, not always. It's surprising. Right now, we find that there's huge short positioning in the Russell.
Mm-hmm.
Are we going to call the Russell trending down right now? I don't think we can say that, right? But people are selling into it.
Right.
Which kind of goes along with the narrative, because the main narrative, I think, right now driving at least the bull side of the stock market is the AI narrative, right? And the AI narrative is be long tech, be long the people that are going to win the AI war, right? And be short people that are going to lose the AI war, which for the most part would seem to be smaller companies that can't afford to keep up with this AI war. And that would be the Russell. So that's what we're seeing here in the positioning right now is people very short Russell, even though the trend really is up, that doesn't happen a lot, but it does happen. And truthfully, that's a great thing because there's nothing better than a trending market that people are short, right? You think about, is there a difference between a market that's trending up that everybody's long and a market that's trending up that nobody's long? I would argue that there is. From a risk reward basis, I would argue you'd rather be in a market trending up that nobody's long than a market trending up that everybody's long. And that's kind of what you see right now in the Russell as of today. So that's kind of it. That's what I do with these three things, It's all about the risk reward, and the risk reward gets helped by all three of these things, If you can see the positioning one-sided, if you can see the sentiment one-sided, and if you can see the market acting in a way that is against those things, like you say, it's a great tell, right? And people have a tendency to fight it, right? Oh, this market's going up. It's stupid. Look at all the bad news. Well, it's about making money. It's not about being smart, and the market is telling you with the market tone that it's going up despite bad news, and everybody's short and everybody's bearish, you can see why that would help you to really get a good risk reward trade on. I'm not saying these are easy trades to make, because contrarian trades are not easy trades to make, because you are fighting the news flow. You are fighting what everybody is saying. You are fighting it, but what you're not fighting is the market, right, which is the last thing you want to fight. You can forget all this other stuff. Just the market tone alone, you don't want to fight, So this puts all three of those things, hopefully, in your favor. And over time, it helps. It's done well for me, but, it takes a little bit of getting used to and a different kind of mindset and all that. But, I think these are extremely important things to be looking at one way or the other.
Yeah. And I think what's also great about this that is really critical with an edge is you've got a defined level where you're wrong and you exit which is not too far from your entry, and you've defined that loss for yourself. The high of the day for a short trade, the low of the day for a long trade. And for people who maybe haven't watched the previous interviews and stuff we did, is the entry right near the close on the day of the news failure? Is it the next day as it confirms? How do you typically place your trade?
On the close of the day of the news failure.
Yep. And then you're defining your position size by the total amount of your portfolio you're willing to lose at that point, and then just doing the calculation of the number of contracts to buy. Is that correct?
100% correct.
Yeah. Would you mind just running through a hypothetical example of, say there's a news failure, you want to go long. How would you typically size that if you've got an entry at 100 and a low of the day stop at maybe 95, just to make the math easy?
Okay. So let's say it's a stock, just to make the math easy, right? Instead of dealing with the futures math.
Sure.
So I buy the stock at 100 on the close. My stop is 95, so I'm risking $5. If my portfolio is, $100, then I'm risking 5% on that. I personally risk 70 basis points on my trades. Everybody has to choose what level of risk they are happy with. I have picked that level because that is what has shown to give me a volatility target in my return stream that I'm looking for. Some people have higher risk tolerance. Some people have lower risk tolerance. I tend to have a very low risk tolerance. I manage a decent amount of money, so my returns don't have to be, I'm not shooting for 50, 60, 80% returns a year because I don't want to suffer the type of drawdown that it takes to get to that, right? I'm targeting, returns in the 15 to 18% area without having a 5% drawdown.
Right.
Has been what I'm going for. So that's where my risk tolerance lies, but everyone's got to sort of decide what their risk tolerance is.
And to determine that 70 to 80 basis points, did you look at what your typical batting average is on these trade and calculate your expectancy? What kind of research went into deciding that?
Yeah, we all started with some back testing. And then from there, now I've been doing this for 24 years, the same process, 25 years this year. So I'm able to also use live returns now as well to make sure that that's where the target is.
It's funny because
I review it every quarter, every 6 months to make sure that my volatility is where I want my target to be.
It's interesting because I talked to Peter Brandt the other day, and his also target risk per trade is 70 to 80 basis points. So it's interesting you guys both arrived at that number. And, he did he looked at, sequence of returns to based on his batting average, how many losses could he have in a row, and arrived at that pretty much same number. Looking at your edge, the COT data, are there any common mistakes that you see traders make who are trying to learn your process that you might mention to help make their learning curve a little bit shorter?
What I have seen, because we started this crowded market report, people have joined, we have a Discord, so there's a lot of active members. I don't encourage them to copy trade what I do. I encourage them to take pieces of what I do to help them in what they do. But some of them do put on similar trades that I do. And so I'm able to witness exactly what you're talking about. What I find is the mistakes that people make in this are similar to the mistakes people make in just about all trading, which is they overtrade,
Yep.
They see the COT is set up. The last COT trade worked great. Therefore, they want to put this one on, and so they're front running it, or they're not waiting for the news failure, or if the news failure happens, they put it on, but if it gets stopped, they don't do the stop because they don't, you know what I mean? The same kind of mistakes that people make throughout all trading. This whole thing is about discipline to the process, right? One of the reasons that I do encourage people to not copy trade me, there's many reasons why I don't think it's a good idea. But one of the reasons is they are not used to the discipline that is necessary to do. I've been doing this type of trading now, like I say, for 25 years, right? I've made a ton of mistakes. I've learned the lessons, at least I hope so. And you know, they probably are not. And then that sets you down a whole spiral of, you know what, right? You know, you take this trade, it doesn't work, you don't stop out, you lose more than I would have. Okay. The next trade you take, you lose. Okay. Third trade you take, you lose. Okay. Then the fourth trade you say, oh, this sucks. Shapiro sucks. This whole process sucks. So you don't take it. That ends up being the one that works.
Right.
Now you've lost 3 trades, one more than you should than I would have. I've lost 3 and made 1. I'm up 1%. You're down 4%. Right. So already there's a 5% gap. Right. So the next one you say, oh, maybe this is good, but I'll just double up on this one. And then, you know, it loses. And so now you're down 6% and I'm flat, you know. It spirals. This is the problem with copy trading, from what I have found. One of the many problems with copy trading, right? I don't make those mistakes because I have so many years and so many trades of doing this. I am comfortable with the fact that they don't all work. I know what my risk is going in when they don't work. And I am comfortable with the fact that I have a 25-year record of these, and I feel comfortable that over time it's going to do what it has done to this point. So I can be a lot more disciplined about it.
How and speaking of what you just talked about, do you take pretty much every news failure that happens if you've got the capital? And how often are you have pretty low exposure in the market? You know, if there hasn't been a news failure trade recently, so it'd be interesting to hear how exposed you are to the market at any given time.
Yeah, I have between like sometimes 0, but usually between 2 and 5 or 6 positions on at any one time. If I have a lot of positions on, like 5 or 6 positions on, that's usually a good thing because it means that a bunch of them are sitting in the money. But yeah, there's not a lot of these trades. I mean, how often does a market really have a significant term, right? But that's why I spread it out. I trade like over 37 markets, so all the same way. I always say I look at it like I'm counting cards at a blackjack room. I have 37 tables that I'm counting cards at, and when one table gets hot, that's where I go to play.
And speaking of that, is there any way that you've set up to kind of judge the potential of a news catalyst? Or like you said, you don't really know how it's going to work out. It might work right away, or it might kind of fluctuate and then work. But are there any factors that you found looking back at your trades that increases the potential for a bigger move?
Not really. Not really. I've done a lot of work. I had a quants working for me full time for a number of years, and we would look into this and that. And every time a trade happened and worked or didn't work, we're always looking into, could we have seen that better or not? And if we're sized it differently, size this one bigger because it had a higher potential. And we really never could find anything that over time stood the test of time. There's a lot of luck involved. You're just getting yourself in a position to get lucky. Like I say with that Swiss franc. Did I know that the Swiss bank was going to come out over the weekend and make that announcement? No. But I was in a position to get lucky there,
Right.
Would it have happened if they didn't make that announcement? We'll never know. We'll never know. But it's all just about putting on, a high risk reward trade and hoping for the best over time. If you can just keep getting into these good risk reward trades over time, then over time it should work out.
Yeah, this reminds me a lot of maybe my favorite quote that when I talked to Peter, he mentioned, I don't trust my next trade. That's why I manage risk, but I trust my process. And then you just execute that process, and over time, based on, targeting strong risk reward trades, it will work out. So that works out completely. Jason, thank you so much. Yeah,
listen, that's what this game is all about.
Right.
And I think that's what people miss. I really think that's what people miss. Most people, they think this game is trying to predict the future, predict where the market's going to go. And I think that's the biggest mistake people make. This game is about getting into something that offers good risk reward and doing that again and again and again. Taking the loss, riding the winner. That's what this game is, nothing else. So how you want to determine how to get into a risk reward trade, that's the next level. This is how I do it. I hope that this can help people. But, other people do it other ways, clearly.
Exactly. I mean, I'm a growth stock trend follower, but I've got my own edge, my own setup, my own and my own way to manage risk which is also at the low of the day. But my setup is completely different from yours. My market is completely different than yours. But we're both doing kind of the same thing. So, Jason, thank you so much for your time. Any last bits of words of advice for people either learning to trade, based on your COT data methodology, or just trading at large?
Be humble, be disciplined, because if you're not, you will be eventually. The market will humble you and force you to be disciplined. So, I think that's the most important thing people can do.
Great. Well, Jason, thank you so much. Where can we point people to if they'd like to learn more about the Crowd Market Report? Is it crowdmarketreport.com? Is that the right address? The URL?
CrowdedMarketReport.com. You can also go on YouTube and look up Crowded Market Report. I do a lot of free videos on there. Try to do at least one video a week on the weekends. I don't know how many hundreds are on there now, talking about all kinds of different subjects about trading. And then I do a daily video as well, just kind of a market recap video looking for these type of things. How did the market react to the news? What was the news? How did the market react? What might that be saying? That's what I focus on. I'm not here to do what everybody else is doing. The CPI came out and I'm trying to focus it on these three things: positioning, sentiment, and market tone.
Excellent. Well, Jason, thanks again for your time. For everybody watching, I hope you enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel, and we'll be right back. Stay tuned. Thank you. All right, welcome back, everybody. It's my honor to introduce the next presenter of the TraderLion Conference. We have Deepak Uppal, who is a full-time trader and two-time top performer in the U.S. Investing Championship, both in the standard division as well as in the Money Manager $1 million plus division with triple-digit returns. Fantastic to have him back again. And today he'll be discussing and presenting on positioning for outperformance, unlocking the keys of those triple-digit years. So Deepak, thank you so much for joining us again today. Really loved your presentation last year on risk management. We'll probably link that down below. I think that's fantastic. And looking forward to this year's presentation as well. Welcome.
Thanks a lot. Appreciate it. Love being here. Love joining everyone, and hopefully can share some knowledge and that's useful for everyone that's listening and watching.
Excellent. Let's dive right in.
All right, perfect. So positioning for outperformance is kind of what the title of the presentation is, and that I want to talk about. Just for everyone, my X handle is down at the bottom. I put it in here just so you can see what it looks like with the check mark, because I've heard that there's a few imposters out there. So if you do go to my X site, or to go to X to see what I'm saying, just make sure it's really me and not an imposter. But so what I want to do is talk about a little bit, just give everyone a little quick background on myself. You kind of already gave a little bit there, Richard, but just for folks that don't know me, or it's the first time you're hearing me, I've been trading for over 30 years, and as I've said in the past, I learned the hard way to trade. There wasn't a lot of info out there on learning how to trade the right way, and so I did everything in the book that you can imagine, trying all sorts of strategies, bumping around into options and all sorts of things to try to make money and find an edge. And it took me a long time to get there, and I think these days it's much easier with folks like Richard and TraderLion. There's a lot of good content that's out there that you can leverage. My background is not professionally trading or anything like that. I was in management consulting and software sales for a number of years, and this was kind of a side hobby for me that I wanted to learn, and got totally engrossed in it, and took up most of my time when I wasn't working was to try to figure out how to trade better. I became a full-time trader in 2023. As Richard said, I since I was doing that, I decided to put my skills up against all the other great traders, and joined the U.S. Stock Investing Championship. I did the $25,000 and above accounts the first year in 23, and I had a 259% return. Came in 5th place. And then in 24, I decided to do it again, and did the Money Manager division, which was $1 million accounts or higher, and I came in 3rd place with a 157% return. Also, I've done a few things. If you find this presentation interesting, there's a few more that are out there that I've done with Richard over the last 18 months or so. You can watch them. These are the ones after the U.S. Investing Championship. I did a presentation of how I did the 259% return. Last year, I talked a lot about risk management, so I think will dovetail into kind of what I'm talking about here today really well. And then I just did another one earlier this year, I think, on how I make triple-digit returns in the stock market. So if there's any interest, you guys can go search that and dig that stuff out as well. I've heard this question a few times, so I figure I would just kind of put it out here right before we begin. I use a few services, right? And I would say that everything I present is not stuff that I've kind of created on my own or discovered or whatever. I mean, it's kind of a mix of what I've learned from all these folks. Mark Minervini, Marcus 360. I'm a subscriber to those guys, and Mark have been for a few years. Chartpattern.com, also Dan Zanger. Have learned a lot from that site, and I'll talk a little bit more about it as we get into it. Stock Market Mentor, I've been with Dan Fitzpatrick for many, many years. William O'Neill with IBD and Market Smith, and then more recently with TraderLion. You guys have some fantastic content that's out there. Great videos and things to learn from. And the reason I selected these, these are the ones that I subscribe to and pay for, is first of all, it's a great education source. They all provide education in a little different ways, so you can always find something that I think connects with you in terms of how you trade. There's access to online tutorials and classes. Some are free, some you have to pay for. I think the knowledge base is incredible. They also provide stock picks, there's only so much you can do on your own, and if you've got other people that are out there also looking at charts and patterns and things like that, you never know, maybe you overlook something. And I get some great stock picks from any one of these sites. And then the other thing they provide are great tools, whether it's charting, analytics, screening, journaling, all those things. And so there's a lot of great content out there. I don't use all of it from all of them, but there's certain things and pockets that are very, very useful to me and help me in my trading day to day. And I would say my trading style is not any one of these folks' trading style. I mean, it's probably a mix of all of them. And that's just, I think that's kind of what I'm going to talk about a little bit, is that I think was one of the hardest things for me to kind of figure out. I was just trying to copy everyone. But it's really, I don't think that is very possible. Like, I'll never trade like Mark or Dan or anyone else. So you got to figure out your own style. So when I talk about factors for outperformance, I kind of thought long and hard about this, and what are really the key things that were difference makers that helped me turn around my trading and allow me to trade well and consistently. And these are the four things that I thought were the most important: psychology, stock selection, portfolio concentration, and knowing your math. I think out of all these, I think the one that's the least important is probably stock selection. It's important, but I don't think it's as important as the other three. And so, I'll walk you through that and kind of give you my thoughts on why I say that. So when you talk about psychology, I think that's the real edge in trading, right? It's really about self-discovery, and that's key to figuring out what your trading style is. And, I used to trade and I'd do things, and I would, go on a walk or something. I'd be sitting there thinking about well, why did I do that? What was the reason I did that, right? And it came down to a lot of these key areas, I think, and it's a great thing for you to kind of take these and think through yourself and kind of how and I'll walk through them each. Like emotional control, how do you handle your emotions? Whether it's, in terms of if you're panicking, how do you handle that? Or euphoria, how do you handle that, right? For me, it was something that I was like, when there's a panic situation, I'm okay, I stay calm. But I have more of an issue in the euphoria side, right? When things are moving up, I just get too excited, and you kind of lose where you are in the market and what the stock's done, and you think it's just going to keep going. And so that's an area that I work on myself and try to figure out, how do I control that in my trading. Discipline is another one. Are you good at being disciplined? Do you follow your plan? Do you avoid over trading? Do you wait for your, do you have the patience? Do you wait for, the great setups? And do you have the patience to let winners run, right? If you see that the stock is doing really well, do you have the patience? Once again, patience is not my forte, if you will. I can wait, but I definitely have a problem with patience. And so part of my trading strategy, I had to account for that, right? In terms of the way I trade. Ego, I'd say in general, I'm pretty good at this. I'm pretty open, pretty flexible. I don't really dig in my heels when the market is saying, it's not gonna, it's going down or something. But that's not always the case. Sometimes that ego does come into play, and you have to figure out how to account for that, or how to work with it or work against it. Risk acceptance. How good are you at taking losses? They're part of the game. Are you okay with losing 4%, 3%, 2%, whatever your risk is? Are you okay with that sale, or do you feel like you have to go back and Monday morning quarterback that loss, and it just kind of eats at you? Adaptability, evolving with the market. There's been a lot of talk right now about this V-shaped recovery we've had since April. People just didn't believe in it, right? If you didn't believe in it and you were kind of like, well, the market's going to turn down again, you're now maybe under invested, right? And you're trying to figure out, well, how do you catch up? So those are the things that, can really kind of hurt you if you're not able to adapt to the changing conditions of the market. Managing fear and greed, balancing your mindset. That's, I think, very, very important. And that's, I think, as humans, we all have an issue with that one. I definitely have an issue with the fear and the greed part of it. Mine's more on the greed side. And so that's something I work on and continue to work on every day. And then growth mindset, I think that's the main thing, like, learning from your losses, and then really, like I said in the beginning, reflecting on your behavior and reviewing your behavior. Like, in that situation, if there's a gap down, how did you act, or how did you behave on that? Did you freak out? Did you have your, process in place and you just kind of took the loss and moved on? Or, are you now still going back and looking at that stock every single day and kind of figuring out, like, why is it moving up? I missed it, or whatever. Those are the things you need to go back and really kind of analyze in terms of your own actions and your, how you were feeling at that moment. And, it's a great thing to do is just write down, okay, this was my mental state, or this is why I did this. And, just keep a track of that. And then you can go back later on and review it. So, I am a true believer that, your trading style is really based on your personality, and you really can't imitate others. I was just trying to follow others stock trades and try to trade like them, and I just couldn't do it because I didn't have the patience, or I wasn't a long-term trader, etc. So it took me a while to figure this out, and I think this really is a key to being a successful trader.
And are these lessons things you need to learn through experience, or do you have any recommended resources or ways to help newer traders who haven't been trading as long to internalize these and really recognize that this is true, and they need to work on their trading psychology?
Yeah, I think it's for everyone. You don't have to be a new trader. You could be a new trader and you just need to think through, okay, in general in life, how do you handle emotions? How do you handle your emotions? Do you just go off the handle, or are you calm? And then, as you've been trading, you got to reflect back in the market. Like, how did you act? What were your emotions, and how did you handle the, like in March, the big downturn in the market? Were you calm? Did you freak out? And those are the things you need to go back and reflect on and figure out, like, okay, if this kind of stuff happens, how am I going to handle that, right? And you have to create a strategy where if something like that happens, it doesn't blow up your account.
Yeah, or the deep sea gap down or something like that. Yeah, exactly.
Exactly. So those are the things that I think, if you've been trading, or even if you haven't been trading, we all have, this is all our own emotions and psychology and daily life. So you can reflect on that, because if it happens in your daily life, the chances are, it'll move over to your trading as well. So, based on that, my trading edge and kind of what I've figured out based on my own experiences trading, right? Here's kind of what's working for me, or has worked for me over the last few years. Number one is, I like to buy high price stocks, $75 or higher. Because I can't stand the volatility of lower price stocks, right? It's just too much for me. Not to say that these can't, but they're probably a little less volatile than some of the $10, $15, $20 stocks. I want to keep my losses at 2 to 4%. I want to try to get a 6 to 10% return on a trade and sell it. I'm not trying to find the next stock that can double. That's not my edge. My edge is, obviously, if I'm holding a stock and it does double, that's great. But I'm trying to get the sweet spot, if you will, of stocks that'll move 6, 8, 9, 10%. Take that and go find the next one. I want to focus, mainly, I've over the years just now kind of just been focusing on the T triple Qs. I invest in the index quite a bit at various points. And then I also want to just select the few leaders in the few industries that I follow. And those are kind of my focus areas. And I try to stay, 95% of the time in that lane. Also, for me, I think what works for me is I like to concentrate my portfolio on stocks that are leading and move like a large dollar amount. So to me, that's just kind of my personality, I guess. I could not hold like a $50 stock for 3 months and have it move up $8 in 3 months. That's just, I don't have the patience for that. And so for me, I'd rather take a stock like that's, $200, $250, concentrate in on it because I think it can move 10, 15, $20, and then size it appropriately, get in at the right time where I've got a limited amount of risk and, see what it does. Try to trade as close to the danger zone as I can. And sometimes that means you may trade in and out of that a few times in a day or in a week just to get yourself positioned in that stock. So you have to be okay with that. And that's something in my personality where I don't mind watching it and keep trying to enter it without taking any large losses, right? I'm talking like less than 1% losses. I'm trying to get myself positioned in a particular stock. And then I tend to turn over my trades faster. Once again, this is just more around my patience. The other thing is, I try to keep my routine as simple as possible. I'm not super detail oriented. I don't like to use too many indicators. Don't listen to the experts or anything. I listen to the folks that I follow. Like I said earlier, on the sites that I'm subscribed to. I kind of just stick with that. And then the other thing is, like I said, I'm very focused in terms of I don't need to deviate. I'm pretty good at that. This is my strategy. It works. It doesn't work all the time, but when it works really well. And so that's kind of what I stick with. I'm not trying to go change it every time the market changes or the stocks that I invest in don't move. I'm not going to go and try to find a new strategy or anything.
And just a clarification question: when you say I want to keep my losses at 2 to 4%, is that on an individual trade basis or is that of your portfolio as a whole?
Yeah, individual. This is individual trades.
Yeah. Cool.
Yeah, and like an individual trade at 6 to 10% return on that trade. But if I'm oversized in it, then a 6 to 10% return on a trade could be a 3 to 5% change in my portfolio.
Right.
If I'm holding 50%. So yeah, it's more around each trade. So the next one is picking the right stocks. And so, I get a lot of questions on this as well. Like, how do you pick your stocks? How do you know the ones you want to follow? And so I've got a few things that I look for to come up with my stock selection. One of the biggest things I learned from Mark Minervini was, when you're looking for stocks, he's got his Mark Minervini stock screen, which I like. He looks at stocks that are in uptrends, i.e. stage 2, right? You want to be only trading in stage 2 stocks. Those that are where the 50 is over the 20 is over the 50 and the 50 is over the 200. Those are going to be the strongest stocks, and those with relative strength of 80 or greater are typically good ones to focus on. I also look at stocks that are only $75 or higher typically, and that are liquid. And so that's a key thing for me in terms of the volatility that I want to try to avoid. Unless it's a leveraged ETF, because I do trade a lot of those, TQQQs being the main ones. But if that's under $75, that's fine. I'll still trade it. I like to look for companies that are quality companies that most people know of. Nothing that's a hidden gem. If it's a hidden gem and it becomes a quality company, I'll find out probably late, but I'll trade it as it's moving up. I don't need to get the double or triple from $10. I look for market theme stocks with momentum. I think that's a key thing, is that you look for the what are the themes in the market, right? And then those themes, what are the best stocks in those themes that are moving or that like to move quickly. And that's, I think, one of the key things, is to be able to find and narrow those down. A lot of times those stocks are the ones in the IBD 250, right? I mean, that's a great place to start looking for those stocks. I mostly avoid industries tied to another asset class: metals, energy, financials, biotechs. I think I've mentioned this in the past as well. I look for stocks with a high ATR, average daily range of around 3% or more. The other thing I think that I do is I really keep my stock list manageable. On the left is kind of an example of my stock list from TC 2000. This is only part of it, but the ones that are kind of flagged on the left in blue, those are my focus stocks that I really those are the ones I'm trading, and those are the ones I've analyzed those from a technical perspective and drawn my lines and all that, and kind of deemed that those are the ones that are moving right now. And then what I like to see is a good setup, whether it's tight price action, it's coming out of a consolidation like a cup and handle or a bull flag or a descending channel. And so that's kind of my stock screening criteria. Like I said, let me go to the next page. Do you have any questions on that?
No, I think that's good.
So this is like the full list that I have on TC 2000 of my stocks that I follow. I had to break it up in two, but these are all the stocks. In general, I have it's about 60 stocks total, but the stocks below, the ones that are flagged, I really don't pay too much attention to during the day. Those are just stocks that have come into the screen and either are not doing much right now, or just I'm not interested in them. But I leave them on there just because it gives me a feel for how the market is. For that day. I mean, if you're seeing all red, then it's not a great day in the market. And if it's all red, the market opens down and everything's red, and then all of a sudden, I'm flipping through these and I start seeing more green pop up. That's an indication that potentially the market could be turning around. So I try to keep an eye on that, and that's why I've got 60 or so stocks in there. But other than that, it's the ones that are flagged, the 2030, that I really am following at that moment. And what's on my watch list is, mostly they're FANG stocks, semiconductor stocks, Bitcoin-related stocks, software stocks, communication, AI-related stuff, Qs or triple Qs, and then just some miscellaneous momentum names that, I might pop up from, one of the sites I'm watching or following, and I'll put it on there and just kind of see what it's doing. So I mean, I think when I mentioned that, I don't think that you need to really, I mean, you need the right stocks, but you don't need to be screening, in my opinion, every single day. You can if you want, but I like I said, I try to keep things simple. I want to do other things as well during the day after the markets close. So I keep it to this. These get updated, as the year goes on, right? I mean, and I'll screen maybe once a week and go see what's going on out there. What I do though is during the day, I have a separate tab that shows kind of the market movers for the day, and I've got some things around that, like what are the stocks over $75 that are moving, and then over a certain amount of volume. And during the day, I'll go into that screen and just look to see what are the names that are moving, and if they look interesting, I'll put them in here, and then I'll try to take one or two out of here as well, so that the list doesn't get unruly, if you will.
Yeah, one quick question. How do you decide whether to trade more like the MSTR or its leverage counterpart, or the Tesla, the TSLL there? Is it just based on the ATR of that particular stock?
Yeah, I mean, it's a couple things. One is, it depends on if the stock is really moving. If it's moving, I'll probably just go to the ETF,
Underlying.
the leverage ETF.
Yeah.
But sometimes, they're just not moving, or you think they're going to move, and maybe then I'll buy MSTR and hold it, and then just kind of watch it. So it's on my screen, on my
Broker, yeah.
it's a stock that I own. It's top of mind for me. And then if it starts moving, then I'll probably maybe get rid of that because it's so much more money, and then buy the MSTX and lever up on that.
Gotcha. Makes sense.
The same with TS, the rest of them, like Avago or Tesla or whatever.
Seems like all the liquid ones have ETFs now, Robin for Hood, all that stuff. So, yeah.
Yeah, exactly. So, but some of them, like a Robinhood, that's a good example. Like it's not that expensive. I usually won't buy the ETF for that one. I can just lever up on Hood because it's not very expensive. And so it just depends on what the stock is.
Right.
Yeah, so I mean, I think, if you're new, like I would say go to the IBD 250, and that's a great place to start, because some of these names are probably, from that. So it's a good place to kind of see what the big movers are, and some of the best stocks in the market are. And I know you guys have a great product as well that you can use as well to go do a lot of the screens. So
Yeah, we have the Deepvue leaders list, which all of these will be on the Deepvue leaders list. Pretty much, that's basically exactly the same growth stock momentum universe that we're looking to build.
yep, I think it's great. So, yeah, I mean, because here's the thing, and the reason I try to keep this and even this list I think is way too much for me, is that, there's just so much you can do. And if you focus on the key handful of leaders, I mean, you probably don't have enough money to go buy all these as well. And if you want to get a return, you don't want to be buying all these, right? You want to focus in on the 1, 2, or 3 that are some of the best stocks, and lever up on those and concentrate your portfolio, because that's how you're going to get your bigger returns. And but this does give you a feel for the market and in general what momentum stocks are doing. Okay, so the next part is, so that was stock selection. We've covered psychology, stock selection, and now portfolio concentration. So just to kind of, I guess, give you an idea of what I think about portfolio concentration is when you concentrate your portfolio in 1 to 3 stocks, or oversize a position in your portfolio. You can have 4 positions, but those other, one position's like 80%, and the other ones are like, 777 or something. That to me is a concentrated portfolio, even though you have 4 stocks in there. The pros are obviously, you can really get good outsized returns if you pick the right leaders. And obviously the cons are it's a higher risk. If one of them, if the one that you're in happens to have some bad news come out or whatever, market turns, you could take a big hit on it. So it is a higher risk. But there's ways to manage that risk if you get in at the right point, and don't just use some random 5%, 8% stop. So there are things that you can do to manage the risk part of it, and still take advantage of the outsized returns. And I talked a lot about that in the risk management from last year. So that would be a great video to go watch if you want more details on that, because I think we went into some pretty good detail on how you manage your risk in those sorts of higher concentrated trades. Also, you don't need to be equally invested in those 3 stocks. I kind of mentioned that. Concentrate heavier in the stronger names, higher quality names. The key is also to know when to concentrate and how much to risk, and balancing it against your total portfolio exposure. You want to be concentrating and going heavy when the market is, hitting on all cylinders. It's in a strong uptrend, and you're having successful trades, right? And things that are breaking out and just running. They're not coming, reversing and all that like it has been, I'd say, over the last few weeks. It seems like things are changing a little bit here. You kind of get that feeling over the last day or two that maybe we are about to take a nice move up, but we'll have to see. But like I said, you must have really tight risk management if you're going to even attempt to concentrate up and lever up in a particular stock or two. And typically you get this 2 or maybe 3 times a year when the market is really working, breakouts are working, everything is kind of humming along. It usually happens 2-3 times a year, and it'll be for a few weeks, and you gotta know like when that not that you have to know when that is, but when you start seeing that, you need to be able to really ratchet it up and go big, and then kind of turn it off once you start seeing things are not really moving like they were. And then I think the other thing is if you're new to trading, definitely don't use margin to concentrate. That's something that you want to definitely have some experience doing and feel comfortable with your trading before you even head down the margin path.
And I know that you can size them pretty large positions, but you also do it over time. And I think you'll show in examples how you work more size into positions that are working. You'll also show a negative example, HIMS, the downside of this and how you dealt with that, which I think is fantastic because that's the reality of trading. If there's going to be HIMS that happen.
Yep.
But I think that's key, that, concentration, you don't have to do it all at once. You don't go right into a 50% position, at any given point. You want to do it over time, manage risk along the way. And as the stock is working for you, and rewarding you for that position in the first place. But this, I think, is one of the keys to super performance. Is obviously, if you can concentrate on the right leaders at the right time, just 1, 2, or 3 stocks can make your year in a matter of weeks or months. But if you do it at the wrong time, it can bite you just as fast. You want to be able to manage those drawdowns when the markets turn. So, and you'll show some great examples of this, which is fantastic.
Yeah, I mean, and this kind of goes back to when I was talking about psychology, right? Are you are you quick, right? I mean, are you flexible, right? When you
Right.
see the market change, I mean, it could be a day or two. Like I just kind of get the feeling like right now, the market we're in is just it's just about to turn, or it's turning, or we're going to have a few good weeks here coming up, and now you got to just be confident to know what you're doing. That push the gas down but manage your risk at the same time. So that's why psychology, once again, is very important in terms of your own trading strategy and plan.
Right. Right.
So when is the right time to concentrate? You need to understand general market conditions and where we are. So 3 things that I do to kind of understand where we are in the market, or if it is the right time. One is I look at market cycles. And to me, that's like a key part of it. Like not a key part, but it's a good kind of roadmap, if you will. It's not that it's going to be flawless and it works all the time, but it gives you a general idea of what the market will typically do. And these are like market cycles that, like this is from Ned Davis research. These are market cycles that are, 10-year cycles that they've done over 50 years, or 4-year presidential cycles that they've been doing, where they take all, the first year of the presidential cycle or presidential election, and they take like the past 40 of them and they just kind of map them and average them out and say this is generally what happens. And then there's seasonal cycles, et cetera. So this first one is kind of an actual where we are in terms of the real cycle right now for the S&P. We're right kind of where this circle is. And so, I don't know, we're past this little pullback, and I think we're on this little uptrend here potentially into mid-July. So in my mind, I'm kind of thinking that's what we're doing. So it kind of gives me a little bit of kind of an idea, like, hey, this is typical in this part of the year, in the first year of a new president's cycle. So that's one thing. Second thing is, I look at the daily, market environment. What's the VIX doing? What's the put call ratio? Percentage of stocks over 200-day, bulls, bears, like what's the sentiment? And what's the IBD market trend? And then there's some proprietary indicators that are, with Mark Minervini, Dan Zanger, and these guys that I look at as well. So, that kind of gives me more of a daily idea, and if you look right now, the VIX is, it's come down quite a bit. Like today, I don't remember where it ended, but I think it was like 16 or something, down from 21, 22 a few days ago. So it's dropped a lot. Put calls pretty low as well. Percentage of stocks over the 200-day is still kind of lagging. I don't think that's a great number right now. Sentiment is not that overextended, which is good to see. People are not too frothing at their mouth right now, and things being too greedy, which is a good indication that we may be just starting something. And then stock action, how are the last few trades that you've made? How are the stocks that you're looking at, out of my momentum list? How are they doing? Are they breaking out? Are they running? Are they coming back to the breakout level? And then just, how's your portfolio doing, right? That gives you a great indication of how the market is. And so, you got to kind of look at all 3 of these things and kind of make your own assessment of, how aggressive do you want to be, or do you think we're in one of those times where it may make sense to start to ratchet up your exposure and your concentration in a few accounts or a few stocks? So that gives me an idea of general market conditions. And just to kind of show, this is like from September of last year to now. this is kind of the way I viewed the markets, right? I mean, concentration of portfolio, would be done in the green boxes. So definitely from, September, late September through, the presidential cycle or the elections, and then past that a little bit into December, mid-December. And then things got really choppy. Like I saw no real advancement in my portfolio. It was up one day, down another day. I wasn't really making a lot of progress in my in my portfolio at all. I was pretty flat at the end of the day, even though I was still trading a lot. That's a great indication that it's a very choppy environment, and definitely don't go concentrating in a particular stock or anything. And then the red box obviously is the whole tariffs situation from this year, which was definitely a red box where you shouldn't be trading at all. I mean, you could do some pilot buys very low, but probing here and there, but nothing major out of your portfolio to invest in. And then I think like that next box, when you look like starting from mid-April, things started to look a little better, and that's kind of where you could have gotten very aggressive and made some a good return off the bottom there. And then right now, like I think the last few weeks, I'd say this box I was kind of thinking about a little bit. It's been okay. It hasn't been great, but it hasn't been bad either. So if you were in the right few names, you could have done okay. But it wasn't necessarily an easy market since mid-May or from late May onwards. It's been pretty choppy. So I'm gonna go in and talk about like like during this time period, like when I got aggressive in a particular stock and concentrated. I'm gonna walk you through a few examples here. GEV was one that I jumped on and really kind of focused in on it. And why GEV? It's actually an energy name, which I typically don't trade, but this was related more around the AI play, around them needing energy. And so if it's a stock that's around AI, then I'm interested because of the AI play and not necessarily the energy play. But when you look at this, why did I trade this stock? It really held strong during the correction. If you look at it, that whole downtrend, I mean, the 50-day was significantly over the 200-day. It didn't even come close to it. So even though it did come down, it was still very, very strong. Number two, I like the double bottom pattern on this chart. That's to me, it's a very strong pattern. If you see a double bottom pattern, it's one of the ones I really like. If you can find it, it's a great one to pay attention to. Number three was that they had really strong earnings on April 23rd, and you can kind of see around here that was their earnings day was here, and then the next day it really just gapped up and then came back down, right? And that made me want to kind of start watching this since their earnings were so good. Now I didn't like the fact it didn't hold its earnings gap. I guess it did hold it down here technically, but it did come back and squat, which was not great. But then this was also a momentum name in the AI market, so that's the main reason why I wanted to really get involved with this as well. And it was a nice, $350 stock back then, which was right up my alley. And then it started to climb this little really tight, kind of this channel, and it was staying within this channel pretty nicely. So it was showing a lot of power. And then the last thing was, there was this gap that it had to fill from January 24th, and so that got me interested as well, because usually these things will fill the gap at some point. So those are the reasons I kind of got interested in this stock and started to focus on it. So the next slide, I'm going to talk a little bit about kind of how I got involved in this stock. And on the left is a picture kind of starting in, I guess in early May, I started to trade this stock. So if you look at it, I didn't even get into the stock until this time period here. So it had already made a decent move, and it crossed back up over its earnings earnings gap, so that was a good sign. I should have probably gotten involved back here. I just didn't. So I really started getting involved around this time frame, and that's kind of what the blow up is over here on the left. The green arrows represent where I bought, and the red arrows represent where I sold. And so this is an example of how I got concentrated into this stock. I didn't buy it all at once. I took small chunks of it. And so on the right side, you can kind of see my trading history on this one, right? This was the date I bought 1350 down here. Probably when it opened over this bar. So I bought some then, and I bought 1,350 shares. It didn't close. It closed okay. It was within the channel, but I don't know. I just wasn't comfortable with it, so I dropped it down to 500. The next day, I bought again. I bought 1,250 shares on this day. It was a good inside day. Bought 1,250 shares, thinking it was going to, potentially cross over the high of the day before. Positioned myself, didn't do it, so I sold 250. So now I was at 50 because it was an inside day, which I love inside days where it's just kind of staying quiet after the nice move it had already had. So I sold a little bit just to take a little risk off, and then I had 1,500 shares of this. The next day on the 6th, I bought again, thinking it would move. It didn't move. So I buy it in the mornings, like when it opens, and I put a stop probably the day before, the low of the day before, or the low of that day. And so I bought again. I bought 600 shares. Didn't do much. I sold 400. But now this was another inside day, which now I'm like, okay, this thing has got to move. I think on the upside. So I sold 400. Next day I bought 200. And it moved up and it closed well, and I thought I had a pretty decent exposure to it, 1,900 shares, and I just wanted to watch and wait and see what it did. It was a little volatile here, it dropped and then came back and then moved up on the 13th. I had a nice move up. So on the 13th, then I sold 1,400 shares. I was down to 500, and then just watched it again. It came down the next day, came down again, and started to build this little channel here, or this downward sloping line here. And on this day, I ended up buying some more. I went in with 2,000 shares. I don't remember when I bought it, but I probably when it tried to get back above this, I bought some 2,000 shares. Didn't do much. Sold them in the before the close. And then dropped my exposure down to 1,500 shares. On the 16th, I bought again, and it was fine. It didn't do much, so I just left them. So now I have 3,000 shares. And then the next day, it dropped, came back, and I bought some more. I bought another 1,000 shares. Had a great move. I unloaded a little bit to de-risk. Unloaded 1,250 shares, and then the next day. It crossed again that line. I bought some more on the 16th, and then on the 20th, and then I bought again, sold again, didn't do much. Bought again, sold again, and then I bought again on the 23rd. I bought 1,000 shares, and then on the 27th, I bought 4,000 shares, thinking this thing is going to move. It moved a little bit. But like that was like a huge exposure I had to it. So I sold off 4,000. I made a little bit, 2.3%. I guess that was pretty good of my portfolio. Sold it, had 5,000 shares still. On the 3rd, this thing made a nice move, and then I sold into this move on the 3rd. 1,000 shares, still held some. Then I went back up to a 5,000 share position, didn't do much, came down again, and then it was kind of just looking like it wasn't going to move. To me, it wasn't making the progress, and I just had too much, and then I just kind of offloaded the rest of it and got out of the trade. So a lot of in and out. I mean, it's most people probably be like, what the heck are you doing? But that for me is like, the way I trade, it works. That's kind of the way I trade when I'm trying to concentrate and build a position. I guess I could have just held here and just held it all the way up, would be the other strategy. But once again, that was, my personality probably wouldn't allow me to do that and have that much risk on. So
Yeah, go
at
ahead.
the end of the day, like with all that in and out, I made about 14.2% of not the trade, but of my portfolio. So that was a decent size return on this one stock over about a month's time.
And for those original buys from the first few spots there, how are you thinking about managing your risk if it followed through? Because we did have that pullback before it actually continued higher in the channel. How are you thinking about where your line in the sand would be to cut it if it kept dropping and didn't hold, didn't hold that reversal low?
Yeah, I think the first few buys that I had, my stop was this day here, this probably the second, no, the first. I think it's the first. And after that, I think what I did was, as this thing was tightening up here, I kept moving my stop up. So this was my stop on that day, and then I moved it up to this, and then moved, like when there's an inside days, like if it's a really good inside day, it's not going to cut back below it. And so what I do is I would ratchet up my stops for what I have as the low of the previous day, so that if it is a real inside day and this thing is going to move, it's not going to go back down, typically.
Yeah.
So that's kind of how I would do it.
And
Or how I
then
did.
for that pullback, were you just watching kind of end of day basis your line in the sand? Because it closed really nicely on that day, but we did have a pretty nasty
It was a
pullback
huge
intraday.
pullback. Yeah,
Yeah.
it was a huge pullback, and I didn't do anything just because that line that I have and that's going over here. This was the channel it was in, so I was using this channel at this point as a kind of a stopgap. And if you look, it never even crossed back down below this line here. So I must have changed my stop. I don't remember exactly what I did because it's pretty dynamic. But I may have not had the stop in place, and then I just watched it, and it didn't go below this low, and so I just held it, and then the next few days it did well, but it did close well. Now, if it would have closed at the bottom, I would have probably lightened up even more, just because that just would not have been a good day. Now, the other thing also is that a lot of times the stock may be doing something, like it may have looked really bad. The stock came down. But I'm also watching the market and kind of seeing what's going on. Like, is it a news-driven thing? As you remember, there was a lot of talk about, the tariffs and things like that. So for that reason alone, I didn't leave a lot of stops overnight just because there was so much volatility. And so in this situation, I don't remember what happened that day, but it may have been one of those things where the news was more around tariffs versus the stock being bad or something like that.
Gotcha.
And the market was turning around. So that's the other thing I definitely do in these situations is you got to watch, what's going on in the markets as well.
Gotcha. Perfect.
Okay. The other thing I really like to trade, and I mentioned this earlier, was the Qs. And so one of the things, especially, I like to trade the Qs when we're coming out of a correction. And so that is, I've just found success doing that. It's a little bit of you got to position yourself correctly. And so here's just an example of the correction we just had in 2025 in April. So, when you look at it, market came down. This is like a typical ABC pattern on the way down. So you're watching this, and there's two things that I'm trying to do to figure out if we've hit a low, right? One is I'm watching obviously the pattern, but I'm watching the VIX as well. And so the VIX I find to be a good indicator of when we may have reached a bottom. You want to see the VIX, like if it's hitting 60, 70 or something like that, I mean, that's really, really high. During COVID, we hit that. During the financial crises, we hit something like that. And so when we hit that here, then, I'm on alert to kind of figure out, like, okay, is this low? So I'm looking at that. I'm also looking at put-call ratio. It was interesting, as we were coming down here during this time, the put-call ratio, even though the VIX was really high, the put-call ratio never really jumped over 1 very quickly, which was surprising. So, between those two things, you want to look at the put call, and you also want to look at the VIX and kind of see when they're both in alignment, meaning that the VIX is like super high, but then also people are protecting themselves with puts And so when that ratio gets over 1, then like, okay, that could be a point where that we may have just hit bottom. So it's not always the case, but with the market the way it had come down so fast and furiously over a few weeks, like that was a good indication. And so typically in this situation, I may try to buy on the day that the VIX was came smashing down or went up super high. We had a good close above where we opened, and that sometimes is a good indicator that that may have been the low. I'm not buying a lot, but I'm just
Testing.
getting involved in the market, and so I'll put my stop is the low of that day, and then I may add as we go on here, and then start to lighten up. It just kind of depends on what the market's doing and what the VIX and all those indicators are doing. So I'll buy, get into it, but really what I'm looking for is it to move up and then pull back. I think I even posted this on X at some point around the 20th, around this time that, hey, it looks like we're starting our pullback here. So we started getting a pullback, and what you want to watch for is the low. Like how far back does this go, and does it cut the previous low, or does it kind of stop before it? And if it stops before it and it's a higher low, then that's what I'm looking for. And we got that on the 21st or the 22nd. So once you get that, then you can kind of start to get a little bit more aggressive, because now you've got a very defined stop on the cues as to where your stop is. And so coming out of something like this, I typically will go more aggressive on the cues than I will on any stock. And so what I typically do is I'll buy as much cues that I'm planning on buying after this higher low, and I'll put a stop right below the low, whatever the low was. And that's kind of where I start to load up again in terms of the cues and start to create my position. So to me, this is like the good buy zone here. Once it cracks above this, and you think like, okay, that may have been the low, and we're starting to get some upside momentum. And from there, you can hold it, you can sell it, you can do whatever. But once you start seeing this is where then I start to look for like, okay, what are the stocks that have held up the best? And then you can start to add stocks. That's when I would start adding stocks in addition to the cues that I've already bought, to see what are the leaders, what held up the best, and then start buying those once we've kind of seen some more upside momentum and we're holding that higher low. And so that's something that I like to do coming out of a correction, because you can make some really good percentage returns in that sort of a scenario. So even if you bought over here on this low, right, and you're holding it still today, and really the market hasn't done anything to make you think like I should sell, except for maybe on this day, but it's over 50% return in just a few months, right? That's a great return. Just if you buy the cues and don't buy anything else.
And for this one, are you pretty much going to let it go when we break the 50, start making lower highs, lower lows, that type of thing? What are you waiting for?
Yeah. So on this one, I like the cues. I have a few different accounts. Like for my long-term account, I bought this, and I'll probably sell it pretty soon, because that's a pretty good return. And then just wait until, we have another opportunity to go back in with this sort of a setup again. So, we've come a long way. And like I said, when I showed kind of where we are in the market back here, right? When you look at the roadmap, if you will, typically also when you look at seasonality, middle of July, the market starts to turn, either goes, flat or starts to go down. And so even this roadmap even shows, the market cycle, it kind of tops out here in mid-July. So I may hold it for a little bit more, but I think I've already started to kind of
lighten up,
decrease my exposure and start to liquidate. Yeah. But I'll probably do more of it in the next couple of weeks and just get out of the whole thing by, mid-July at the latest. So, so that's an example of, of coming out of a market correction. And just so you know, I went back. I went to a couple other years where it was bad, and you can kind of see the same sort of setup, right? So this is in August of last year, right? We had an ABCDE sort of a wave down, right, from August. Well, actually, if you look at it, it's actually interesting. It's mid-July, right? Like right when I said, so from mid-July till early August, this market just came flying down. And if you look, the VIX was over 60 again. Which was pretty high, and I don't have the put call ratio here, but I'm pretty sure that was over 1 as well at that point. So this is where I started to probe a little bit, buy a few things, and kind of see what was going on. But this is kind of where I really loaded up on the Qs again. Was after this, it came back down, stopped, and then started its run up, right? And so it's this higher low that you really want to see after a market downturn. Yeah, you can catch this, but more than likely it's going to come right back down, and you're going to have a better opportunity to buy it with less risk than buying a ton of it here because you think we're just going right back up. And even if it's a V-shaped recovery, like I showed you, like this one we're having now, it's V-shaped, but it still came back down and gave you an opportunity to get involved over here, right? And similarly, even though this upside was a little higher, it went up like 40%, I think, from this whole downtrend. It gave you another opportunity to come back in, load up here, and then you could have gone as far as you wanted to hold it, as long as you wanted to hold it. But again, 30% return in a few months. And then I think I have one more example. So this is like from the COVID time, right? This was everyone calls this the V-shaped recovery. Here also you see an ABC pattern down, from February through mid-March. Market started to move up. It didn't go up very much, but came back down. But here was your higher low, right? And that was your indication that, hey, I could take some risk. And like I said, I like to take risk on the index and not on any stock at this point until I see some more validation that this is a real kind of bottom and we're turning around. Because my feeling, and gives me more kind of conviction, is that typically the markets are not going to market's not going to go to zero. You hope, unless there's something that we don't even want to think about. But it's gonna it can go lower. But if you manage this properly and bought at the right time and you put your stop at this higher low, your risk is very limited. And you can actually have then a great return. And in this case, in this situation, we had over 200% return in a few months. So it's a strategy that works for me, and I use it quite a bit. But like I said, I only buy the index because I'm more comfortable and I've got more conviction that it's not going to go to zero. And I've got it risked appropriately where I'm not going to blow anything up as well.
Yeah, how much of your portfolio or what position size do you typically shoot for coming out of a correction in situations like this on the higher low setup?
It depends. I mean, it can be anywhere from I'll buy 40, 50%, 60% but I have a tight stop on it, right? So it's fine. And so sometimes I'll buy more than that. I'll have 80% in it because I feel like, okay, this is the blow, and I'll have like a 1 or 2% risk on it because I'm buying it right on one of these days at the bottom. And then I may add to it as we go, but I'll have appropriate stops at that point as well. And so what I typically do is I'll buy it, and I'll buy a lot, like I said, pretty high percentage of my portfolio. Coming out of it, I'll sell it after I have a little bit. I'll hold on to some of it, and then I'll start looking at stocks to invest in and move that money into some of the leaders that are moving or that have held up well.
Yeah, it's interesting because that initial bounce where you're playing the TQQQ, almost everything is correlated. The market's expanding, and TQQQ kind of captures that. And then, like you said, you're kind of rotating into, okay, now what are the best liquid ideas to focus on that you can, you finance the risk of those positions with the TQQQ trade. So it's really interesting. Not all of us have to be as big cowboys as you and those sizes, but I think the strategy as a whole is definitely, super, it works. It works well.
Yeah. I think, it's worked for me over the years, and I do use this quite often. And I find the TQQQs to be a good instrument to use. I mean, I've done it with the Qs as well. So either one works, or the S&P, you can do it on that as well. on the SPY, but it's exactly like you said. I mean, it's low risk. You're not going to get any, you know, well, you can get news, I guess, on the index as well, but I just find it to be a little bit easier for me to be convinced of the trade versus an individual stock.
Yeah. And do you use this higher low on individual names as well, like the really liquid stuff? I think maybe you have a Meta example. Is that actually
Yeah,
the
I'm going
next
to show
one?
that right now.
Yeah,
Yeah.
perfect.
So, yeah. So, okay. So this was, I showed you this one from just recently, from the April correction, March-April correction. So one of the things I did was I did that exact same strategy with the T triple Qs, bought those. But then I also did it with Meta, right? So when I looked at it, Meta was just, why did I look at Meta? It was, I bought it on the first market pullback. It held. It was kind of a double bottom once again. It was a low risk entry with a tight stop. I bought it, right on this day at the bottom at 499 and change. I did half my stop at 478 and the other half at 485. And so it was a pretty low risk entry. And it was a FANG leader, right? I mean, Meta's been doing well all year, and it's one of the stocks that I think is loved. Down here, you can kind of see this is the Qs and kind of how the Qs reacted right at this point in time. And that's kind of where I looked at Meta and bought some Meta, on this day I don't remember the day it was, but, probably April 22nd or something like that, when the market really, that was the low, the higher low in the market. So I bought it, and I still have it. I haven't sold it yet, but I'm probably getting close to selling it soon. But it's a good trade. Pretty easy trade to make, and not much risk with a good upside on it, right? So it's already made almost $213 move. So that's a pretty decent move. All right, moving on. So those are some good things, right? Some things that worked well when you're trying to concentrate and leverage up. Here's a trade that I took. It wasn't huge. It was probably like a 20% of my portfolio. It wasn't gigantic, but the reason it wasn't gigantic was because it's a lower price stock as well, right? I'm not going to go in 80-90% of my portfolio on a HIMS. But why did I pick HIMS? First of all, it had a really nice cup and handle going, which I liked. It tried to break out of the handle here on this day, and it got rejected, right, and came right back down into the handle. And so sometimes it takes a few tries for a stock to break out of its handle, or wherever it's if it's a cup and handle to come out of the handle, or a flag pattern come out of the flag. Sometimes it takes one or two tries, which is not the best, but it happens. And this is a point in time where the market wasn't, the breakouts weren't necessarily just going. Sometimes it took 2-3 times for them to really get going. So they had really good earnings and sales numbers, and they had a big deal with Novo Nordisk for Wegovy. And so it was really kind of what was getting the stock going. And so I was like, okay, I'm going to watch this and see how I can get involved with it after, it came flying down. And so here I'm going to walk you through kind of what I did here. So what I did, my first buy was on the 3rd, right? I bought 2,000 shares of this as it came down and closed here at the low. And what I did, the reason I bought this was it was closing in this hourly, if you can kind of see this. It came down and it closed the gap that it had. And so at that point I ended up buying it, right? That was my first position. I thought, okay, it's going to close its gap and it can turn around from here and get going. Obviously it didn't do that. It came down. So before the end of the day, since it closed towards the low of the day, I just sold half of it and kept 1,000 shares, which was totally acceptable. And then what I did was, this thing started to move up. I bought again, and it squatted and just closed at the low. I bought 2,000 shares on this day, so then I just kind of held it. The next day, I didn't do anything after that until the 10th. So once again, this thing started to move above these two bars. And so I thought, okay, you know what, maybe it's going to start to curl up and get going. So I bought, 1,000 shares on this day, held it inside day, and then it started to make this little support line. So I kind of used that as well as kind of a stop, if you will. The next day, it goes up again. I bought 1,000 shares, and it came squatting right back down. I sold those 1,000 shares, and then the next day it went lower and closed on the low, which was not great. So I sold another 1,000. I'm down to 3,000 shares. Next day it turns around, goes above this previous day, that previous day's close and this close. So I bought some more. Only bought 500 shares because by now I'm kind of like, okay, is this thing going to really go or not? So I was at 3,500 shares. The next day, I kind of just inside day, so I kind of took a little bit off, took 500 off. I have 3,000 shares. And then the next day it gets going again. So I bought the 500 back after it crossed this high of the previous day. Bought 500. It was doing well. It was doing well the next day too. At this point I was up almost 2.4% of my portfolio on this trade, and I thought, okay, looks like it's going to get back up here and cross this in the next few days, and I was fine with the position I had at 3,500. The next day, news comes out that their deal with Novo Nordisk was gone. Like they backed out of it, and the stock went just plunging in the morning. Right, it was a huge downdraft. So what I did was it opened. And as soon as it opened, I gave it a few minutes and tried to look to see on the 5-minute chart, like if it was going to move back up. It was just going down. So I just didn't think twice and just got rid of the whole thing right away. So it was a huge loss. I lost about 8.7% of my portfolio on that one. So that hurt a little bit. But that's the risk of trying to concentrate, because you can get these sorts of events. And this is another reason that a lot of these smaller names like Hims and things like that, right, that are still building their businesses out, any piece of news can really hurt them. And so typically I don't try to trade these stocks very often. Sometimes I do. I thought it was a good story, and it looked, the stock was behaving well. It was a really good setup, right? And I thought, okay, this thing can really, really move here once it crosses the high that it had around $70 or $68. And so, yeah, it was all set up, had the best plans, best intentions, and unfortunately the news came out and it just got smacked. So this is a situation where, you can't panic and just hold on to it. That was a big reason, that news was a big reason, I thought, of why the stock was moving, was that deal. And if that deal's gone, then what's really the catalyst? So I just sold into it and lick my wounds and move on. So even though this happens, I think if you trade often enough, yeah, this hurt, but over the long run, like, it's not even going to make a big difference, because the opposite happens as well, right, where it goes up and you didn't know it.
Yeah, I didn't get hit, but this one got hit on a few on the deep seek. But you just got to take your loss when you got it. And in a good market, it's amazing how quickly you can get back to where you were. And yeah, I think every growth stock trader is going to experience gap downs like this at some point, and you just have to manage risk as best you can in real time. So
yeah. Exactly. I mean, so just because this happened doesn't mean I'm going to change my strategy, and I'm going to try to refine it a little bit and see if there's something I can figure out. But, in something like this where it's some news that comes out, you really can't do much around it, right? I mean, it was set up properly, and those are the risks of trading. And, but, you need to be able to, once again, not panic, and you've got your process, you got your rules, and yeah, this was way higher than I wanted to lose, but you got to do it, sell it, and be out of it. Earnings gap. Someone asked me about this as well, so I thought I would just cover something like this, right? So if there's a stock with an earnings gap, like, how do you play the earnings gap? And this is one I just recently played, or took, I guess, is Credo, right? this came on my screen. How did I hear about this? Through one of the sites that I follow, they had mentioned the stock, and so I looked at it and I was like, oh, it looks really good. It's a nice, great cup and handle pattern. Well, it was a cup without a handle when I started looking at it. Right, it tried to break out of this cup with no handle. It was really a nice looking chart, and so I looked at this and said, okay, let me look into this. They had strong earnings numbers. That's why it gapped up, but it couldn't hold it. Once again, like towards the end of May, early June, like things would try to break out, but they would get squashed. So this wasn't anything that I assumed was wrong. It's just like that's what stocks were doing at that point. So I just started to follow this a little bit. But what I wanted to do was I kept watching this thing to see where it would make sense to get in. I thought it would close the gap. It didn't. It just went down and touched the previous high of this. This is kind of where it broke out that day. So it came back and kind of touched it. And I've got to zoom in on this a little bit. But if you look at this stock, right, 400% earnings growth and 180% sales growth. Like those are great numbers, right? So this immediately got on my list and something I'm really interested in. And I think the quarter before it also did decent, but it still got hammered just because I think we were in the whole tariff news, and so it got kiboshed. So here's a blow up of that, right? So tried to break out from here, right? Broke out from the earnings, tried to break out, didn't do it, came back down, and then just slowly made this nice descending channel. So it looked like it bounced off of the previous high here that it broke out from. It bounced off of that and closed, it's still a low of the day, but then the next day I decided to get involved with it. On the 15-minute intraday chart, this is where I bought it. I bought it on this day as soon as it kind of crossed this little consolidation, if you want to call it that. I bought it there, and then the next buy was over this one, which was at this point in time. And so I've made two purchases on this, and I'm still holding this stock. It's doing fairly well. I think this is a chart from yesterday or day before. It's around $94, $95 right now. I think I'll probably close it out closer to the century mark or so. So a pretty good trade here, from $70 on to close to $90.
And was your stop below the day before's low?
Yeah,
Yep.
it was a stop right here because this was kind of where it bounced off of the support line. So right away that, hey, if it crosses this, then it's probably going to go down and close this gap. And I don't want to be part of that. I'll wait and see if it does. If it does close it, I'll see if there's a setup that makes sense after it closes that gap. But it's a good thing it didn't close the gap because it shows that it's got some power behind it, that it doesn't need to close the gap. It just tested the breakout, which is very normal.
Right.
Another just trade I made on Affirm. This is another cheaper stock, but for some reason, I've been trading Affirm for a while. It's been good to me, so I kind of go back to the well every now and then with this thing. But the reason I decided to trade this was the stock was making a turn, after a correction. It was starting to, came down like everything else and then started to turn up, came down, lower highs here, had some support at the 50 and then started to move up. And then it was like right around the 200 day. And this is kind of where I started to watch it to see what it did at the 200 day. I added to the position I took the initial position at the 200 day, and then I added to it after it broke this downtrend line that was there. And so I held it for a few days and just sold it out in two waves with, I'll show it over here. So I bought it, like I said, when it crossed the 200 day. That was my first buy of 2,000 shares. The next day it crossed above the two things. One is it broke over these 3 days of highs and crossed the downtrend line, which I liked. So I bought it here as my second buy. So I had 4,000 shares. I just held it. It did nothing wrong. I sold half of it here and I sold half of it there. and made 3.2% of my portfolio on that trade in a few days. I wish all my trades were that simple and clean. Unfortunately, they're not. But if I can get them, I'll take them. So that's all I really had on in terms of concentration and how you buy and sell, and my index trades. Any questions?
No, I think those are great examples.
Okay, so the next one is knowing your math, which I think is really, really important. So, one of the things that I don't think people know is, what are their stats, right? Like, how many trades do you take? How many are winning trades? What's your average gain? What's your average loss? How long do you typically hold your gains and losses for? And what's your win-loss ratio? I think it's a lot of work to do it, and most people don't like to do that. But it's definitely worth it because it is eye-opening. Two things. One is, I think knowing your stats is eye-opening, and if you do it for a year, I mean, you don't even do it for a year, you could probably do it for 6 months and get a good feel for what your numbers are. That's important. And the second thing is, I think going back and kind of plotting your trades on a chart is real important as well, to kind of see what your tendencies are. But your stats will have a big impact on your your portfolio and how you manage your math. And once again, I'm not going to go into too much detail on this because I went into detail on this in the other presentation. But I think one of the things that for me is like I don't want to take any more than 7 or 8% of portfolio risk at any given time across all my trades. Right, that's like the ideal kind of goal I have, is that because 7 to 8% on your portfolio, you can make that up pretty easily. And so like that's a manageable loss on your portfolio. You don't like it, but you can kind of come back from that without it being like devastating to your account. Keeping single trade risk low, try to keep it at 1 to 2% of your portfolio. And the key to this is, entering at a really tight spot where you're wrong, get out. And this is where I do a lot of trading on getting into a stock on the intraday charts. So I know kind of where my stops are. I may have to do it multiple times, but if you lose, 0.5% of your trade on the stock, that's not that big a deal. You can do it 5-6 times and still only lose 2-3%. And then I try to just get, like, my goal is to get 2 to 4 R on a trade. Typically 3 is what I like. And I just have this trade tracker that just gives me a quick update on what is a 2R, 3R return on my portfolio. And so that kind of gives me an idea, okay, if I'm there, I'm going to start to lighten up, and yeah, I'll try to get 4 or 5, but it'll be on maybe a little bit lighter position unless it's like a really, really strong stock that's really moving well, like a Circle or something that's been recently going crazy, right? So that's kind of the key thing, I think, is knowing your math. Like, what are the percents you're trying to hit? What's your max loss you're going to take on a stock trade and on your portfolio at any given time? And I think it's important to know how much risk you have on across your portfolio, if you're levered up especially, right? Like, what's the max you're going to lose? And you got to then feel okay or comfortable that that's not too much risk for you based on your trading numbers and your trading style. So I think that's an important thing for everyone to understand and to learn. So final thoughts. Final thoughts for me that I wanted to just leave behind was, number one, I think psychology is an overlooked area that people don't think about. And to me, I think that's really like a key part of your success in trading. A few things that I've looked at, a few books that have really helped me out in this area are Trading in the Zone. Atomic Habits is a great one that I'm not sure a lot of traders talk about that for trading, but little things, right? Make them habits into your trading process, and it can make a big change. And then Mindset for Winning as well is a great book that I think helps you understand how to learn to have good habits. So 3 books that I think are very good. to help you with the psychology portion of it and in terms of making habits. Find your trading style. Like I said, it's based on your personality. Don't try to imitate others. Go through that list of emotions and things and kind of think like, how have you handled some of these situations? Like a gap down, or the market's just going up and going crazy. Your portfolio size is going, the moves your portfolio is making in a day are just, not anything you've seen. How do you handle that? Do you just kind of think like it's going to keep going, or do you start to take some off and start to protect those gains? And so that's an impact on how your trading philosophy and your trading style that you start to develop. I think believing in your ability to be successful in trading is key. You got to believe in yourself. Like I said, if you've been doing this and the market starts to move up, like, believe in yourself. Like, hey, I'm feeling that this is happening, and based on all the studying that I've done on the markets and the technicals and the charts, it looks like we're making a turn. Are you going to wait around until it's made a big chunk of that gain, or are you going to be able to believe in yourself and put yourself out there and start to trade like it is moving, but have your risk in line so that you don't get hurt? I think the other two things that I think on X, I was talking to Mark Ritchie about this, was that your two goals are to manage your risk and make money. That's it. Tune out all the other noise. It doesn't matter, right? Like the news, the experts, the folks that are on TV and all that. Your goal is to manage risk and make money. However you decide, you can do it. For me, like I said, I have a few things that I do. One is that TQQQ makes money at the right time. I use it. I do it. And I focus on leaders. I don't need to go find, stocks that are going to double, triple. Whereas a lot of people are looking for those, right? But that is my main goal, is if I'm making money and I'm managing my risk, then I'm not changing what I'm doing, because it's going to, I'm achieving the two goals that I have. And so whatever your two goals are, if it's just, hey, I just want to trade Bitcoin, or I just want to trade AI stocks and that's it, that's fine. As long as you're making money and managing your risk, go at it. And then I think the other thing is set targets for your trading. I set 6 months goals, targets for what I'm trying to achieve, and then review those and see, kind of go back and kind of analyze what happened in those 6 months and make changes as needed to either increase those targets for the next 6 months or to adjust as needed, so that I can achieve some of the goals that I have for my trading and my portfolio. So I think that was the end of it. If you have any questions or anything, hopefully that was helpful for folks.
Yeah, excellent. Deepak, thank you so much for talking us through that. I definitely got a few questions here. The first, I think it's a great point you made about, finding your trading style, and we've kind of seen yours today in terms of the trade examples you shared. I wanted to hear how that kind of evolved a little bit, when a lot of multiple buys, testing the water, seeing how things stick during a day, taking it off, or some of it off, or all of that day's buy off if it didn't work. Because obviously, a lot of the books we read, a lot of people, they buy at one pivot point and then look to hold. William O'Neill did like to add a little bit as you goes, which is kind of similar to what you do. But yeah, if you wouldn't mind kind of sharing, how you develop that process and how you find it kind of works well for what you're trying to do in the markets.
Yeah, so it's definitely evolved, right? Originally I was just like buying if I was going to go big, I'd just buy it all at once and just put a stop in at 8% and stuff, and let it ride. And that's before kind of I really tried to like understand what I was doing and why I was doing it. The other thing, also, is that I trade full time now, so I can sit in front of my
be more active
and watch the trade. So that's part of the reason why it's evolved into that, is that I'm watching the markets all the time, right? So that's been the other reason why it's evolved. But also, it's just my personality, right? Like, I think I'm one of those people that needs to be doing something, and so like I want to watch it, but I also want to make sure that I'm active, and I get a feel also, like by doing this, like I get a feel for how that stock behaves, how it acts, and so that's helped me out as well. But I don't want to hold too much of risk overnight. So that's the other reason that I've been doing that. So this is actually, when you say how did it evolve, one is I started to do this full time, so I can sit there and do that. Number two, I didn't have success buying large all at once, and I don't think that makes sense, because you may be right only 40% of the time, or 45% of the time. So the other times you're going to get burned, right? So this is a good way for me to watch the market and try to pick at a stock that's in an uptrend and try to catch that big move when it happens, and be loaded up without being loaded up the whole time, and just going all in, if you will.
Yeah. And then as a hypothetical example, if you want to have end goal maybe 50% of your account in a name, your first buy, are you typically doing 20-30% of that? What's kind of your decision making process with that in terms of how much you might allocate to each buy as the stock progresses?
Yeah, I mean, to me, it's almost like if I buy something that's too small, like it's not even consequential to my portfolio and my account, then I'm probably not going to do it, because I won't be interested in it. So for me, I'm probably doing just a 20%, right? I'm going to buy 20% and as an initial buy, so that if it does move and it starts moving well, I'm going to make some money that makes an impact on my portfolio, and B, I'll start to lever that up then. Once I find like a good spot to add on to, whether it's during the day or whatever, and add on to it. And if it closes well, I'll add on the next day as well, right? Kind of like that GEV example I showed, and I'm just kind of watching it and trading in and out, and just kind of getting a feel for where the stock is going.
Yep. And then last question, by the way, this has been fantastic. You've mentioned a few times, you have multiple accounts. Do you trade them all the same way, in this kind of very aggressive style? Or do you have some accounts which you kind of consider longer term, more investing focus, and then you're more aggressive like this in your trading accounts? If you've got a differentiation between how you think about the different accounts you're managing.
Yeah, a little bit. I mean, like when I do my Qs, right? I mean, that's more of my longer term account, and so I'll hold that for a few months, or if I'm buying a Meta or something out, that's a account where I don't mind holding it for several months, and I'm not looking at that account every day or anything. So it's just kind of, I buy it if there's an opportunity, especially the T triple Qs. I'll buy it, hold it for several months, and then sell it.
Mm-hmm.
The other accounts I have, like some of the smaller priced accounts or some of the smaller stocks that I buy, I've got some smaller accounts that I'll use those as buys in those accounts, like like an Affirm or something like that. That's not very high priced, but my main account is I'm buying the larger stocks, the ones that are in the USIC investing championship. Those are the ones that I'm really trading like this.
Great. Well, this has been fantastic. Any last bits of wisdom or anything else you'd like to share to all the traders watching?
Yeah, I mean, I think there's a lot of great stuff that's coming out of the conference. I would definitely say find the topics that interest you, and definitely go watch them. There's a lot of good stuff out there, but everyone can do this. If I can do it, everyone can do it. It's not rocket science. It just takes some of these key, like I said, focus on the key things that are going to make a difference to your portfolio, and those are the ones you want to focus on, and tune out all the other noise and stuff that isn't important. And I think you can do great, and it can make a big impact on your life.
Excellent. And your X Twitter handle, that's the best place for people to reach out to you if they'd like to.
Yep. And just make sure it has the blue check mark there. So.
Yep. Awesome. Well, Deepak, thanks again so much for your time. To everybody watching, I hope you enjoyed. Definitely leave a like if you did. Check out Deepak here on X, and we'll be right back. Take care. All right, welcome back, everybody. It's my pleasure to introduce my friend and fellow co-founder, Ross Haber, who will be the next presenter at the TraderLion conference. Today, he'll be discussing modernized CANSLIM trading strategies for today's faster markets, basically how he's adapted the CANSLIM process that he learned from William O'Neill himself to suit modern markets where things have gotten a little bit more volatile, and he'll talk about the specific adjustments he's made that help him perform. Ross, of course, is a former portfolio manager over at William O'Neill and Company. He later went off to manage a hedge fund, putting this process to the test, managing hundreds of millions of dollars using CANSLIM and the adaptations he's made. Ross, thank you so much for being here. Looking forward to this. I think this will help out a lot of traders who are looking to develop their own process as well, using maybe CANSLIM as the foundation and then making adaptations that will help them all along the way. So first of all, welcome, and looking forward to diving in.
Thank you for the intro, and you said everything I would otherwise need to say for those who might not be familiar. So we'll start right there. Like Richard said, from over the last 30 or so years, from retail broker to hedge fund manager, I've watched the market evolve, structure has changed, things have changed. And so I thought I would share with everyone the things that I've adapted over that period of time, which actually started when I moved from O'Neill to the hedge fund. I had a significant bit more of money to manage, so I needed to figure out how to.
You could just breakouts at the base anymore. You
right. I wouldn't tell. Yeah, what I was doing in my personal account, and even in my firm account for O'Neill, it was not the size of the hedge fund, and so I had to do a little adapting, and so that's where it all started, and I'll explain how that all happened as we move through. So basically, let's overview what we're going to cover here. So like I said, overall market structure has undergone significant changes over that time. Let's say in 95, when I started as a retail broker, from roughly 2008-ish, the middle of running my hedge fund time, that's when we noticed that things used to be, I would say, the slower, more methodical, easier to navigate. Right around that 08 time, you could see the difference on the level twos. They started flashing a million miles an hour. What you used to be able to do no longer worked, right? We've gone from a largely human market structure, right, where we had floors of NASDAQ market makers yelling at each other on the phone, a very busy New York Stock Exchange, and now that's all but extinct, right? As a result of that, we've had, around that 08 time, what happened was high frequency trading, algorithmic trading became prevalent, where institutional volume accounted for 70% of the market. It's now about 90% of the market. So things are much faster, more volatile, and so we're going to discuss what still works from traditional CANSLIM, what doesn't work, a powerful new tool that I'm going to share with you guys that Bill's talked about all the time, and so that's the long and the short of it, and here we go. Like I said, the big change was the accelerated price movements, much faster pace and accelerated volatility due to algorithmic and high frequency trading. Also, right now that between social media and now AI and everything else, the flow of information to the reaction is almost instant, right? So, and like I said, we're now at 90% of the market volume is institutional, even though, let's call that 10%, right, retail, due to things like Robinhood and making it possible for everyone with $50 to invest to put their money in an account and trade. That has further added, at least to the very short-term volatility, reactions, shakeouts that might happen intraday over a couple days, that sort of thing. Okay, so moving on, here are the 5 main categories we're going to cover throughout the course of the presentation here today over the next hour or so, starting with assessing a stock's personality all the way down to our bonus tool of counting weekly accumulation and distribution in the individual stocks weekly basis. That being said, let's go ahead and move on to our first of 5 core categories. The stock's personality. So long story short, after many years of looking at tons of charts, building model books and that sort of thing, I had come to realize 2 things. First of all, where I noticed and observed, obviously, the sort of stocks Bill O'Neill was always buying. He honed in on the 2 or 3 biggest leaders and put all of his money in those stocks, right? And then I noticed what seemed to work the best, most consistently, after looking at thousands of charts, building model books. So the first category is what I refer to as tight, organized, somewhat predictable, often liquid stocks versus wide, loose, erratic, not always illiquid, but usually wide, loose stocks are not always as liquid as, let's say, some of the tighter, more organized ones, as you'll see when we look at some examples here. Back to where we started, Bill O'Neill stocks, I've noticed, always look like this one on the left. Tight, organized, predictable, right? You get some very clean breakouts. Sell stops are easy to set because it trades in a nice, tight manner. You can see it respects key moving averages quite well, which makes it predictable, right? It makes managing risk very easy, takes all the thought out of it. You're basically, and it's one of my techniques is to manage against a moving average, and we will discuss more of that versus, and you can see over here, and this, like I said, is not an illiquid stock by any means, right? Average volume, almost 22 million shares. However, you can see how much harder it would be, especially to enter on strength and then manage stops, right? Huge wide ranges. If you don't buy it exactly right, it's very easy to get shaken out. It sometimes respects some moving averages, but not always. You really have to be. So my point being is I will always stick to the Bill O'Neill style. That's what I've learned. That's what I've watched him stick to. It makes life much easier. It makes preserving mental and emotional capital much easier. However, if I find a stock like a Rocket Lab, which looks absolutely phenomenal on the weekly and monthly, I'm going to figure out a way to get in somehow, but it's going to be a completely different entry tactic. And obviously the sell stops I would use based on that entry tactic versus one of these. And that's what we're going to get into.
And what's interesting here with these 2 examples is that during this time frame that you showed, they both pretty much doubled. But which one would have been the easier ride? Which one would you have stuck with? And I think that's the key point between tight and organized versus wide and loose is, you want a stock that can make a big move, but you can also sit with. And I know, Ross, you could copyright the term aggravation-free trading, right? You want something that's holding the moving averages on pullbacks as supported and just goes from consolidation pivots. A Rocket Lab might be really great for more swing traders where there's a lot of more intraday volatility, quick swings. But for a position trader, kind of the tight and organized names are often the better way to go. I think a lot of people on Twitter really focus on the wide and loose names, which can have amazing momentum moves and momentum surges, and that's why they're being talked about. But often a Roblox, which has been one of the best names of this cycle really so far, but just isn't mentioned really anywhere on Twitter. So it's interesting, that divergence. But Ross, would you say there's a way to kind of determine, looking at a chart before it actually restarts a new uptrend, kind of judge the character of the stock and what it might be if there is a new uptrend? So basically, looking at 2 bases, how would you kind of determine and pick between 2 breakouts that look pretty similar, but one might end up being wide and loose versus tight and organized? Is it looking back in the history of how it traded and the character of the stock? Is that pretty much what you do?
Absolutely. I mean, unless it's an IPO, of course, right? Then you've got no history to base it on. But I'm constantly looking to the left. So that's always it. I look to the left. What's the personality of this stock? I was talking to Jackson about this the other day. He started to, we can find the best stock ever, but after a while you get a feel, or just like, that would be a great stock, except I know I can't hold it. I don't like the way it trades is what I'll say. I look at it and I'm like, I know I can't hold that stock. right? I saw a very funny meme the other day. I think they weren't talking about Rocket, but it was another one of these. I think it might have been CRCL, right? One of these IPOs that's whipping around that has a lot of promise from here. But, the meme was, the typical CRCL. I think a guy was being held up by and had his face being pushed into a turntable of the right. That's not the way you want to make your money, right? As your face is smushed up against whatever. So yes, that is the difference. If you can be, and I say this from experience, I can't tell you how right I have been on stocks that I wasn't able to hold. And so where does that get me?
Right.
So
yeah.
That being said, let's look at a couple more.
And there's circle. And one thing I want to add, Ross, first of all, is for me as well, it's to help judge the character. What I kind of look at is, are there a lot of wicks at the top of moves? Are there a lot of gap ups, gap downs? For me, that also goes in the equation whether something is wider and looser and a little bit more choppy or erratic versus more tight and organized. And I think ZS and Circle are two great examples, and both have great potential. But which one are you able to hold and enter while managing risk a little bit easier? So, Ross, I'll let you take it away here.
Yeah, no, you're exactly right. Like Circle is the sexy one that I can't stop watching. And not that ZS is terrible, but I will. You want to know the best part about ZS is I know from looking at the market yesterday versus where this chart is now, it's a few days apart. ZS cracked below its channel, and it makes it it's a very easy sell stop. And if you bought it back here, it makes, you don't really have so much problem if you didn't sell it all any into strength and you're selling it on the crack of the 21. And you're out, and then you can buy it back again. And honestly, that's why I love the reason I love the tight, organized, logical, predictable is if you buy them right, there's almost no thinking. The exit's done for you unless something wild happens along the way. Whereas the other ones, you're really got to be tactical, looking for tightness at key support, with a ton of, let's say, confluences backing you up there, because you kind of have to put on, it's harder to scale in these cases. I'm usually putting on 10, 15, 20% at a time with a super tight stop and trying to wiggle my way in that way in anticipation of a move based on its personality.
Right.
And so on the flip side, I have been I've watched the conversation, about which stocks do you own? You don't own enough of the leader. Well, Bill, the leader's all the way up here, right? Figure it out, right? And so I've also figured out how to pile like if I'm missing the leader, but it's one of these tight, logical, and it respects the 10-day, then you day trade your way into a position trade versus a short-term moving average if you have to. So anyway, I just wanted to throw that out there, just in terms of the different ways you're handling
was that a little bit
tactics versus personality, and the setup, right? The setup is important too, right? If you're trying to squeeze your way into at least a short-term extended leader, that's going to be completely different, even the way you're going to buy it a liquid stock normally, or a tight logic. And one more example, not to we'll kick it, beat a dead horse, but you can see the difference here. In this one, you break the 10-day, it holds the 21, right? And if you look to the left, it had that very similar thing going on. So I see what happens over here, and I set stops accordingly over here. And you can see again a quantum, one of these quantum stocks where if you didn't catch it, let's say on this day through this first consolidation pivot, it's much harder to start your position up here as it's whipping around. These are hard days to hold, and then you see what happens if you don't, right? This is just a much harder stock to hold. Why is it on my watch list? The whole group looks good. The weekly and the monthly looks phenomenal. So I'm hoping it tightens up and gives me a way in, right? So this is one of those stocks, or one of those stocks in one of the, a leader in a group of stocks that I'm watching to set up. The entire group is somewhat wide and loose. So,
Ross, a question for you. Does the bid-ask spread, does that also impact whether something trades a little bit more liquid?
Oh, absolutely.
And also, when you're putting on pretty sizable size, you don't want to move the stock much. And does that differentiate as well, the tight and organized names versus the wide and loose?
Yeah, I mean, when stocks in the 90s, when stocks traded in fractions, I didn't mind putting in a market order at the offer on a $2 spread. And some stocks were NASDAQ stocks that ripped would trade with $1, sometimes $2 in the middle. Now there's not that doesn't work anymore. If it does, you're going to deal with a lot more aggravation. So yeah, I mean, if you're looking at a spread now of more than a quarter, 3/8, or 25 to 38 cents, like 50 cents to me, especially now when traders are trading for. I'm still mind blown when I get a fill back with like 4 and 5 decimals after the dollar. Ridiculous to me. So it used to be to me 1/16 or roughly 6 1/4 cents a share. That was unthinkably small. Now we're talking about fractions of 1 penny, right? So. Again, due to market structure, things have changed. Yeah, and yes, those big, liquid or not, if there's a big wide spread like that, I'll just go find something else. It's not worth the aggravation to me.
Yeah, and one last thing I want to mention is the wide and loose names. Even if again, even if they're going to make a 200, 300% move in a month, or that's sometimes what these are capable of. There's going to be intraday volatility where maybe your position is down 15, 20%, and it's just normal. That's just what the stock does. Circle, obviously, amazing move, and then it pulls back 30%, is maybe building another base here, maybe sets up another move.
I mean, here's my point. Imagine if you bought this right here. Look at that explosion. Now, when I see that, I don't want to sell very quickly. The 10-day is really far away. Now imagine watching it here. You're almost back to even. And I mean, you want to talk about aggravation? It looks like, oh yeah, I just sit through that. Trust me, when you watch your stock go from, almost double and back in that quickly, it makes your brain do weird things that you're not used to, that you're going to be fighting against. Trust me.
Yep.
So it's very hard to manage, right? So this is just very hard. Where do you sell? And you know how it works. You start selling some, and the next thing it's like that stock that goes to 1,200. And that's always the struggle in your brain. So.
Yep. Awesome.
Yep. Moving on to entry tactics, right? So now that we've gone through personality, right, we decide which personality we're looking at. Now entry tactics. This was the big game changer. This is where, what I call, it's the hybrid of CANSLIM and Stan Weinstein's stage analysis, right? Old school textbook CANSLIM, the reason you're waiting to buy a base breakout within like 15 to 20% of the high near that base pivot is because now you've gotten through most of the resistance. You've now got confirmation. There's volume up the right side, all of that sort of thing. But what I noticed looking at Stan Weinstein's stuff is a lot of times what Bill might refer to as junk off the bottom would be Stan Weinstein's golden nugget, stage 1 into a stage 2A
uptrend,
base uptrend. And so I was like, okay, well, both guys have methodologies that work extremely well, and so I started looking and testing. And what if I entered here? If I have everything else CANSLIM lined up, from the fundamentals to the technicals, all the way down to the industry group, all shaping up well, early stage, that sort of thing. And it worked, right? I always say this, no need to back test and make assumptions. Start with 100 shares, start with 10 shares, start with 2 shares. I don't care what it is. Start small, and does it work? If it's working, make it bigger. And I mean, that's what I did to figure out that I could, Bill's junk off the bottom wasn't always junk off the bottom if you had certain characteristics present, right? And that's what we're going to discuss here, right? So this used to be, a stock like this, so close to the bottom. This was just way too early to buy in Bill O'Neill land. You're typically not even looking to buy anything until, like I said, within 15 to 20% of the high, because you're through most of the resistance, and that's where most people are looking for your traditional CANSLIM breakout. But Stan Weinstein watches for stocks what he calls stage 1, which is the bottoming process. Then there's stage 2, the uptrend. Stage 2A is the beginning of his uptrend. And what I noticed is a lot of times right at his stage 2A, and we'll get into this, you're breaking a downtrend, which if you draw the declining tops line, in many cases you'll notice all of the moving averages converging to the upside into a tight bunch, which we'll also get into, like we refer to as the launch pad. And then you'll see these breakouts through the swing highs as the stock begins to build the right side of its base, right? In O'Neill land, in the beginning, I was always scared that all this resistance here, why do I want to fight this here if it has the chance of rolling over when there's other stocks that are already stronger through that resistance, right? And that's a big thing. We actually covered that a ton at O'Neill. People would ask, why don't we buy down here? And we'd go through all that. Well, guess what? You can buy down here as long as what I'm going to show you is present. It actually works quite well. And I will say this, things like base breakouts and, which I don't use, Fibonacci, like the fib sequences, those are known to work. Hence, they are built into many of the computer program, the algos, high frequency, whatever it is. Much fewer people are looking down here. So I would say this is the breakout crowd. There's more eyes up here than there is down here. And I find these pivots, or what we call consolidation pivots, in the first half, let's say lower half of the base, tend to also work more frequently than the base breakouts, which tend to shake around a whole lot more these days.
Yeah, and going to the next slide, Ross, just to show a zoom-in view of the
yes.
consolidation
So here it
pivots.
is.
Yeah, basically what we're looking for is a strong base to form in a stock that has strong potential based on the CANSLIM characteristics, growth, institutional accumulation, all of that. And then we're looking for a push off the base low. And then, like Ross, you said, swing highs. And those become key resistance levels that create these breakouts. And what's great about the consolidation pivots is often you can manage risk tighter and more logically against moving averages. Ross, I know you like to use the 10-day moving averages as your stop typically on these consolidation pivots. And this allows you to kind of avoid a lot of the volatility that often comes near the true base breakout. And sometimes they coincide. Sometimes there's a consolidation pivot just below the base breakout. It allows you to get a little bit earlier, set your risk tighter, and have a little bit of a cushion to deal with that volatility as we get near the actual highs. Because, Ross, I know this is an observation you've made. There's a lot more breakouts that fail, reset at a moving average, reset at a consolidation pivot, and then work. But if you enter at the breakout, you're getting stopped out at those instances. If you enter a little bit earlier on the consolidation pivot, you're handling that and able to sit through that volatility. So, yeah, anything else you want to add? I think RKLB is a pretty good example here.
Yeah, and I would just say this is a consolidation pivot here. Let's say you can buy through this line, this line. I just drew some simple ones, and then you notice here you got this little mini bull
Short
flag. Look at it. You buy the flag. You got so it's anyway. And this actually in the beginning, you can see starts off actually quite tight. And then you can see once it gets to base breakout land, everyone's watching it. It fails. It gets wide and loose. And it doesn't take a genius to see that buying here is a whole heck of a lot easier than buying here, right? So much lower risk, much lower aggravation. And now you've gotten into a stock that gets wide and loose, and you don't even have to think about touching the breakout, and you can just wait and see what happens. So.
And that last consolidation pivot you pointed out with the 2 tight days at the top there, that's a little bit of what you're talking about. Is if you've identified a stock that's a leader, how do you work yourself in if you miss a lower entry, right? And you're finding spots with these consolidation pivots where it's tight enough that you can work your way in, buy part of a position and build into it if you missed, a prior entry point. So I think that's a good example right there, right. Up the right-hand side.
And one thing, to be fair, I noticed short term, we're a ton of resistance at the green line. So that's what I'm looking,
that's the character.
Why I use the green line on the way up. I assume that will be short-term support on the way up, the way it was resistance on the way down.
So that's a good example of learning the character of a stock. Perfect. All right, I think we've got maybe another example here. Yep, go ahead.
So here's another quick one. You can see base pivot. and this is still quite early, well below the all-time high. But you can see here, you almost got like a little mini cup and handle. It's not a cup, right? And this is the thing, right? It's all I forget what's the word I'm looking for, like this. It doesn't matter. You could almost call it a mini.
It's semantics.
Maybe that's what you're working shoulders, cup and handle, whatever it is. And my point being is, as long as it has those, even though textbook-wise all of that is wrong, it's not long enough, it's in the wrong space, so on and so forth, but it has all of the constructive characteristics, and so that is also very helpful to understand that all is applicable down here. And again, so you can see you're working your way in as it's just working its way up through its 50 and 65-day exponential moving average. That's what we have over here. I don't have the 200-day on here. And again, look how much easier it is to enter down here than waiting for up here. What I wrote here, or this declining tops line across the highs of the handle, this is the Bill O'Neill early cheat. If there was enough volume here, he would 100% start buying on the break of the declining tops line of the handle. I've kind of made that much earlier. Why, and as you'll see, you can draw the bigger declining tops line, which often lines up with these consolidation pivots and the moving average cross. So.
Yeah, and just to dive a little bit deeper into this example, in terms of how I would interpret it, we've basically got a transition, like you said, from a downtrend below the moving averages. It finds support, builds structure there, forms an inverse head and shoulder, if you can kind of point that out, Ross, at the lows of the base. And I think the word you were looking for is semantics. What do you call a pattern? Doesn't really matter. We're looking for constructive price and volume action where we push lower, form an intermediate low, find support, push higher, tighten, and you've got a lot of tight areas on declining volume there, especially before the first consolidation pivot you point out there. Look at the volume in those tight ranges right there. That's constructive price and volume action, and what you're looking for as a suggestion of support. It respects the moving averages, a change in character, and it's interesting because I might draw this pivot a little bit differently. I typically like to almost ignore that wick that you drew it at and draw at the top of the range before, but it's all looking at the same thing, or using that.
You can absolutely do start, and I will do that also. Start at the top of the strong, right, because that failed, and that's another. And you can also draw the little declining tops line there and all of that jazz. And like Richard said, you get the super tight closes. This shakeout right here, that is all super constructive. And once you begin to start to notice these patterns as groups are working and you develop confidence, you'd be surprised how many times I've started to, I'll buy this day versus the green and the, because you've got such easy support there if it's a liquid name. And I will often, how many shares can I buy 10% down here? And if I use my red line as my line in the sand, can I afford to do, how much will I lose? How much can I afford to do that with? I'm always, what's my risk reward? Can I keep my risk to 62 cents with the potential of, 2, 3, 5, 10 times, right? I want to make sure I can make, I can make at least double, right, what my risk. So that's all I care about. Risk reward. How am I managing my risk? And does the stock I'm buying and everything I'm looking at, is there enough edge? Do I have the wind at my back? Am I the house? I want to be the house. I look at it this way. Counting cards they don't let you do it because it works. It makes you the house. I look at it this way. If you have the patience, right? There's only one market. You can't switch casinos. You can't switch decks. But I feel like when everything's working and you're disciplined, you have just as good, if not better odds. I would say even better odds than the guys successfully counting cards and making money that way. So, however, it takes patience. When the deck goes cold, and it goes cold, and that can be hard.
And one other question here, Ross. In this instance, I think first consolidation pivot, we do get a gap up through that. How will you typically handle it? Will you just see, can I manage risk at the 10-day moving average here, and just work your way in as it proves itself throughout the day? Or do you avoid when there's a gap up to the consolidation pivot at all? How do you typically handle that situation?
Yeah, so it depends. You're right. So if the beginning of that gap is close enough to wherever I can manage risk, then fine, I will do that. But in general, buying strength, especially in, today's markets, it's just harder in general. And I do everything I can to unless it's, what I would consider one of those buyable gap ups after earnings and I'm really honed. But in general, I'm either going to wait for a new setup or my risk to be more. At the end of the day, if I can find a new spot or a way to keep my risk tight and feel like otherwise I'm either going to move on to something else or just wait for a better spot. Chasing strength was absolutely necessary in the late 90s. Doing it now is a bad idea.
Yeah. Would you wait for maybe an inside day after that gap up and then manage risk versus the lows there? Would you kind of work your way in that way?
Yes. I mean, in general, 99.9% of the time, I'll always wait for the next day. And if it leaves the station without me, it's very frustrating. It happens. But in general, I have found I will get a chance. It'll consolidate or give me an inside day or two. And then you can manage it versus the low of the prior day, the low of that day. Waiting one day gives you a lot more options, assuming it doesn't just gap again and leave the station, which is annoying, but...
Yeah, and this is another benefit of the consolidation pivots versus the base breakout is because if you miss the first one off the base lows, there's probably going to be at least one or two or maybe even three up the right-hand side where you're still technically early, but you can just find one that gives you the risk reward, allows you to manage risk versus the moving average, allows you to manage risk versus the range lows, the prior consolidation pivot, whatever it is. Find one that fits kind of what you're looking for versus waiting for the base breakout where it's one shot and maybe the risk reward is great there where it isn't straight off the bottom, but sometimes it isn't. So that's another benefit of the consolidation pivots.
Yeah, I mean, the bottom line is this, like in the very beginning, the thought of buying a stock in the lower half of its base was just, that's just an absolute not a chance. And now in general, when I'm trying to buy a stock on, I usually have a full position on in the lower half of the base. If I can, sometimes they happen a little higher up, but using these points, it gives you a huge advantage, especially, when you get to that base breakout. If it's not set up exactly how you want it, you can ignore it and wait. And if you miss it, who cares? You already got a position on. And if it sets up perfectly, now you can pyramid on a little more and look to sell it proactively and reduce your average cost even more on your original position, that sort of thing.
Excellent. So do we talk about we've got one more example. Okay, go ahead.
Yeah, and I won't get it. Again, visually you can see you got and we're going to go through this next. The launch pad, you're breaking, the downtrend to the upside. You get your first consolidation pivot here. Again, you can draw even the declining tops line here. So the O'Neill in me makes me want to buy it through the consolidation pivot above all of its averages rather than starting below all of its averages, right? However, that worked, right? So, and you've got the big, and my guess is this is earnings here, right? You test the gap and then you're off to the races, and clearly that's and to be quite honest with you, let's say this is you're much closer to traditional entry up here near the highs past. And you can see you just get a whole lot more aggravation here before it actually gets going than if you bought it down here and used the 10-day to get your way up in there.
And this one, Ross, so you're looking at the consolidation pivot where it is, the tight and logical spot for me to manage risk here is versus the 50-day moving average, the red line there. Would that be kind of what you were using to set your stop at pretty much if you're buying that CP? Yeah.
What I do, so here, I would split probably between the gray, which is, the 50. Oh, wait, the 50 is the red. So I would use the 65 first just because it's there. Mm-hmm. But yeah, I would be splitting between the gray and the red line as sell stops. And then at this point, I always use the prior consolidation pivot, assuming it's not too far away. Or a lot of times, I just use the breakout. If I'm buying extended above the 10-day, I got to be right. I'll use the low of the low of that day. And as long as it holds in there, I'll give it to the next day and see what happens.
Yep. Great. All right.
Right. moving on to, and so I've kind of started talking about this. So this is a funny one to me. As I showed you before, Bill O'Neill's a big fan of drawing a declining top line across the highs of the handle. However, and this is this is technical analysis 101. You draw a decline here, and let me just go to our first example here, which is that you're drawing a simple trend line, 3-touch trend line, and when you break through it, that's your first sign that you're getting through the most recent downtrend, however long that was. This is Stan Weinstein's stage 1 into stage 2, and you'll see that comes right. So you're buying, and this is another thing that I'll do: buy through if the moving averages are close enough like this, through the moving average with the sell stop just a little bit below the moving average to give it some wiggle room. But you see this happens before your first potential consolidation pivot here, but you see how it all lines up, and that's why I say if enough things are, so if you're looking at a CANSLIM stock, right, you've got to have all of the fundamentals in line. It's got to be early stage base, group participation, and you're seeing preferably the whole group starting to, like, the market's moving higher, the group is all now moving from stage 1 to stage 2A, have a similar pattern, moving averages are starting to cross. That I have noticed. Oh, and especially what originally gets my eyes on these things is watching relative strength. I'm always watching relative strength as the market corrects. That's always letting me know these are the strongest stocks during that period. These are the ones where there's an absence of sellers at a bare minimum, if not somebody buying, supporting a stock while the market's going down.
Yeah, great. And like you said, all of these are kind of happening in the same general area here. The first consolidation pivot, the launch pad, and this break of the DTL here. So that confluence gives you confidence. Confluence gives you confidence. I just coined that term. And then all the moving averages are right there to act as your logical stop.
Right. So your major resistance turns into your sell stop, and then this is one of those tight liquid, right? And the 10-day basically keeps you in the whole way. Even you can add here versus the 10-day. It's not that far and it just there's nothing to think about. And if you're getting in down here, right, even here, by the time you're up here wiggling around, and the 10-day and the 21-day are so close, now you don't have to worry about $3. You can let it wiggle around a little bit. You don't have, depending on how far these are apart. If it was a longer trip from the 10 to the 21, I'll sell a third to a half possibly. But here, I'm not even thinking about it. Who cares about 3% if I own it in the 60s and 70s, right? So that freedom, lack of aggravation, preservation, to me, that ease of my brain at the end of the day is worth more than the $1 million I'm trying to make, if you know what I mean. When I was younger, I could deal with it. Now that I'm older, I hate aggravation. So
now that you're old.
Yes, now that I'm old. And again, same sort of thing here, and I wanted to show you can draw a longer term, right? This is your real downtrend break. However, as I'm watching the moving averages turn up, the big volume come in, things are acting well. I'm going to pay close attention here. This is still a very valid 3-touch trend line, and notice how the confluence is right with all of its moving averages. So now you're right, you got the moving averages. You're a little early here, but they're all now rising, converging to the upside. You've got big volume coming in after you test the gap in a big, my guess is this was earnings here. And so you're breaking through major resistance. You can start here. You can add, there's so many places where you can, there's no, right, at the breakout, you're kind of all or nothing. You got to get your position on, hope it doesn't run away, hope it doesn't fail. Or if it runs away, great, right? But hope it doesn't fail. Whereas you've got all the time in the world to put on 5%, add on a pullback to key support, buy the next, you can take a deep breath. There's not as many eyes on it, right? So the benefit is clear. And then you've got all of, right? And here's another, and I would say this, when you got a stock that clearly respects the 10-day moving average, let's say you didn't put on enough down here and it gets up through here, you can buy it versus that 10-day moving average. Wait on the days till it's within, let's say, 0.5%, and set a 1% sell stop. That gives you 0.5% below, wiggle room below the average, right? On a day like this, it's going to shake you out. right? But in general, if you bought with the half, right, using that tactic, you're gonna wiggle your way into a stock that would otherwise look extended and still be able to manage risk. And last example, ASTS, similar, right? We've got the longer term declining tops line, the shorter term declining tops line. I didn't even draw your consolidation pivot here because you can get in before that. Sometimes I'll even draw this here. I'll draw the line across here. You can buy through here. You could have bought here. I'm always trying to accumulate, right? Get on a good, if I can get between 10 and 20% on down here, I don't have to think about this up here. And I'll tell you the way this is what I consider a straight up off the bottom move to new highs. That is failure prone. It didn't fail this time, but I won't buy that, period. Because most of the time, that's going to give you the hard way to go before it actually breaks out. It didn't. So that's, so there's clearly extreme power here. This is unusual. But what I love about it is I can get on a full position here. I'm up $8, $10. I don't even have to think about it. I can wait. Oops, it took off without me. Now I got to wait for a new entry to develop with what I consider optimal risk reward. So, anything else there, Richard? Or
no, just that was a more of a wider loose name in the base, but then as it pushed out on big volume, it kind of changed character. And though it did break the 10-day moving average, so we'll see. This was a name that trended amazingly, and then look how choppy it was in the space, buying any kind of trying to buy strength at all until this most recent kind of base on base or base within a base developed.
Yeah, if you did it here, you were very unhappy, and I can't tell you how many that happens. But then you got to be, if you manage your risk well and you're still watching it, you got to be willing to do it again. And I will say you are right, personality wise. So I've got two tactics for getting in these names. That's either putting them all on it, key support, or getting that first early push, and it's got to work, right?
Yep.
So you got to put on a tight stop, and then otherwise you just got to get out of the way because the potential pullback will get out isn't worth it. And again, the launch pad. So you've seen the green circle, right? I've kind of gone through this as we've gone through the other charts. Simply the area again, and it often happens right as you're going through the downtrend. First consolidation pivot. All of the moving averages you see here start rising. I always say convert. The tighter, the better, right? And on my normal on this chart, we have 4 moving averages, 3 simples, the 10, 21, and 50 simple. I put on a 65 exponential. That's an average that I use. I'll be honest with you, I put that on just because I know that I always have a 200-day on my chart, but I knew it was going to be relevant to this presentation, and I don't want to get too deep into this, but I have found that the 65-day exponential will often be where stocks find support that break the 50-day. Do as you wish with that. That's why it's on there. I also, in general, will keep the 23 exponential to catch stocks that break the 10. So when I say in a tight bunch, I'm usually looking at 6 moving averages, so it's easier to spot. However, I'm not suggesting adding moving averages to your chart. I think the cleaner, the better. I've only added those 2 exponentials recently. I used to only have the 4 simple moving averages, 10, 21, 50, 200. That was it. So moving on again, right? Same thing. You're through the downtrend. Moving averages are all crossing up right at that consolidation pivot. Right, so it's letting you know there's significant. This becomes significant to me here. So you can actually buy a little bit of. You can buy the gap with a low at stop at the low of the gap. It's tough. I can't measure here, but what I do like is that becomes a significant area of support to me until it breaks again. And one more, and we've already looked at this one a bunch, so we won't get into it, but you can see again where all the moving averages cross is right around that longer term declining tops line break, right? That stage 1 to stage 2A, right as you're near that first consolidation pivot, which we drew on the other charts is here. And I will say this very often happens. The most powerful time to buy these here is as a market is following through, beginning a new uptrend, and you're looking at the strongest stocks with the best earnings, all doing that's your hot deck right there, right? You've got your follow through day, and the qualitatives, right? The health breadth of the market is telling you this is a follow through day that's going to work. So.
And when a whole group is doing this together, when all the software names are doing it together, cybersecurity, when themes are shaping up, that gets you more focused on that particular theme. Is that right?
100%. 100%.
Yep. All right.
Yep. That is, one of the things that from traditional CANSLIM and sector and industry group, that is as powerful as ever, right? That those stats still stand the same. If I'm not mistaken, 49% of a stock's move is directly related to its sector and industry group, 37% industry group, 12% sector. That is always a huge, right? That, like you said,
that's a hot deck too.
That group confirmation is big, and then also relative strength, which we'll cover a little bit. That's still my edge, and it was my edge in 1998, and is my edge today, right? So. We just want some basic position sizing here. I think is relevant because managing risk is so important. The two ways to manage risk is either sell stops or position sizing. And I think it's important for people to understand the basics of backing your way in relative to the risk you're willing to take. And then with experience, you begin to develop a feel, right? You go, a stock that looks like this. So I know now that for me, a 5% starter position is no problem. But I used to start with maybe a 1 or a 2% starter position. But with time, then I know 5% is easy, but I also know what 10% feels like. So that feel you develop also will play a part into, right, as you're making progress, pattern recognition, personality of the stock. But this is how I always started. And this is where I'm always starting, right? If I want to add a position, pyramid a position, all I care about is how much progress am I making? How much can I afford to lose? And is there a tight logical sell stop that stops me out there? And tight logical meaning if the trade isn't a failure there, then it's not logical. You're just shaking yourself out for no reason, right? So it's always risk reward, and this is how you do it, right? So look at the personality of the stock, and obviously more volatile stocks you're gonna buy less of. The more organized, liquid, tighter trading ones, it's tight, lower average daily ranges and all that. Obviously, you can buy more, and it's easier to manage risk. Again, why I like those tighter, more liquid, organized stocks that tend to respect key levels of support. Just makes life easy. But it's simple math here. It's worth understanding. You want to start how much am I willing to lose on this trade based on where I am, and develop a feel from there.
Yep, great.
So now, scaling into positions, right? So, and this is kind of, I think, obvious as we've gone through the examples already, right? Instead of waiting for that base pivot where, the breakout crowd is focused, you now have, I feel like you've got plenty of time to start accumulating in that lower half of the base. Like I said, I rarely have trouble getting on a full position in that bottom 50% of the base. And I can decide to buy the breakout, not buy the breakout, if it looks beautiful, pyramid a few, or just stay away altogether if it's a straight up off the bottom move, which is, it's so freeing. I can't begin to tell you after the frustration of, dealing with having to put on larger positions, and you got to be right. So being able to scale in as the stock proves itself and not feel like it's getting away from you is a big deal. So this is just an example strategy to give you an idea. But again, depending on the setup, the stock's personality, it's always going to be a little bit different. And I would say this too on exits. Even for a stock like we looked at earlier, a ZS, that's crap. A lot of times I'll draw that rising bottoms line, if you will, or that bottom channel line, which often lines up
Coincides with the
10-day moving average, and I'll split the sales between the 10-day and the 21-day. So that way, maybe I sell a third at the 10, and if we get support at the 21, like the left side shows me it does, hey, now I've saved the half to 2/3 of my position, and I can add, I've protected myself, and I can add that back. And again, some more examples, just very simply, you can see here, there were 6 valid early entries over a 3-day period, still in the lower half of the base, way before you got up. And again, right, this is one of those straight up off the bottom moves. If you buy the breakout, it's not a bad retest, holds the 10-day like a champ. I think if you look at Coinbase today, it's probably somewhere near 400. So again, right, if you had missed this down here, you didn't want to buy the breakout, at least it gave you a chance to buy it versus that 10-day moving average. But it doesn't always work out this nicely. The beautiful thing is here, if you have on 20% and you add 5% here, you can afford to let it fail and go to the 10-day and let it wiggle around. This gives you so much freedom. It's amazing. And again, you have to be able to hold your stocks to make money. I can't tell you how many times I've frustrated the what out of myself because I picked the right stock. I owned it, and somehow I lost money in my stock that I was right on, right? And so I had to figure a way to make that stop happening, and this seemed to be very effective. Again, right? Start small. You can watch, right? And I'm seeing signs of institutional accumulation, support at key levels, add another 5%, and before you're even but you can watch the move literally move halfway up off the bottom, and you're still way before the textbook CANSLIM. So that is the point, really, right? And so here's another example, CLS, and this actually gives you a nice double bottom base, and here is actually your traditional double bottom base pivot. It is and it isn't, I would say. If I were to have Bill O'Neill here right now, it's a little bit low. A
little bit slumped.
Not a perfect double bottom to say the least, but if you were to look on Twitter, people are going to call this a double bottom. So I'm just going to, let's say you're referring to, you still have several ways to get in before you even get to that point. And even if you're buying there, if you want to call that traditional, I have a hard time with it just because it's still, I guess it's just a big, deep correction, right? So when I see the big, deep corrections, I tend to, again, that's the traditional CANSLIM in me that tends to make me very careful when I see when I see a formation in the lower half of the base. I don't like it as much as when it's in the middle to upper half. And so anyway, a picture is worth 1,000 words. Whatever you want to call it here, like Richard said, let's not get into the semantics. Establishing a position here, I say this is borderline early entry because this is, I think I did the math, but you're roughly 20%. Right, you're right at that, the borderline of should I be buying this far from the high? And so again, just a simple example of how getting in early, and then in this case, except for a few times, right, you get a little shake below the 10-day, and I won't get into the nitty-gritty here, but I have rules for managing shakes below the moving averages that typically, let's say 7-8 times out of 10 will keep you in for a quick shake below an average like this, and in this case it would have.
Are you waiting for a close below that level? Or are you watching for a break of the low of the day it breaks below? Just to give a little bit of detail there.
So, in general, right, I'm watching on a closing basis. So on this day, and I always let one close below. And so this turns out to be a shakeout and ultimately a constructive close just slightly below. I leave that alone. And then the following day, I like to see an immediate recovery. My number one, now, mind you, my intraday, this is one of these times, there's 2 times I use intraday sell stops. If I'm putting on a full position at key support, I'm not waiting for the close. You can't afford that. You can't do that. If you're going to put on 20% versus an average, you have to have an intraday stop line in the sand. And in this case also, after your one close below a key moving average, if I break the low of that, sometimes it recovers. I don't care. I'm just out. So as long as it doesn't break the low, sometimes I might give it a day or two to recover that average, but I never sell I wouldn't say never. If that break below and my cost is at a point where that stops me out because I've hit max stops on that trade or whatever it is, well then max stop rules will always
Supersede.
supersede every other rule. But yeah, so I'm always want to see. It's usually a second close below. But I might wait for it, depending on how it is. If I get a nice constructive inside day, or I might give it another day again, and then using either the low of the prior day again or the original low as my stop to, wait for it to recover that average. And that works. You'd be surprised how well that works. All right, so now we're moving on to sell stops, which, as I said, is the other core part of risk management, right? We have position sizing, sell stops. So this is just basic. What we're going to look at here is just, there's nothing really new here. The point that I was trying to make, and Hood is one of these tight, liquid, organized, respects key moving averages, big institutional ownership. You can see how easy it is, right? You can buy here, day low, sell stop. It just works. It's the nature of the stock. Again, here you can buy your first consolidation pivot. I wrote, right, 10-day works. The 10-day, if I'm not mistaken, was 59 and high change, 80-ish cents. So $60 is also right? So I love the confluence of both 60 and the 10-day. I'm aware of both. Again, right here, you got the 10 days super close. It works. And like I was saying before, if you're seeing this sort of respect, you're free to add versus that 10-day moving average, right? And then even again, so you can just see how this makes life so easy. There's the nature of the stock is little aggravation. Whereas, and I don't have an example, but the whippier stocks that every time they whip up will pull back a whole bunch, right? Those are going to be the ones that you've either got after a constructive pullback, you've got to be, in immediately on the first bit of strength through any short-term declining tops line with a really tight sell stop. You essentially have to be right at support or at that first push off key support if you really want to have a little confirmation and strength. And it just, right? So that's the difference is you're when you're wiggling your way into the more volatile names, you're using much tighter stops, buying more at key support or that first sign of strength from key support, because once you get too far extended, aggravation becomes the theme of the day. And that's really what you're trying to avoid. So point being, sell stops are tactical based on personality in the setup. Other than that, there's nothing new. Otherwise, all the rules still stay the same. The most important rule, if you don't have a tight logical sell stop, you don't have a trade, right? If you're looking, I don't care how good the stock is, if you can't come up with a tight logical sell stop, wait until you can or find a new stock. Just keep that in mind. That'll be the most important thing you can ever remember. If you don't have a tight logical sell stop, you're gambling. Just remember that, right? So I'm glad we went through that. I should have had that written down somewhere, but that's important to remember. So here we go, relative strength. And we're going to get into distribution days, which don't work as well. But we're starting here. Like I said, in 1998, relative strength new high before price, as especially coming out of a correction, was my go-to edge. And I've got a couple examples here. You can see this was right around as the market bottomed and followed through. Earlier this year. And so you can see, right, I draw the high line here across the stock, the highs, right, from the corresponding relative strength line. And you can see here, look at this relative strength line. That's what the pink dots are. It's letting you know we're making new relative strength highs, but you can see prices just getting through these moving averages. So like I was saying before, when I see a whole group, right, of stocks doing this, the launch pad, the break of the declining tops line, the proper price volume, a follow through day, and this, and sure enough, don't be surprised. Wasn't surprised to see Netflix was one, if not the first stock, it might have even broken out before the follow through day, but it was absolutely one of the first stocks to break out. And you can see using the green and the yellow line, no aggravation. All you had to, right? So you could have even, and this is one of those cases, and I'll just say here, this is a breakout I would have missed. These are failure prone. I hate aggravation. I don't want to deal with this. I would have missed this trade if I had not started at the consolidation pivot, which I did.
It's amazing the first RS new high before price is like 1 day after the base low. I mean, that's amazing. So this allows you to really focus on the name and focus on the next consolidation pivot, right? So this is a great way to get it on your radar. We've got screens in Deepvue that look for RS new highs versus price and get you a list of stocks forming the same characteristics. So this is great. Yeah.
We've actually got one in Deepvue also that finds Launchpad, where all the moving averages are starting to cross for you. And so one more quick example. This one didn't happen as low in the base, but this wound up being a leader, I guess, until over the last couple of days. Software cracked a little bit. But Rubrik, this is part of the AI theme software group. The whole group was working at this point, and here you are again. Relative strength line is yelling at you, hey, look at me. Don't miss me, I'm stronger than everyone else. As obvious as that sounds, I can't tell you how. So when I see all of those things lining up, the relative strength, new highs with price, in addition to all of the others, that goes at the very top of my watch list, right? That relative strength it's been my key since the 90s and remains the staple that puts every stock on my screen in the first place for the most part. Volume, but sorted, even if it's an up on volume screen, it's always sorted by relative strength, period.
And one thing I like to do is, Ross, can you point out when the relative strength line first gets above its signal line there, which I don't know if you have the 21 EMA or the 50 there, but over to the left a little bit, the first time. Yeah.
Relative strength phase,
yeah.
correct.
I love looking for the first consolidation pivot or first range up the right-hand side of a base when we begin an RS phase. That's what we call when the relative strength is trending above its line. So that's another characteristic to look for in addition to the RS new high before price, to say, okay, focus on this name. If it's got all the other characteristics, Rubrik, recent IPO, showed a great potential with a really nice move coming out of its IPO base beforehand. That's why we're watching this stock. It's cybersecurity, it's software, it's got all the characteristics we're looking for. Now, what is the technical edges that we're looking for to say, hey, this is ready to be, traded? Well, it's maybe the start of the RS phase, the first consolidation pivot, or the RS new high versus price. This is how to get its name on your radar and basically it letting you know that it's ready to potentially make another move. So that's one more thing I figured to mention with the RS line.
Absolutely. And, as I'm sitting here making the observation, I might have to start paying attention to if the relative strength line is doing this. Maybe you don't need as much of a consolidation here. I'm trying to figure it out because this is a very recent observation because I've seen a lot of these breakouts straight up to new highs I've seen more of them working lately. It still won't get me to buy them because the majority of the time I've run into trouble, and which is why, But it also makes it very easy. Let's say you wanted to buy this. You can just buy the breakout with the sell stop at the low of the day. And lo and behold, the nature of the stock, the strength of the market, the relative strength, you had all the wind at your back. You're in, right? It's like the hot deck cleaning you up at the blackjack table. There's not skill. It's the order of the cards. It's math. You have to win, right? So that's what you want. It's what you're trying to do here. Rather than having a poor market exacerbate mistakes, you want a strong market cleaning up your mistakes. Exactly. Makes you feel like a genius when you shouldn't. You got to be careful of that too. That's a whole nother story. So we're not going to spend a lot of time here. So a distribution day in the textbook is any day that falls more than 0.2% on heavier volume than the prior day. Doesn't have to be above average. Volume increases, days down 0.2 or more, distribution day. For starters, the distribution day count used to work like an incredible timing, one of the best sell side timing tools ever. 2-3 distribution days over a 4 or 5 day period, leadership starting to break, get out of the way. Sometimes it broke immediately. Sometimes it'd try and wiggle you back in. But if you watched it work as many times as I did, you just sat there and like, And usually within 2 to 3 days, it made you feel so smart. Holy cow, I just avoided a nightmare. That doesn't work anymore. There's many reasons for that. I have a buddy in Chicago that is a huge algo HFT guy, and he's let me know in no uncertain terms that he can manufacture distribution day if he wants to. So they are very aware of that. I would say that is a contributing factor, to say the least. They can also manufacture follow-through days, and this is why the qualitative clues have become oh so important and more, right? So the follow-through day, in the very same way, literally, it's just this, it works more consistently than the distribution days, which I use. Again, the distribution days are helpful in addition to the qualitative clues, whereas follow-through days still work as well as they always did and has always been. What do the leaders look like? Because you can have follow-through days that fail, and I'll tell you, it's almost very easy. If you're paying attention to the leadership, it's typically easy to tell which ones are going to fail and which ones are going to work just by the way leaders are shaping up. It took me a long time. I'm not going to say to figure it out. I can't tell you how many times the guys at O'Neill, whether it be Bill or one of the other more senior portfolio managers, I'd ask a question. They'd be like, Ross, just watch the leaders. Just watch the leaders. And I'm like, man, that's such a blow-off answer. I'm bothering you, aren't I, right? But no, those 3 words are everything to watch the leaders. If you want to know what the market's going to do, watch the leaders.
And so,
right?
Yeah. And so the qualitative factor you're talking about with both the distribution days and the fall through day is, what are the leaders doing? Are they shaping up in new bases altogether, breaking out? That would suggest the fall through day is much more likely to be successful versus if there's no setups, or names are still low in the base, not really looking ready to make a move. That's the qualitative factor with the fall through day. And then with the distribution count, for you, watch the leaders is much, much more important now, because these can provide a lot of false signals, maybe because of the increased volatility, the HFT as you mentioned, and it's just much more helpful to see what are the top 10 liquid institutional names doing. Are they just trending, or are they breaking lower on volume, changing character, becoming more volatile, more wide and loose? Those are the qualitative tells that you're looking for that are much more important than this in terms of your gauge of whether the market trend is healthy or going to continue to be an uptrend. So just thought I'd add that. Yeah,
you're exactly right. And unfortunately, I wasn't able to go and look, but I'm going to tell you, right? So I've seen this happen way too many times post 2008, an 8 or 9 day distribution cluster. But if leadership looks good, ignore it. Right? So it's certainly no short-term timing tool. However, if I start to see a lot of distribution days clustering up, I'm going to look at leaders and I'm going to go, well, are we closer to the beginning of a market in early stage basis, or are we looking at a bunch of stocks that are, stage 3, stage 4 that have all moved 100% plus and are getting tired, that, are some of them starting to break, show signs of exhaustion, climax tops, that sort of thing? That is when I'd get concerned. But for example, if I'm like that, you see software stocks break, but the crypto related stocks and semiconductors pick up. As those stocks sell off, these gain all of the rotation. That's what ultimately holds up the market, is healthy rotation. So it's fine if the software stocks crack and take trips to their whatever it be, the 21, 23, 50-day moving averages. They're allowed to do that. The key is rotation into other healthy sectors ultimately holds up the market, and that's the hot deck, right? That's what I always want to see as it's breaking. Not so much is there something wrong with these stocks? I don't care if they're correcting after a big run from an early stage base. The more important thing is, are there groups of traditional stocks setting up that I can now move into that I would say can maintain the uptrend? If the answer is yes, I don't care how many distribution days there are.
Great. Yeah, I think we can leave it at that. Perfect.
And so finally, this is the last section. It's funny, I've sat in a ton of meetings with Bill O'Neill, portfolio and manager meetings especially, and we went through this technique in detail, right? So mind you, this has nothing to do with counting distribution days on the indexes. This has strictly for looking at individual stocks, weekly basis, looking at all of the weeks on above average volume, and then assessing, and this is going to take us back but anyway, assessing whether it's an accumulative week or a distributive week, and don't just, if it's red, bad, blue, green, or blue, good. You have to look at what was the volume, what was the closing range, and interpret it that way. And what you're looking for is more accumulation weeks than distribution weeks. If it's a tie or less, find something new or wait for more accumulation to appear, right? So I always do this. I want to make sure that this is on my side. If if for some reason I think everything looks perfect and I'm looking at, 2 or 3 weeks of distribution and 1 week of accumulation, I'm a little bit leery there, right? So it helps you keep your eye on all time frames as well. All right, so let's go ahead and take a look at an example so you can see what this looks like in real time. Again, we're choosing Netflix. This was one of the first leaders out of the gate for this cycle, right? So what we're going to do, right, is look at this weekly base starting with the first week down. That's the beginning. And what you want to do, like I said, is you're only counting weeks with above average volume. Since we're on the weekly chart, we're looking at 10-week simple moving average versus, like the 50-day average volume on the daily, right? So our first week here is a black line. Even though we closed down, right, this is more neutral to me. We get support, close well off the lows. I'm going to give that a neutral more than a distributive action, even though it's red.
And to determine, and just to clarify, to determine accumulation versus distribution, we're looking at where the close was relative to the range from the high to low. So if it closed, 40% to mid bar, it's kind of neutral, like you said. If it's in the lower third, for sure, more distribution. Upper third, upper half, more accumulation. Just to clarify for folks.
Yes. There are times where 40% off the bottom, if everything else is I've seen Bill refer to as still not distribution, right? Because I always used to like to think of the 50% mark, right? Below, not good, above is good, but really I use 40%. Like I will make 40% the line given context, if that makes sense.
Yep.
All right, so you can see here we've drawn colored lines across all of the weeks of more above average volume, right? And so this week here, above average volume, right? Close in the lower third below, right? The 10-week and 20-week moving averages. So we're moving back up here, right? So this is an accumulative week, right? And then the next week above average volume, accumulation. We skip this week because it's not above average volume, right? That doesn't count. Again, the next one here, clearly distributive action, and then here the last 3, all accumulation. And then you simply take the count, right? We leave the neutral one out of it. We've got 2 distribution and 5 accumulation. And as long as you're seeing at least 1 more week of accumulation than distribution, you're good to go. I would say this, as a rule of thumb, I stay away from ties. Again, context will matter. If things are really shaping up, it's in a group that's shaping up, and I'm fairly confident that, but again, you are, a little less wind at your back at that point. So you want to make sure your feel is good and that you're looking at the right stuff. But in general, as long as you've got more accumulation than distribution, your thumbs up, and as always, more is better, right? So.
And just to add, because we don't have it exactly in this example, a down week could be considered accumulation if it closes high enough in the range. So if that last distribution week, Ross, if you point that out, the very last one right there, if that closed near its high but still below the close of the prior week, it doesn't matter if that's a down week. It would be a strong push off the lows, and would be considered a accumulation week.
Yeah, especially, let's say, it opened here. Let's say it closed, just that. Back past its open, which would be a super strong close, but still negative on the day below the 21-day, that's still getting a blue line. So yes. Okay. So, and that's also the thing with distribution, the definition of distribution, simply being down 0.2 on heavier volume. it's a great basic definition, but the problem is on those hammer candles, when you get a pink hammer candle, that can be down, let's say 0.23, just a little over 0.2% on the day, but it's a clear accumulation bar. Counting that as distribution based on, that definition makes no sense. You're only hurting yourself. And that works in reverse too. It's basically the opposite of what Bill calls churning or stalling, which can be, it's usually red, like it's a big volume churn with little price progress higher. It can be a little bit blue. It can be, right, so you can have big distribution weeks that are blue, and likewise, you can have big accumulation weeks or days that are pink.
Great.
So, that's pretty much it. Those are all the big changes. Everything else is important as ever. Remember that Bill's original principles are as sound as ever. The only thing we've done here is change the application of them. I would say, while, for those who might say entering early adds risk, the tactical stops, paying attention to personality and all of the other things, I think really helps put the wind at your back at pushing through that overhead resistance that, we talk about in all the CANSLIM workshops. But at the end of the day, I have a huge respect for Stan Weinstein. I've been following him for a very long time as well, and it's been made very clear to me that that isn't necessarily the case when you have the combination, right? StanSlim, you have all of the CANSLIM stuff going on, relative strength, the fundamentals, all of those key bottoming signs. Then you can kind of combine the two and get a much earlier entry, which makes the likelihood of actually holding your winning stock much bigger, which was a big thing for me, because getting in too late with too much size and having to be right creates a whole lot of it's much more difficult to navigate from there. So yeah, and that's it. And as you can see, we can go through here. I'm sure we're sick of looking at the same stocks. This has just been a beautiful one of the more beautiful charts of this cycle, right? You got the launch pad, gives you the ideal early entries right above all of those moving average crosses. You got the smooth, tight personality, so on, and right. You got, like Richard was saying, you've got your relative strength phase beginning here again, right as all of this is going on. The relative strength new highs before price, and so again, as you see the slide putting it all together, this is, you can see when the relative strength, your relative strength screens and your group screens start bringing these to your attention, it pays to start accumulating early, really.
Yeah, so. Excellent. Ross, thank you so much for the presentation, kind of showing how you've adapted CANSLIM and the tweaks you've made to make it work for you. So appreciate it. Any last bits of wisdom or advice for traders who are first starting to use CANSLIM, or maybe want to learn consolidation pivots or some of the adaptations that you've talked about today?
I would say this, sorry about that. I would say this, just like on our scaling in slide, start small, make some progress, add, get comfortable with what you're doing. Here's the two major things. If you can't find a tight logical stop, you don't have a trade, start small, make sure things, and you have to earn the right to add exposure or make your positions bigger. You should always be averaging up, not down. And we're not going to get into it, there are some times where I'm in very specific situations where I might put on a bit of in general, talk to Mike Webster. He won't average down. It's a great rule to start with. Don't average down, meaning you should never be adding exposure unless you've made progress first. If you're losing money and adding, you're going in the wrong direction, right? You're throwing good money after bad, as they say. So manage risk, and manage risk. Otherwise, as long as you do that, the performance will follow. And that would really be it.
Great. Ross, thank you again for your time. To everybody watching, hope you enjoyed as well. Let us know your key takeaways in the chat, and we'll be right back with the next presenter. Cheers. All right. Well, welcome everybody to the end of day 4 of the 2025 TraderLion Conference. hopefully you guys enjoyed today immensely. There were fantastic presenters and topics covered from all sides. So huge thank you, first of all, to our amazing guest speakers, and thank you guys in the audience for attending. Again, really hope that you guys are getting actionable information out of this and have some great takeaways from today. And let us know in the chat what your favorite presentation was and maybe a few of those takeaways. And it'll be cool to see what you guys are getting out of today's conference. Again, a huge thank you to our presenters, Peter Brandt, Pax Trader, Jason Shapiro, Deepak Uppal, Ross Haber, sharing their experience. We've got a great group of veterans here today, and they were absolutely fantastic. So again, let us know in the chat who you most enjoyed listening to today. And yeah, this was fantastic, and so many great lessons shared from all their experience and hard-won lessons as well. Many of them experienced their difficulties, as all traders do, and have come out the other side. So they're able to pass on and share that experience, and hopefully we can avoid those mistakes, or at least deal with them a little bit better. So let's go ahead and benefit from those hard-won lessons. Again, to get the most out of the experience and get the slides and additional resources from all the presentations you just watched, definitely go ahead and take advantage of the free VIP pass. All these sessions are recorded and stored there, in addition to the slides, if there were any, additional speaker notes, additional resources as well. And you also get access to free giveaways of the TraderLion Masterclasses and subscriptions to Deepvue. So definitely go ahead and pick up your free VIP access. If you haven't already, you can scan this QR code or click the link that's in the description right now. It's also in the chat, or should be. Yeah, definitely pick this up. Again, it's 100% free. And not only do you get access to this year's presentations, but you'll also get access to the prior 4 years as well. Just a tremendous breadth of educational material that you don't want to miss. And it's all organized there for you. So definitely pick this up. Again, it's 100% free. So definitely go ahead and scan here or click that link in the description. Again, a huge thank you to Ninja Trader Live for sponsoring the conference. You can tune in to Ninja Trader Live 6 days a week. They're live with featuring real-time market coverage and actionable strategies. You can scan this QR code to learn more. Definitely recommend checking out their resources. They're fantastic. I know many of the traders and educators on that platform, and it's a fantastic resource for futures traders. So definitely check that out. You can, again, scan this QR code, or the link is in the description as well as in the chat. So definitely check out Ninja Trader Live. And again, a huge thank you for powering the TraderLion conference. Also, I do want to mention the Trader's Handbook. Again, this is our debut book that we published just over a month ago. We worked very hard on it. Each chapter covers one aspect of building and refining a trading system. So especially if you're newer to this, you're within your first few years, definitely this will help speed up your learning curve. And even more experienced traders, a lot of the later chapters on post-analysis, doing trading studies, building a model book, a lot of those are very applicable to more experienced folks. So there's something in there for everybody. And we're very proud of this resource that we've created, and I highly recommend you pick up your copy if you haven't already. You can scan this QR code and also click the link. It's in the description as well to go ahead and pick yours up right now. If you've already gotten your book and read it, let us know in the chat what you thought, and you can let other traders know if it's worth picking up. So huge thank you to you guys. We're very proud that's rated 4.9 stars with over 400 reviews on Amazon. There's not many books out there that get that type of coverage. So again, a huge thank you to everybody who's read it and especially reviewed it. And we've got over 13,000 readers in a little over a month, which is pretty, mind-blowing, especially for a more niche trading book. So thank you guys all for picking up a copy, and hopefully it'll be a very valuable resource and help you guys, again, speed up your learning curve. We've got a testimonial from Stan Weinstein. The Trader's Handbook is a clear, no-nonsense resource for anyone serious about improving their trading. It's rooted in common sense, sound technical principles, and most importantly, discipline. The authors focus on price action, trends, risk management, and teach you how to build a real process, not just chase opinions. It's a practical book that respects and emphasizes the core truth that the tape tells all. I recommend that you pick up a copy for your trading library. So listen to Stan, pick up a copy if you haven't already. And I do also want to mention, as I mentioned this morning, by picking up this book, you also get access to the free educational course that goes with it that has additional webinars, bonus webinars, model books, a lot of great material, bonus resources, bonus articles that go in depth into the material and approach it and attack it in different ways. So that by itself is an amazing, amazing resource. So that coupled with the book just makes it a no-brainer. So go ahead and pick up yours and then send us your receipt at traderlion.com/handbook to get access to that free educational course as well. And with that, we've got a sneak preview at next Saturday's schedule. We're kicking things off with U.S. investing champion and record holder Oliver Kell. I learned such an immense amount from Oliver, and that will be absolutely fantastic. Then we've got Roy and Wes Maddox, Himanshu Sharma, Leif Sareda, Christian Flanders, and then Brad Freeman. A wide breadth of different discussions that you don't want to miss. So again, click that subscribe button if you haven't already, and make sure you sign up for that free VIP pass, and we'll send you an email letting you know about the link, all of that well in advance, so you can be prepared to access the final weekend's schedule as well. So again, a huge thank you to everybody for attending. Huge thank you to our presenters, especially from today. They were fantastic. Let us know in the chat again who is your favorite, and also who are you most looking forward to learning from next weekend. This will be absolutely fantastic. Yeah, looking forward to seeing you guys next weekend as well. And again, a huge thank you for all the engagement, the messages, the questions in the chat. You guys have been great. And I look forward to seeing you back here next weekend. So rest up, be ready for next weekend, because we're going to end it with a bang. So definitely go ahead and, again, subscribe, join the free VIP list, and we'll see you back here next weekend. Stay tuned. Take care.